Welcome back to Squawk Box. There's still a partial government shutdown, but the Department of Homeland Security has brought back TSA PreCheck after a brief suspension. Global entry remains paused for the road warriors out there trying to figure out what to do. Joining us right now with the state of traveler ID verification and so much more. Karen Seidenbecker's here, co-founder and CEO of Clear. So before we get into your business, what is the state of play as you see it right now?
I think the state of play is that everyone's hoping that the government reopens quickly. You have TSA employees who are showing up this morning. They've been on the airport floor since 4 a.m. and they're not getting paid. This is the second time in a few months that this has happened. And we're on the verge of a travel surge. Spring break starts in a few weeks, America 250 and the World Cup in 100 days. So I think everyone hopes this reopens quickly.
Okay, so how does this impact your business? I, by the way, am a proud Clear customer. I love the service. Having said that, the service does require, to some degree, the participation of TSA, because you have the Clear employees who then are effectively liaising, if you will. You're skipping the line to some degree, but then you actually have to land in some form of a TSA line at some point. So how does that work, especially right now?
Yeah, so I think it's never been a more important time to have public-private partnerships. We've told TSA, airports, and airlines, and our members, we're open and we're here to help. Our e-gates are in over half of our airports, I think about 40 airports. And so you're going right through, and then our employees are helping divest and help people get through physical screening. So we're here to help. Everyone's got to work together, hand in glove. And so I think it's really important that our over 3,500 ambassadors are on the floor with our awesome and important technology to make it all work together.
Here's a question for you. So that I think about all the time. You have really innovated the whole space in terms of, I don't know, Joe, you'll experience this next time maybe you get Clear and go to the airport.
You know I have Clear.
I know you do, but you know,
it's just,
now you effectively walk in and depending on where terminal you're in or whatever, you can literally just look at the thing and keep going. It's a remarkable thing. But where I was going to go with this is TSA is also trying to develop what seems like very similar technology, or they're trying to get to the same place. And by the way, you now have airlines like Delta and others that are also trying to do this. And so you have this sort of technology. I don't know, do you think of this competition? I mean, they all are, some of them are fast followers. I mean, you've been ahead of them across the board, but I wonder how you think about, it's almost like everybody's competing in the same space in the same airport sometimes.
So I actually think about it that it's never been a better time to be a secure identity platform, and that you're right, we've been leading on biometrics for 15 years. We expect them to be ubiquitous, both in the airports and in the enterprise space. We're now playing to fight fraud, waste, and abuse and things like Medicare, but back to airports, we're focused on the home-to-gate experience. Biometrics are a piece of that, but that is not the driver of the total experience. Our new redone app tells you when to leave to get to your gate perfectly on time. You can book an Uber and reserve it so it picks you up. We now have concierge in 30 airports, so someone can meet you. Someone will be meeting my son today to help him get through either the e-gate or to security, my 81-year-old mom, right, to take her all the way to the gate. And hopefully there will be coffee waiting for you so you don't have to break stride. So
this is on the app?
Yes.
Hold on, so this part now I'm way behind.
There has never been a great reason to use the Clear app until now. So it is reimagined. It can sync with your calendar, home to gate, book an Uber, order a concierge in 30 airports.
Okay, hold on. This is I'm going to the airport today. This is a game changer for me.
Yes, and you can, you guys are members, but if you're not a member, you can enroll with your passport. And it's now both available to U.S. citizens as opposed to 42 visa waiver countries ahead of World Cup.
You just want to say I'm going, like, I want an agent to do everything. So you would say I'm going here.
We are your agent.
But all I say, here's where I'm headed, do everything.
All you have to do is sync it with your calendar. It'll know where you're headed, and it will tell you. Live activities are coming soon. You know, I think when you think about travel, it is the great unknown, highly unpredictable. What's traffic? Where's my gate? How long will security be? What's the walk?
And anxiety.
How much do you think of your business still around travel or around biometrics and sort of using this technology? Sort of, this is the funnel, top of the funnel to get people into the system, and then to eventually use it in all these other places. And I know you've been using it in different stadiums and other places. What's this enterprise plan ultimately look like?
Yeah, so we announced earnings this week where our bookings growth accelerated to up 25% in the fourth quarter. We told the street we would grow free cash flow, beloved free cash flow, up at least 28% this year to over $440 million. We'll end this year with over $1 billion of cash on our balance sheet. We are a secure identity platform that make experiences safer and easier physically and digitally. whether it be keeping North Koreans out of critical infrastructure, right? You got to know that someone is who they say they are in the workforce, whether it be reducing fraud, waste, and abuse in Medicare. And so we think of ourselves as a secure identity platform, a subscription-based secure identity platform in B2C and B2B, and it has never been more important.
Okay, you got to come on back so we can
Well,
talk
it's kind of
about
amazing
this.
what you just said about I'm trying to think of about Medicare and the amount of money we're talking about. If you had bioidentification,
Not if
it's
you have,
mind-boggling.
you will have, and I have
It'd
to.
be mind-boggling.
Yeah,
You got to
you
go to
know,
Minnesota first.
Hats off to this administration. If you read the GAO report from December, one social security number had 125 policies associated with it. They formed 24 fake accounts, 22 got through. Fighting fraud, waste, and abuse is a here and now opportunity, and identity is the tip of the spear.
You get some pushback from the left on for some reason, but
Who
go
doesn't
for
want to
it.
reduce fraud, waste,
They
and
don't.
abuse?
They don't.
I think it's good for America.
I agree.
Are you downloading the
But they
app?
also don't.
I already downloaded the app and I'm logging in and I'm very happy about it, by the way,
Okay,
folks.
let it sit
Okay,
in your calendar.
we'll give you a full review later.
Thank
Thanks.
you.
Thank you.
Thanks, guys.
I can't believe I played along. I'm in. I'm a clear person. Looks
I
at me,
love it.
recognizes me.
I know.
Right. But I did end up right. Andrew's right. You do end up with the good old at some point with TSA. You do end up there.
Public-private partnership.
Yeah, you do.
Yeah. Which you're not paying these people now. Thank you. It's 7 a.m. It's 7 a.m. on the East Coast, and you're watching Squawk Box on CNBC. I'm Joe Kern along with Andrew Ross Sorkin. Becky is off today. Let's get to Dom Chu with a look at this morning's pre-market movers. Hey, Dom.
All right, happy Friday, Joe. Happy Friday, Andrew. We're going to start things off with shares of Dell right now, climbing just about, maybe call it 10% or so at the last check. Now 11% after posting a beat for both profits and revenues and a strong full-year revenue outlook. The PC and server maker is projecting $50 billion worth of AI revenue. That's double what it posted for the prior year. Now, the company is also boosting its dividend by 20%. Several firms on the street are raising their target prices for those shares. Citi's going to $180 from a prior $160. That's a 48% upside from yesterday's closing price of Dell, up 11%. Now let's check on shares of FanDuel parent company Flutter, which are sinking by just about 12 to 13% after reporting worse than expected profits and revenues. The company said bettors lost more often than usual in the fourth quarter, leading to some gamblers betting less and stopping use of the app. On the earnings call, CEO Peter Jackson said he's seen no evidence of prediction markets cannibalizing the sportsbook business. He said the rise of prediction markets would likely spur more legalization of sports betting by states overall. Flutter shares down nearly 13%. We're going to end with shares of Duolingo, which are plunging by just about 25%. After the language learning app maker reported its slowest daily active user growth in 4 years. The company said it's stepping up its investment in artificial intelligence and would sacrifice some monetization to accelerate user growth and engagement. Their CEO saying that would mean slower bookings growth and lower profitability in the shorter term. Those shares, by the way, have lost about 3/4 of their value over the past year. JP Morgan, Morgan Stanley, and Evercore all downgrading that stock due to the focus on user growth over monetization. Shares down 25%. For more on those and other top analyst calls of the day, just head over to cnbc.com/pro. Subscribers get all the content and detail around the big analyst upgrades and downgrades each day. Joe, I'll send things back over to you guys.
Great. All right. Thank you, Don. Joining us now, Dan Moorhead, founder and managing partner of Pantera Capital, a venture capital and blockchain hedge fund. He is formerly the CFO and head of macro trading at Tiger Management. Tiger Cub, you're a full-grown Tiger now, I guess. You're not a Cub anymore at this point. Last time you were on, I think we talked about AI, whether it was rich. There's been some cracks in the market. CoreWeave today, NVIDIA, big numbers yesterday, still down $11. Is it still richly valued in your view? And if you put on a hedge, would you go long crypto and short AI?
Yeah, we track an index of the top 10 AI companies, and they're trading about 20% over their long-term trend, and crypto's trading at a 50% discount to its long-term trend. So as a kind of relative value investor, I think crypto is very cheap relative to AI at this point.
Is it cheap relative to just normalcy?
No, I think it is. Crypto's come off 50% from its highs.
You were expecting that, probably.
And it's literally at its 7th percentile value against this 8-year trend average. So, there have been a few times it's been a little bit cheaper than it is versus this trend, but right now it's about as cheap as it gets.
So 7th percentile, so 93% of the time it has been above historically where it is right now.
Exactly. And one of the things that's just wild about crypto is every investor that's owned Bitcoin for 4 years has made money
Right.
over the entire history. And I've never seen an asset class like that. So as long as you have a multi-year view, this is a fantastic time to enter.
Across the board, not just Bitcoin. You went into Solana. Is that coming back? It's down 60% from when you decided that was the time to go in there.
Yeah, so we still have a large position in Solana. Love that. There are some other good protocols. Very important to have a basket. You know, don't put all your eggs in one thing. But crypto generally is very cheap.
The blockchain, in whether it's Ethereum or whether it's Solana, what will cause the underlying components of the blockchain to appreciate?
Yeah, I think the way to think about it is you know, blockchain is going to kind of impact all kinds of things, and some aren't that obvious. One good example would be the mortgage market. Mike Cagney at Figure has already put 20 billion of mortgages on the blockchain. That doesn't really make the front page of the newspaper because it's kind of boring, but that's where you're going to really see the big impact of blockchain, is real use cases where you're taking the middleman out. And in that case, they're reducing the spread between the borrower and the lender by over 100 basis points.
Will the supply-demand dynamics of building out the blockchain cause these things to become more dear? What I'm talking about? Like, is Solana going to quadruple or go up 10 times in value because of this, just because it's a blockchain building block?
Oh, I think so. Supply and demand is super important in our space. It's like the gold standard. There's a fixed amount of crypto, and so if a lot of people want to buy it, it goes way up. And we just had that in 24 and 25. $115 billion went into ETFs and digital asset treasury companies, and that kind of ran its course. And now that's why the market settled back down. Supply and demand is going to equilibrate, and then it'll get back on its trend.
It is true. You know, time goes fast, Andrew, but remember when I think Bitcoin got down to 17 or something. Remember after it had been at 65?
Right.
Then with ETFs and all the positive things that happened, it was at 125 from 17. We forget that, but now here we are, 67 or wherever it is. I mean, that you got to be a calm investor to weather those moves.
You do, and it actually does follow a 4-year cycle because the number of Bitcoins that are issued gets cut in half every 4 years.
Right.
It really does this cycle, and when it was down around 17 3 or 4 years ago, we forecast that it would hit $117,482 on August 11, 2025. And it did that day. Super wild.
Yeah.
But unfortunately, it means it would come back off. And so that's what it's done.
Well, it used to drop 80%. Some people thought it could go 40 or 50. That's what it's done, basically. So you think right now Bitcoin should be bought anywhere in the 60s?
I think that's a great point. Is the first cycle, we've done 4 cycles now, 4 of these 4-year cycles. It was 87%, then it was 74% loss.
Yeah.
Now it's at 50, so we're pretty close. It's somewhere in there. 50, 60 probably is the worst it can get. But again, if you have a multi-year time frame, these are great prices.
Do you think about the S&P or the NASDAQ?
I do. You know, I used to be a macro trader at Tiger, and I would say that as I look around, the Fed has flooded so much liquidity into the markets. Everything is pretty rich. Bonds are trading 50 basis points below their 50-year average on real rates. The equity risk premium on stocks is another 50 basis points through that. So if you're an investor and you're looking at those look rich to me. And again, crypto does objectively seem cheap.
Okay. So you're not counting the table on the NASDAQ at this point?
No, it seems fully valued.
Fully valued. Dan, well, thank you. Buy crypto, Andrew.
That's what I heard. That's what I heard. Coming up, Netflix is out of the game, out of the bidding war. Paramount's David Ellison winning the battle for Warner Brothers Discovery. Lightshed Partners co-founder Rich Greenfield is going to tell us what he thinks this deal means for the rest of the media sector. And we've got an exclusive interview with the former Secretary of State, Antony Blinken, covering everything from U.S.-Iran nuclear talks to the war in Ukraine. Don't go anywhere, Squawk Box. I'll be right back.
of this 250th anniversary.
Welcome back to Squawk Box. Paramount Skydance set to acquire Warner Brothers Discovery after Netflix bowing out of the bidding war. Join us right now, Rich Greenfield with Lightshed Partners. I want to talk about all the implications of this, Rich, but I want to start with just the basic question, which is, do you believe fundamentally the explanation that Netflix provided for dropping out of this bidding war, which I think came as a surprise to a lot of people, that the price tag was just too rich, or do you believe that there was something else related to politics and the ability for them to get this deal across the finish line from a regulatory perspective that changed the calculus?
I do not believe this was a regulatory fail. I mean, look, Andrew, we lived through the AT&T Time Warner. The government can stop a deal or try to stop a deal, but we're ultimately a nation of laws, and you go to court, and I think there is no doubt in my mind that if Netflix wanted to play this out through the full process, they could have closed this transaction. So I don't believe that this was, they found something, all of a sudden they decided that their own view of regulatory was wrong. I think actually, there's actually a bit more simple explanation to this. Paramount finally came around and did everything the board wanted them to do. And so, you know, they've been literally hammering on the relative value of Discovery Global. And, you know, we've talked on air with you and Joe multiple times about the Versant valuation. What does that mean for Discovery Global? None of that really mattered to the board because they didn't have certainty. They didn't have comfort around closing. And so from that standpoint, that Discovery Global valuation was somewhat secondary. As Paramount did everything else that the board wanted, the price, I think, for Netflix to actually match wasn't just moving up $1.50, because the Paramount bid is probably $31.50 by the time it closes in Q1 2027, and because of that ticking fee. So I think it wasn't just moving up $1.50, it was probably moving up $3. I think that's sort of the body language I get is that the board was going to want more than just that $1.50 tweak. And so, not to mention, I think Paramount would have gone higher. And so I think Netflix realized that they weren't going to be able to solve the leverage issue, or, you know, they didn't want to put more cash in. Like, it was just getting increasingly complicated and increasingly expensive. And I think for Netflix, they were like, you know, we're out. It surprises me that it was this quick, but the ultimate decision of Netflix is a company that has never made a large acquisition and has built an incredible business. I think they feel pretty comfortable continuing to build.
And is your sense that, so you don't believe, I'm not, by the way, suggesting to you that they wouldn't have won a case against the Department of Justice. I think the question that I'd ask is, do you think that there were signals sent in the last week that changed any of the balance of thinking? Obviously, Ted Sarandos was at the White House yesterday, spoke to Pam Bondi, according to the reporting, and others, not the president, you know, individually, and may have gotten some signals even prior to that meeting. Maybe some of the Susan Rice commentary to say, you know what, it's going to cost us more. We're going to be in the crosshairs for a very, very long time. It's going to, or do you say they always knew they were going to be in the crosshairs, and so that's not even part of the calculus?
I mean, they told you it was going to take 18 months plus to close. So, you know, Andrew, they knew. Like, I don't think there was any way you went into this transaction. I mean, go back to the original battle. Like, if you think that first week in December when you and I were talking, like, the whole story then was, oh, Netflix is going to take far longer than Paramount because it's going to be such a tough regulatory road. Like, there was never it's not like the regulatory path was ever expected to be swift. And look, to be honest, I still wonder how fast it's going to be even for Paramount. I mean, you are merging two studios. There is going to be major bloodshed. You know, California's AG has already come out. Like, I actually wonder whether this could take a bit longer to close. And look, that's going to be a big issue for Paramount because they just bought Paramount, meaning Skydance. They want to get their company sort of set so they can build for the future. So the faster this closes, the more they can sort of build a unified strategy. Now the question is, how long is this going to take?
When you start to think about sort of the next steps for Paramount, we were talking to Tom Rogers earlier, you know, given the amount of debt that they're going to be taking on to do this, do you think that there's assets that get sold? How do you think this re-scrambles the chessboard of the media world?
Well, I think, do they do a large equity offering right after closing? I think being this levered, yes, there's lots of synergies, but, we've seen the media space struggle with go back to the original Warner Brothers Discovery transaction, or when Warner Media merged with Discovery, the synergies never really materialized because the core business, the linear TV business, eroded faster. And so that's going to be the challenge here, is how fast can they actually delever? Do you need to do an equity offering to sort of, I wouldn't say protect themselves, but certainly give themselves more breathing room? I mean, being this levered, certainly hampers your flexibility. And so I think the faster they can delever this company, the more they can invest. The thing that was so exciting about Skydance buying Paramount, last year, was having a far less levered. I mean, Andrew, you and I have followed Paramount and the predecessor Viacom for so long. They've been levered, they've been struggling, they've never had the ability to invest. And when you look at what Paramount's been able to do, buy the UFC, get into South Park, we can debate the ROI on any one of these investments, but what's very clear is Paramount, for the first time in, I can't even remember how long, is in investment mode. That's something that wasn't possible with leverage. And so reducing that leverage is going to be critical to investing.
So now they got all the stuff that Warner Brothers was going to spin off, that they were arguing wasn't worth nearly as much as Netflix was, or as Warner Brothers was saying that they were worth. Now they got to say, now it's worth a lot. Suddenly they got to turn around, and if they're going to, I'm sure they're going to sell some of those things, aren't they? Now it's worth a lot in their view.
I mean, look, there are certain assets I could imagine them selling that are non-core. I mean, look, your own, Mark Lazarus, who is the CEO of Versant, I think the two of us were on air a few weeks ago when you formally launched, and I made a comment about, something like the Food Network, which isn't core to, certainly wouldn't be core in my mind to Paramount. Could that be sold? Sure. I mean, there are individual assets, Joe, but I would actually take a slightly different tact. The key for buying these assets, right, is going to be massive cost savings. I mean, the vast majority of the cost savings are going to come from reducing the infrastructure of the linear TV business. And so I'm not sure it's selling as much as dramatically reducing the cost structure of that combined cable television portfolio. There's probably 1,000 people at CNN. My guess is in a year, there's going to be 1,500 or less.
Well, why didn't Warner Brothers decide to do that? Why'd they decide to spin it off then?
Look, the reality is I think for Warner Brothers, they spun it off because they wanted to create a pure play studio asset and streaming business that people would want to buy. And look, your parent company tried to buy it, Netflix tried to buy it. So David Zaslav got mission accomplished. He went from one bidder that would have paid $19 a share in the original bid, Paramount, to three bidders and getting $31.50 or maybe even more if it takes longer. I mean, this could be $32 if the deal drags on. So, the reality is David Zaslav, by splitting the company, was an incredible decision. He brought in more buyers than he ever would have brought in, and I think that's what angered Paramount, obviously, is that they ended up having to pay a lot more. But look, splitting the company even here, I don't think it's possible because you've got too much leverage on day one. You can't do that after this transaction. But they need those cost savings to delever as fast as they humanly can.
I guess you did say that. Why didn't Paramount just wait till the stuff was spun off and then buy some of it? They didn't need the whole thing. So maybe they do like that stub.
Look, I think they look at this business as a funder for their studio and streaming business, and now it's going to be up to execution. I mean, look, Paramount is in the very early days of its transformation since Skydance. Now they're going to go through an even larger transformation. I don't think we've ever seen a company, you basically Skydance, which was a, single-digit, small billion-dollar company, a single-digit billions company, going and now owning both Paramount and Warner Brothers all within a 2-year time frame. I don't think in the history of media we've ever seen something this transformational and this ambitious. And there's a lot of execution risk. This is a big bet by not just David Ellison, but by the Ellison family on building this. I mean, they're going to own the overwhelming majority of the equity here.
Rich, we got to run in a moment, but just tell me what happens to our former parent company, Comcast and NBC, and what you think happens to their ambitions. Does this open up any? I don't see the opportunity that it opens up vis-a-vis, for example, with Netflix or something else, unless you think that this makes Netflix potentially a buyer of other things now.
Look, I have more emails from investors overnight saying, is Comcast going to do something with Netflix now? Now, look, if Brian Roberts was really, he should look at the value that was just paid for studio assets effectively and streaming assets. If you could merge Universal Studios, combine with the theme parks, kill Peacock, and sort of transform that entire thing and plug it into Netflix, sure, that would be absolutely amazing value creation for Comcast. The problem is, you sort of then get stuck with NBC and TV stations. You don't really know. I don't think Netflix wants those assets. So, even with the spin out of Versant, you're still a big player in linear TV, which I think makes that transaction harder. Not impossible. I mean, look, I think the reality is this was a unique opportunity for Netflix. They saw something very unique in both HBO and the Warner Brothers library. It was very clean and pure play. Unless there's something that gets created or spun out that looks like that, I doubt Netflix does anything else. And I think for Comcast, Andrew, I'm sorry, but I don't see a major move coming this year.
Investment bankers, they spin off I think Comcast ought to buy back Versant. Is what I'm. Aren't there's some great assets.
That would be wild, Joe. I mean, just because they create the
bankers
value by it's cheaper now.
Right. What kind of premium you want for it?
We need a premium. Now we need. Remember
I don't think it's about buying
You
back.
want shares or all cash?
The pharmacy benefit managers.
No,
they
but,
sell-
but there is a
they
big
buy them,
learning
they
here.
sell-
But there's a big learning here. Simplifying your company creates more buyers. And so think about for Disney, will Josh tomorrow spin off ESPN and ABC to create more, there is certainly a learning here for what Zaslav did. Smaller pieces create more buyers.
What spun off in the Ford? I'm gonna want 70 for my person. If Comcast comes back, they're
70, Joe. 70?
easily, maybe 80.
70.
Maybe, yeah, just to begin the conversation.
Joe, I want whatever you had for
I want
breakfast.
some ticking thing too. Tick, tick, tick.
Rich Greenfield, always great to
Thank
see
you.
you. Thanks for playing along with us this morning and providing some pretty smart perspective on all of it.
Squeeze those
Thank you.
Roberts. Squeeze them. Coming up, Robert Frank on the booming business. Just kidding, Brian. Seriously, because I still have cable's still very important in my house. The business of the wealthy getting loans against their art collection. Squawk Box returns in just a minute.
Time now for today's Aflac trivia question. Where is the largest mall in North America? The answer when Squawk Box returns. And now the answer to today's Aflac trivia question. Where is the largest mall in North America? The answer, Edmonton, Canada. The West Edmonton Mall covers more than 5 million square feet and has over 800 stores.
The business of lending money to the wealthy against their art collections is becoming a booming industry. Robert Frank joins us now with his latest Inside Wealth report. Suddenly I have visions of people living off their art and never paying capital. I'm now worried about like it's founder stock.
Yet another way of this income stream that Andrew talks a lot about. And we're going to start with billionaire Leon Black, because he had a loan from Bank of America back in 2015 of $484 million. Now, the rate on that loan was 1.4%, but instead of pledging his homes or his company, he pledged his collections of Picassos, Giacomettis, and Van Goghs. Now, borrowing against art has become increasingly popular with the wealthy. This year, art loans expected to top $40 billion. That's nearly doubling in the past 5 years alone. Now, private banks, they're the biggest lenders, followed by the auction houses, especially Sotheby's Financial Services. But a new industry of dozens of art finance companies has allowed even small collectors to cash in on their art. Now, these specialty lenders, they can get rates of 10 to 15%, making it a highly profitable business. And among the wealthy clientele, that's less likely to default. Now, borrowers, for them, they get liquidity, and as Joe just mentioned, they can still keep the art on their walls. Many use the proceeds to buy more art or as tax-free income, and since the biggest collectors today are hedge fund and private equity managers, they're used to using leverage as a wealth strategy. And it can be risky, though. During COVID, back in 2020, 2/3 of specialty art lenders actually had defaults. Now, for more on the Leon Black loan and why the wealthy are borrowing against their art, sign up for the Inside Wealth newsletter at cnbc.com/InsideWealth. I should add, Joe and Andrew, that Senator Wyden has started an investigation into this. He thinks this is some kind of illicit tax evasion, but as we all know, this is another way to buy, borrow, and die. So you borrow against your assets. That's tax-free income. It's a lot cheaper, even at a high interest rate, than selling the art and paying that higher capital gains tax on collectibles. So it's very effective, and more people are doing it.
Now I'm thinking it's also, if we do a wealth tax, and you know how much I want to do that,
Wealth tax.
2 or 3%. Let's throw that art in there too, baby. Can we do that?
It's an asset.
So that would all have to be.
It would have to be
appraised. It would have to be appraised.
It counts as an asset, and it counts as part of your total net worth. Yeah, and in Leon Black's case, of his fortune, $2.7 billion was his art collection.
Yeah.
So some of these collections are meaningful as it relates to their total net worth.
Do you have?
You have an art collection.
I actually do. Yeah,
You should leverage it. I mean, there's something like $1 to $2 trillion in art. In art out there.
We have. Yeah.
That is, and if you think that the total lending market is $40 billion, it's, many say, the most under-leveraged asset in the world. So you could be pulling more cash out of that stuff on your walls.
I like it. Thanks. Don't leave. I want to talk to you. Oh, great.
Okay. Robert, thank you. Before we get to that break, though, check out this. Kalshi users weighing in on the dispute between the Pentagon and Anthropic. We've been talking about it all morning. Yesterday, there was a 42% chance the Pentagon would call the AI giant a supply chain risk. This morning, that number down to 27.9%. Of course, you could be a supply chain risk on one side, and you could be required effectively by the government to be used through the Defense Production Act on the other. Those things seem at odds, but that's part of the debate. Squawk Box coming right back after this. Coming up, a rundown of global hotspots with former Secretary of State Antony Blinken. U.S. and Iran nuclear talks, the ongoing war between Russia and Ukraine, and now a war between Pakistan and Afghanistan. He joins us for an exclusive interview next. Welcome back to Squawk Box. The United States and Iran held indirect talks in Geneva on Thursday in an effort to reach a deal on the nuclear program and potentially avoid a war. During President Trump's State of the Union address, he said he prefers a diplomatic solution with Iran. Join us right now in an exclusive interview to discuss the latest developments in Iran and much more is former Secretary of State Antony Blinken. Good morning to you.
Andrew,
let me read you this headline. This is from the New York Times today. With the threat of a U.S. strike on Iran looming, the United States Embassy in Jerusalem now telling its workers that they may leave Israel and warn them that if they want to, it's vital that they do so immediately. And this is according to an email from Ambassador Mike Huckabee sent to the U.S. mission on Friday. So given where these talks stand and what the notes he's sending, where are we?
Well, this just points to the stakes and everything that's at risk in this moment, because there's a lot of damage Iran can do if it chooses to retaliate, if we attack. We have a lot of assets, a lot of people in the region, in the area, and we have to take the necessary precautions. But look, I think the president's right to want a diplomatic solution, but we're in a kind of ironic position. Apparently, this is about the nuclear program that President Trump said he had obliterated last June with the military action against Iran. Apparently that program hasn't been obliterated. If we're on the brink of potentially going to war using military action to do something about it. It's doubly ironic because, of course, this entire nuclear program was put in a pretty strong lockbox by President Obama back in the day with the Iran nuclear deal, a deal that President Trump tore up and then insisted he would get a better deal. He didn't do that during his first term, but now he actually has an opportunity to do so. And I hope that's where the focus is. Iran, Andrew, is in its weakest position in as long as I can remember. Militarily, politically, economically. It's challenged at home, its economy is in ruins, and of course, its military has been not devastated to the point of not posing a threat, but it is in a very weak
But
position.
how much
that puts
credit
us
do you
in a very
give-
good position for a
How
deal.
much credit do you give? I mean, we should really talk about what's going to happen next, but given that we're relitigating a little bit of the past, how much credit do you give to President Trump and frankly Bibi Netanyahu in terms of the position that Iran is in this moment?
Well, this started back during the Biden administration when Iran tried to attack Israel not once but twice. The United States, for the first time, joined in the active defense of Israel. Israel took actions that initially took out a lot of Iran's air defenses, and then yes, last June, the actions that were taken did tremendous damage to Iran's military. But the question is, where are we going from here? Because I think this is a moment where continued pressure, but also restraint and a focus on getting a deal could actually get a good result, precisely because Iran is so weak.
Well, the question is, what kind of deal can you get, and do you want to have a deal with this regime, or is there the possibility, dare I say, of regime change?
And you know, last time we talked, I think I said anyone who tells you what's going to happen in Iran, particularly with the regime, you should probably talk to someone else. No one knows. The only thing we know for certain is the regime's going to be around until it's not. That could be tomorrow, that could be in 2 years, that could be in 5 years. One of the challenges that we've had for a long time is dealing with the nuclear program. So now we're in a position where I think sustaining the pressure that we have, taking advantage of the weak position that Iran is in, you could get a good deal. The president needs to get a deal, I think, that he can present as stronger than the one that President Obama achieved. That's what he said he would do. I think he's actually in a place to do that. But at the very least, we ought to be able to hear from President Trump, from the administration, exactly what we're trying to do, how we're trying to do it. To my knowledge, Congress hasn't been informed of that. Certainly the American people haven't been informed of that. And given the stakes, given what you started with, we've got 30 or 40,000 American assets in the region, so many American citizens or dual nationals, all of the repercussions that can flow from a war, we ought to make that very, very clear. And here's the thing. The Iranians may well conclude, even from a limited military action, that there's an existential threat to their regime, and they may respond in kind. Last time around, they were fairly restrained. The lesson they may have learned is that restraint equals more aggression from their perspective. So we've got to make sure that we're communicating as clearly as possible about what we expect. That should start with the American people. But I think there is an opportunity if it's used wisely.
What is your take just on the strategy of using Jared Kushner and Witkoff in these negotiations as opposed to maybe Rubio directly? I ask because you're the former Secretary of State, he's the current Secretary of State.
Look, there's a lot of work to go around. Different administrations do this differently. Some put more emphasis on special envoys, others on sitting officials. Look, it is good as a general matter to have officials in place who are doing these things who can actually be held responsible by Congress because they've been confirmed by Congress. So I'd like to see that, but look, if you can get the job done, fine. And as I said, there's a lot of work to go around.
Let me ask you, I want to get into Ukraine and Russia, but let me just ask you about the State of the Union and maybe even tariffs to some degree, which is sort of where you think the U.S. sort of stands in the world. We've just made all of these deals around the world, ostensibly to huge, $100 billion of commitments to invest in America. The rest of the world now is seeing that the Supreme Court has undone these tariffs, at least under this current construct. The president will try to keep these tariffs in place for as long as he can. How do you think all of that manifests itself?
Heads are spinning. They continue to spin. Look, I saw a poll the other day that had 70% of Germans considering the United States to be an adversary. About 50% of South Koreans said we're threatening. We've managed in so many ways, by so many means, to alienate our closest allies and our closest partners. And at the very least, the ongoing unpredictability makes it very hard to get things done. The thing that I'm most concerned about is that countries will increasingly try to work away from and around the United States, cut their own deals, set up their own supply chains. Now, there are limits to that. The primacy of our financial system means that people have to do business with us.
Right.
But at least on the margins and maybe more, you're going to see things moving away from the United States in ways that are, I think, not favorable to our interests. And, you know, the other thing is this, Andrew. I'm almost more concerned with the destruction of an internal alliance as I am an external one. By that I mean this. After the Second World War, as we know well, we created this extraordinary alliance among the federal government, our universities, research institutions, national labs. We went from spending about 1.4% of GDP on research and development to 3.5% by the time President Biden left office. And that meant that whereas at the start of the 20th century, there was not a scientific pursuit in which the United States led the world, we've gotten to a point by the start of the 21st century where there was not a scientific pursuit in which the United States didn't lead the world. And that had powerful, powerful ramifications for our economy, for our national security. That system now being threatened and being challenged. Luckily, from my perspective, Congress is standing up trying to preserve the funding. That's hugely important. And at the same time, we have to make sure that we continue to attract the smartest, the best, the brightest to be the engines
Mr. Secretary,
of
that's
this remarkable progress.
That's a nice segue to my final question, which actually relates to what's happening with Anthropic and the Pentagon. Because the good news is that in terms of AI, we seem to be out front, at least for now. I know that it feels that we're in a war of sorts, or a technological war with China. But there's a big debate right now about how the Pentagon should use this technology. You have Anthropic saying, look, we're happy for you to use this technology, just please don't use it for surveillance purposes, and we don't believe the technology is ready to be used for autonomous weapons. The Pentagon saying, as long as it's lawful, we want to use it. We believe that surveillance is illegal, so we're not going to use it that way. Anthropic says, by the way, you still could in certain types of ways. And then, of course, there's this debate about autonomous weapons. Where do you land on that?
Well, first, we shouldn't be treating Anthropic like it's a European ally, in other words, an adversary. This is a company, and in Dario Modi, this is a leader who've been a critical part of the national security mission, maybe more than any other leading AI company. And I know that from my own experience when I was Secretary of State. They've been a critical component of it and really leaning into it. Second, as you say, this really shouldn't be that hard. And in a way, I think the burden should be on the Pentagon to answer the question, not Anthropic. And it's pretty simple, as you said. Do you intend to use AI-generated technology for the mass surveillance of Americans? I think the answer should be clear and is obvious, and it should be no. Do you intend to use these systems powered by AI, autonomous systems, without a human being in the loop on the battlefield in ways that could kill human beings? The answer should be clear. It should be no. Clearing that up shouldn't be that complicated. Now, I understand from the Pentagon's perspective that having to do this on a contract-by-contract basis every time is really burdensome, which suggests to me that we ought to have some regulation on this. It's something that Anthropic has been asking for. And in fact, again, here, this is a company that, when it comes to, on the one hand, seeing the extraordinary potential and possibility of AI, but on the other hand, being responsible and saying we've got to look at safety, we've got to look at security, we've got to look at risk, we want to encourage that. You were saying earlier, and rightly, you know, the government now is looking at using two very powerful tools to compel Anthropic to do what it wants: the Defense Production Act and this notion that it's a supply chain risk. As you said, you can't have it both ways. It can't at once be essential to our national security and a threat to our national security. They ought to be able to work this out, but the government really ought to be able to make clear that it doesn't intend to engage in mass surveillance of Americans, and it doesn't intend to use these systems, these lethal systems, without a human being in the loop.
Secretary Blinken, thank you for joining us and offering your perspective on everything going on. I wish we could talk a lot longer, and we look forward to talking to you again soon. Thank you.
Coming up, more mortgage rates dropping below 6% for the first time in years, just in time for a strategic partnership in the real estate market. The CEOs of Compass and Rocket Companies will tell us about their alliance. That's coming up next. Squawk Box will be right back. Mortgage owner and home ownership platform Rocket Companies forming a strategic alliance with Compass to increase home listing inventory on Redfin. It's a 3-year partnership that could bring 500,000 more home listings to market. Joining us now, Compass CEO and co-founder Robert Revkin and Rocket CEO Varun Krishna. And it's not fortuitously, it's serendipitously. Look at you guys. I mean, you're in the sweet spot. Mortgage rates finally under 6% on the day that you're here. Did you plan it that way? You didn't.
We didn't plan it that way, but we're really happy about it.
Yeah, I'll bet you are. How does it work? Well, go. It was released with the earnings today that there's going to be this partnership.
So this reflects the largest brokerage in the country, 9 brands, 340,000 agents, Compass, Corcoran, Sotheby's, Coldwell Banker, ERA, Better Homes and Gardens, Century 21, Christie's, At Properties, partnering with the largest mortgage company in the country to give home sellers choices they didn't have before. Now, for the first time, they can market their property to 60 million buyers without the risk of days on market and price drop history.
And when will it close? Or when will it begin? When will things be actually listed?
I mean, the partnership begins immediately. I mean, you're going to start to see coming soon listings on Redfin.
It's live today?
That's right. That's right. So we're going to start to see listings, and that's going to ramp up over time. And this is really focused on home affordability and how we can actually put a dent and really create more home affordability and attack the problem in 2 ways. You know, there's the buyer, there's also the seller. And as Robert said, you know, a big part of this is focused on the seller. If we can create more inventory, I think everyone can agree that's going to be a good thing for buyers. And so this will create a lot more inventory available on the market. And then for buyers, there's a mortgage partnership that where we will integrate Rocket Mortgage with the Compass platform and offer a more integrated experience, low rates, low fees. We have a preferred pricing bundle that we're also introducing, and we're excited about it.
So a buyer could select a home, and then he could be directly connected to an agent and a mortgage supplier. A real agent? Would it be AI? This is one of those things where it's going to be agentic. Could you just do all this in 2 or 3 years without even talking to someone?
I mean, I think on some level, the human connection when it comes to your biggest purchase is very real.
Right.
I think agents play a very, very important role in creating confidence and choice for consumers. I think Robert has built an entire company that's built around that. I think technology will help speed things up. It'll help make things more efficient, remove waste from the system, and that should create value. That should lower rates, fees, lower friction, improve turn times, faster closings, create certainty. That's where we think AI and technology will play a big role.
But as far as the supply goes, the supply isn't immediately or suddenly increased, but if you can see the supply, it's like it was increased.
Yeah, so there are artificial barriers for you to list your home. Days on market, price drop history, valuation estimates that could be less than the value of your home. We're taking those artificial barriers away. There shouldn't be fear to list a home. And by doing so, more inventory will come to the market. And one example of that is 11% of the inventory in the fall was taken off the market during the winter and brought back on just in this spring market that's coming up. Why was it taken off? That was days on market, there's fear of looking stale. So we're taking that fear away from the seller.
Why have mortgage rates been so stubborn, in your view?
Well, I think there's a lot of different things. You've got inflation, you've got other sort of pressures in the economic
Fed's been cutting.
market. Yeah, we have. Well, the good news
And more cuts to come.
is the 10-year Treasury is down. Mortgage
four.
rates now have a 5 handle on them, which is great. You have over $1 trillion of equity that can now be unlocked, and so we think this is a great thing. Mortgage rates are the lowest that they've been in the past 3 to 5 years. So we expect that to unlock buyers, but the key thing is we also have to unlock sellers. I think one thing that's really important, I think, to understand about this partnership is the world in some ways has forgotten about the seller, and without a seller, there cannot be buyers. And so sellers and buyers kind of work together to create that equation, and every seller is a buyer. So it's moving in the right direction, and we think that's going to unlock more demand.
What else would you like to see from the Trump administration, Robert?
Look,
For homes, this is every day. Affordability, housing.
What I'd like to see is helping home builders build more inventory. I'd like to see, of course, more cuts would be good. If mortgage rates can sustainably stay in the 5s for the spring market, I think we'll get will be at the highest level of transactions since 2019. Right now, we have 11% more inventory than we did this time last year. Pending transactions are up 4% year over year. Prices are just up 1%. So the dynamics are positive and constructive, but we would like to see mortgage rates stay sustainably in the 5s.
Can I try something out on you? And I don't know how big a market you think this is. There's an argument to be made. In fact, I think that Scott Bessent made it at some point, and was criticized for it, even though I think there's an accuracy to it, which is there are these people, retirees, who own a bunch of homes, like a whole bunch of homes that they made as investments, that because of a lot of things that are going on, and for tax purposes, don't want to sell those homes. So they're renting them out. And whether you would even think about any kind of tax structure or shifting the tax structure even for some kind of short period of time to try to get them effectively out of those homes so that they sell them and to try to create more inventory. I don't know if you think that's a completely wild or crazy idea, but people have been talking about how you actually get some of that into the market.
That's a great idea. Making mortgages portable would be so you wouldn't lose your low interest rate.
Right.
That would also.
That one seems harder.
It is hard.
The portable and the mortgage seems harder. The question is, do you look? A lot of the retirees who do own these homes, will, if they hold on to them, there'll be a step up in basis that they'll give off, to whoever's part of their estate later. The question is, maybe you give them the discount now so they sell those properties.
Yeah, that's a huge issue. So in the Bay Area, for example, I hear this all the time. People bought their homes 30 years ago, 40 years ago, and if they sell it and they retire and move to a retiring home, they'll pay a huge amount of tax.
Right.
So how can you help with that so that they defer the tax in any way that will help them not feel that pain immediately?
I think ultimately we support anything that creates more reform and modernization in this space, right? We know today the experience is antiquated, there's too much friction, it's too expensive, there's not enough supply, there's no demand, and we've got to do something to unfreeze that. I mean, that's a big part of why we're doing this partnership is, affordability is more than any one thing. I mean, it's taxes, it's income, it's insurance, but we want to do our part, and we're hoping the rest of the industry and the administration supports that as well.
Great. All right, gentlemen, good luck. Thank you.
Thank you.
And congratulations on the 5 handle. I know you guys walked in here, you were like floating. Oh, yeah. Smoshbox coming right back.
Great to be on.
Paramount has emerged as the victor in the battle for Warner Brothers Discovery after Netflix has bowed out. Our David Faber joins us now from the New York Stock Exchange. A lot of different ramifications for Barrow, and it is Friday. I see the no tie look. You can pull that off. It's good. Let's talk about this. Should I be thinking about a dog catching a bus and then saying, what the hell do I do with this now? Not so much, maybe. and then what do we think about Zaslav? To go from, what was it, $7 and to get one of the hottest auctions we've seen in years, and what do we let's call it 32, because things are tick, 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 tick. It's not 31, right?
Where do you want me to start? What do you want me to try and answer first, Joe?
What are you most excited about? What do you feel like you can really wow me with and wow all our viewers with? What type of more
really?
than even
that
normal?
wasn't part of the questions. You listed 3 questions, then I asked you for 1, and then you gave me a 4th.
Oh, let me think about if I can come up with the 5th.
All right, let me listen. I'll try and answer a few of them because
Okay.
they were all actually good questions. I think the dog catching the bus one. Paramount was an $11 billion market cap company. Obviously, 70% of its cash flow, I think, still comes from cable networks. It's going to lever up to about 7 to 7.5 times to do what is one of the largest, as Warner Brothers board said very often, leveraged buyouts of all time. Obviously, with a lot of equity. A lot of it coming from Larry Ellison, some of it coming from Redbird, and much of it also coming from other investors. We'll see how that all pans out. But you're right. The question will be delivering on $6 billion in synergies that Paramount has talked about. Clearly, they needed this. They were sitting there, as I said, it was an $11 billion market cap company. With that, now they can diversify. They can obviously build significantly in terms of the studio, and most importantly, streaming and all their plans there. But they're going to have to deliver on those $6 billion in synergies. They're confident that they can, because you need to. When you're going to lever up at more than 7 times, you've got to bring that down quickly. And if, in fact, they are able to deliver on 100% of the synergies, they will tell you, well, we're only going to be levered at about 4.5 times. So that's a key part of this. As for Zaslav, listen, they did a great job creating value. There's no way around saying that. That is the board, and I argued many times with people on the Paramount side who felt like things were tilted against them and the process was not fair. Ultimately, when they delivered the certainty that board had been asking for throughout the process, they got in the front door, they got the deal that they wanted at $31. Of course, let's not forget, they started at 19. And they've gotten their deal. So Zaslav and the board delivered great value. Thanks, by the way, guys, to Netflix being there. Without Netflix, you're not getting anywhere near 31, are you? Again, I pointed out they started at 19. I think the original conversations, I was looking back in my endless notes here, maybe they would have gone mid-20s is what they were thinking to get it done. And look where they ended up, Joe, 31.
We talked the irony of I guess Paramount talking down the value of that stub, right? Pointing out the debt that it had versus. Now they're going to be trying to sell some of those things, and now they're going to be talking up the value of it. It's kind of they're going to have to.
It is kind of funny, and also don't forget, as you know, I mean, MTV, Nickelodeon, BET, like they're a cable networks company too, and yet they were talking down the value based on the Versant multiple. That didn't help anything here in terms of the argument around value for the Netflix deal at $27.75 in cash, and then whatever the value was of this spun-off entity that would have included all those cable networks and a lot of debt. And that was a key consideration here. How do you deal with this debt adjustment? Because you probably would have had to. When people close, the Netflix point of view, my belief was that they would have had to raise at least $2.50 to $3 a share just to be able to kind of hope that they matched. But the prospect, Joe, that Paramount would have come back again. As high as 31 is, and maybe it gets a little higher with the ticking fee, they were prepared to go even higher, is my understanding. And so Netflix said, we'll take our $2.8 billion and we'll see you later.
Because we've been kicking that around. Is that why Netflix decided what's another $1? Or there was an intimation that Pam Bondi said, no way, boys, that this is going to. Do you think there's anything to that?
I don't know, Joe. I was trying to work on that last night in terms of trying to understand what happened yesterday in Washington when Ted Sarandos met with Bondi around this Section 2 investigation of them as a monopoly. There's some thinking, but not from the Netflix side. That I didn't hear that. They believe firmly they would have gotten the approvals. The Warner Brothers board was also consistent that they believed they would have gotten the regulatory approvals. But I'll leave it to you to tell me exactly what happened in that meeting and whether there still will be the Section 2 investigation
David, let me ask you this,
or not, because I just don't know. Yeah.
I got the sense in the past couple of days that Netflix was getting a little bit, I don't want to say skittish, but just a little less hot.
Yeah.
And so what I wonder was not necessarily whether it was said in that meeting yesterday, but maybe earlier in the week, or maybe when it started with some of the Susan Rice stuff or others. I'm just trying to figure out, something happened in the last week where they went from this is super important and we're doing it, we're defending it, we're going all in, to we're not. And
the only thing would be, Andrew, that it was their view on antitrust darkened. If that's true. I will tell you, when I would speak to their side, the words that I would constantly hear were discipline and nice to have, not must have. They were very consistent in that. Now, they obviously did step up and got a deal done originally, much to the chagrin and surprise, I think, of Paramount and its advisors, perhaps. But, they were consistent in that. But I don't know if anything did color their decision. It certainly had to have been in part, I think, antitrust and this possibility of a Section 2 investigation around them as a monopoly. And then, obviously, they knew what they were competing with here, a company that it was much more of a must-have for, I think.
Yeah,
and
definitely.
so, 31 with the ticking fee, although, by the way, on regulatory, they've already gotten HSR here, right? They've already gotten clearance essentially here in the U.S. as Paramount. So really it's about Europe. We'll see whether any state AGs show up, but they believe they're going to get this deal done as soon as, let's call it late summer, before that ticking fee goes into place starting, October 1st at 25 cents a quarter.
I don't have a lava lamp, but this would be like the old Squawk Box, because I got an idea. I don't know if you heard it earlier. You know how many times in the past we've talked about these investment bankers, merge, demerge, buy the PBM, sell the PBM. I don't know what Comcast is going to do, but Versant is one hell of a company. What do you think? If they do approach Versant, I'm not going cheap. What do you want for 70?
Who's buying Versant?
Yeah, because they don't have
Comcast is going to buy us back.
Exactly. The investment bankers are floating that idea, right? Why are you laughing? They're floating that idea, but I'm not going cheap. What do you want for your
No, I think we deserve 10 times. 10 times.
What would that come out to on a per?
It'd be a lot higher than we are. We're trading around 3.5 times right now.
That probably won't happen.
And by the way, stock's up. I think you've seen versus stock is up.
I do wonder what Comcast does. And Greenfield was talking about Comcast Netflix or something.
I don't know if that happens. But listen, Comcast was a bidder here. They had a very creative structure. Ultimately, it wasn't going to win the day given its structure. Given the fact that the Roberts family is very reluctant to give up its vote, so they were going to still have, it was 51-49 in terms of how it would have worked out with additional cash put in. I won't go into details, we've talked about it previously, but yeah, it's a fair point. Joe, what happens ultimately? I mean, all of this is under the guise of what's going on in Hollywood and the rise of streaming, but certainly the rise of YouTube in many ways and what that means for linear cable networks, which we all know. At least entertainment linear cable networks. News, much better. And sports also very helpful. You're right. So these are key questions as we continue to watch sort of the pieces change. Netflix, for its part, though, can just kind of pursue what it was. I mean, let's not forget, it was a surprise that they came in so strong here. And it will be interesting for their shareholders to sort of assess as you watch the stock soar yet again. Well, was it strategic? Did they really need it? What was it saying about their view of the business longer term?
Are you going to see that mega superstar or media person, Sarah Eisen? Are you going to see her today?
No, I think she's still on the View.
Oh, still? Yeah, that's right. I guess it's.
I think it was a 2-day gig.
Great job yesterday. I saw this. It was trending. They were shocked. They were like, whoa, what? Anyway, thanks, Dave. See you later.
Coming up, IBM's Vice Chair and former NEC Director Gary Cohen is going to join us to talk tariffs, inflation, AI, and much more. And then the number of the morning, the Producer Price Index is going to be out. We're going to bring you the numbers and market reaction. Don't go anywhere.
Shares of financial technology company Block shooting higher after CEO Jack Dorsey said he was laying off 40% of the team due to AI efficiencies. In a letter to shareholders, he said, intelligence tools have changed what it means to run a company. That's just one of the things we're going to talk about with IBM Vice Chair and former NEC Director Gary Cohn. Someone did write into me, Gary, and welcome, it's good to see you, that Elon Musk bought Twitter and got rid of like 90% of their employees, and not one thing happened. So maybe Dorsey has some bloated employee ranks at companies that he owns, or runs.
Joe, look, it's great to be here. Look, I think we're in this reality where companies are being forced to run themselves much more efficiently. We saw headcounts around the world blow pretty dramatically after COVID. People were hoarding labor. When people were working from home, they were working 2, 3, 4 days a week. The productivity rate was down. So companies had to make sure they had excess capacity, excess employees. We're now back to a much more normalized environment. People back in the office. We're getting productivity out of workers. And we've got this whole new AI, thing upon us, let's call it. And it's hard for companies to actually explain how they're using how they're using AI. But the one KPI that they can tell you is we've cut heads. So today we've sort of made the world synonymous with I'm using AI, therefore I need less heads. I ultimately don't think that's the truth, but companies don't have a better way to explain to you how they're creating synergies, how they're creating productivity. They're saying, look, we're just being more efficient by cutting heads. And I think that's the trend we are seeing and we have seen for the last year or so.
Because you have been in past appearances, and I remember you were explaining something that was very confounding about, I guess, the labor force or the Jobs Fridays, what was going on, and you said people don't need that. I remember what it was. the reason that one way to deal with tariffs is you look at the whole situation at your company, and if your margins are going to be hurt by some increased costs, then you're not going to hire people, and that's the way they were dealing with it.
Yeah. So if you look,
so that's continuing.
I agree. And if you look back on the last few years, and you think what companies have had to live through, we went from a zero interest rate environment in 22 to the Fed raising rates to 5.5%, 5.75%. They did that to slow the economy down. Right? That's why you raise interest rates. So we went through that period of zero interest rates to higher interest rates. We've gone through this period of what I would call trade wars, trade imbalances, higher input costs. We've gone through this world where the dollar continues to go down in value, meaning that a lot of the commodity input costs continue to go up in value in dollar terms. So if you're going through this period of time where your input costs, whether it's cost of funding, cost of labor, cost of raw materials go up, and you don't feel like you have pricing power to the consumer, the company's going to get squeezed somewhere. And where they've been trying to alleviate the earnings problem is they've been doing it through human capital. So human capital has been sort of the lever that companies have been pulling to make themselves profitable. And you saw it, even in this last quarter's earnings announcements, we saw well over 100,000 announced layoffs in some of the bigger companies. And I think this is a trend we're going to continue to see as people fight with higher interest rate costs, higher input costs, higher commodity costs, and more trade tariffs.
One thing that President Trump tried to do the other night was highlight some of the things in the economy that the administration feels are underappreciated. Yeah. And there are a lot of things that are underappreciated. We had Mike Wilson, I know you followed his work the other day. He said, look, the stock market anticipates future positive business activity, and then as it starts playing out, some of the money comes out of the stock market and goes to fund the increased corporate activity. He's expecting some blockbuster year, inflation trending down or maybe at least flat. Yeah. You have the same optimism? It's not reflected in polls.
Look, I'm fairly optimistic right now. We've got a lot of really strong tailwinds, and I think the president tried to talk about some of these tailwinds during the State of the Union. Look, we've got the Build Back Better bill, and what people are now starting to understand for the first time is when they put that legislation through, they changed things in the tax code retroactive to last year, but they didn't change the withholding tables, meaning that we could have withheld less money from workers every day. Instead, what they did, and probably very smartly, is they kept the withholding rates at the same level. So as people are actually filing their taxes today, they're getting a much bigger refund than they might have expected. They're allowing to deduct higher SALT deductions. So whether it's state and local taxes, real estate taxes, that's giving people more money. So the consumer is getting more money in their pocket. You look at what's going on in the CapEx boom and the reindustrialization of the United States.
Is that happening?
It's happening, but I've always sat here and said, look, this stuff is slow. As fast as the federal government wants to work, and as fast as the federal government wants to get manufacturing built and they want to get data centers built, state and local regulation does not move at the speed that federal regulation moves. So these plans to build and these plans to develop factories, they're in state courts, they're in state zoning committees, they're in city courts, they're in city zoning commission. We're starting to now see some of that money being put to work in real construction projects.
The Dow hit 50,000. We heard that the other night. Yep. The S&P hit 7,000. But Monday was it Monday or a scary day. Today, I think we're down 450 now. NVIDIA unable, with a great report yesterday, unable to save the technology sector or the AI or software or whatever. Is this just a normal backing and filling after a big gain, or is there more to it?
So, Joe, I think we're having a bit of a rotation. If you look at the S&P itself, the market cap weighted index. So the biggest companies have the biggest influence, which are the companies we've been talking about, the NVIDIAs, the Googles, the Microsofts.
It's gone up so much.
This year it's today flat, right now with today's activity, it's about flat.
Flat. Right. But prior to that,
if you look at the equal weighted index, where every company is equal, that index as of last night was up about 6%. Okay. So net, we're seeing the stock market as a whole hold its value. We're just seeing a rotation where people want to be. People are starting to reevaluate the growth numbers that they had on a bunch of these, I would say, technology companies, software companies, technology companies, and they're starting to reevaluate the growth of what I would say traditional companies in America. And traditional companies like Walmart, like J&J, like Exxon, like Verizon, companies like that are all trading basically at their 52-week high as people are saying, look, I still want to be invested in the market. I still want to be long the economy. I just want to be long it in a more judicious fashion where I don't have as much exposure to the Mag 7 or the top 5 or 7 names. I want to have exposure across the board.
Will you stay for a while? We're going to get a number that we got to get.
I'd love to.
We'd love to have you here. He's going to be staying. We'll get his reaction to the PPI data coming out in just a few minutes. Squawk Box. Squawk Box. We'll be right back.
Welcome back to Squawk Box. Rick Santella here, live with this Friday's breaking news of the morning, our January read on wholesale inflation, PPI, Producer Price Index, coming in up 0.5%. That's hotter than expected by a couple of tenths. Equals where we were last month at up 0.5, and the up 0.5 last month was the hottest in September when we were up 0.7. If you strip out food and energy, it's up 0.8%. That's a 0.5% higher than expected, 1/10 hotter than our last look, and that would equal where we were in July. To find a higher number, you're going in the Wayback Machine of March of 22. If strip out energy, food, and trade, it's up 0.3, as expected, 1/10 lower than the rear view mirror, and 0.3 would be the smallest since it was 0.2 in November of last year. Now, in my opinion, some of the more important year over year gives us that macro view. 2.9 on year over year headline final demand. That's hotter than expected, 1/10 cooler than the rear view mirror. 2.9 would be the warmest since it was 3.2. 2.9 would be the coolest since it was 2.8 in October of last year. X Food and Energy 3.6. That's 6/10 hotter, 3/10 hotter in the rear view mirror. That's the hottest going all the way back to March of last year. And finally, X Food, X Energy, X Trade 3.4, little lighter than expectations, lighter than the 3.5 in the rear view mirror. Equals October. You're going to September to find a lower number. There are some revisions to the monthly numbers. Each one loses a tenth, but everything is still warmer. Market hasn't responded much. Doesn't seem to pay much attention, and many were expecting a hotter number. And today's the big day. We're actually under 4%. Andrew, back to you.
Rick, thank you for that. We're going to run through all of these numbers in just a moment, but we also have some big breaking news for us right now. OpenAI officially now raising $110 billion in new funding, values the company at $730 billion. And this investment includes investments from SoftBank, NVIDIA, and maybe most importantly, Amazon, which is now deepening its relationship with the AI giant through what is now going to be a multi-year strategic partnership. They are investing the equivalent of $50 billion in OpenAI. Of course, OpenAI has had a relationship with Microsoft for so very long. Amazon had a relationship and continues to have a relationship with Anthropic. This may change the game all over again. In just about 10 minutes from now, we are going to speak with Amazon CEO Andy Jassy, is going to be joining us, and OpenAI CEO Sam Altman about this deal, first on CNBC.
All right, let's get a reaction from Gary Cohn on this. We didn't talk about the sub-4 10-year in mortgage rates falling below 6%. Yeah. So some of those things, it takes time for all this stuff to happen, but it does seem to be happening. You think that the mood of the country eventually improves if we believe the polls?
I do. I believe that the mood of the country does improve. Look, these PPI numbers today are not going to be helpful. But a lot of this is when you see on the producer side, a lot of this, as you can see, is input costs. Right? When you're talking about producer price index, the producer has to absorb the input cost. They have to absorb the higher commodity prices, the higher copper prices, aluminum prices, steel prices, nickel prices. They have to absorb the higher interest rate prices. They have to absorb the higher labor prices. And so we're seeing, and they have to absorb trade. The cost of trade has gone up. And you saw that in the numbers. The ex-trade numbers were not nearly as high as the numbers that include trade. So look, I think we still have to be realistic that there is some pressure in the system and that inflation still is lingering around. That said, I agree with her. There's a lot of positive news. As you see, interest rates, mortgage rates falling, 10-year down below 4%, and tax refunds and the CapEx will continue to stimulate economic growth, continue to stimulate jobs.
The beginning of the show today, in relation to the block news, I didn't initially think about Twitter and how many extraneous, irrelevant employees they obviously had at the time. I don't know if the same situation was back, but we immediately wrote it off to AI and what the future looks like, and we even, so we jumped to conclusions. We even got to UBI, because no one's going to have a job, universal basic income. We actually got all the way there, because I don't know, we've seen past disruptions, and when people lose their job making buggy whips, they end up making transmissions. We understand how that works, but this time seems like it's harder to connect the dots to a positive future for everybody. With 300 million people in this country, what if there's all these agents and truck drivers are gone? What's everybody going to be doing, Gary?
Joe, I look at it like this. If you look at the history of technology and technological advancements, we've always gone through these periods where it's been, oh my God, it's the end of work, it's the end of civilization, it's the end of life as we know it, because what I do isn't going to exist tomorrow, and a machine's going to do my job. Right. And that is, we saw that, you're right, you go back to the internal combustion engine, you go back to the cotton gin, you go back to the internet, you go back to all of these technological advances that really changed the way we work. We had all of these fears. What's happened over history, and I believe it will happen again, is these are all productivity tools. Productivity means that we produce more units of output per labor. When we do that, the economy gets bigger. The economy gets dramatically bigger. It's what drives economic growth here. As we grow productivity, we will need people. People will do different things. As you said, you won't be cleaning bars anymore, barns. You'll be changing transmission fluids, or you'll be building transmissions. We are going to need people to drive the economy. We're going to have people that know how to work in the economy. And look, there are things that AI can do. I'm afraid that we're not going to allow AI to do it, and it's probably the right thing, because people are going to have to learn skills. So, you know, if you're working in an investment bank today and you need to put out a presentation, can an AI machine do the presentation fairly well? It probably can. But 3 years from now, when you're the banker sitting in front of the client trying to get a transaction closed, you have to understand the way the income statement works. You have to understand the balance sheet. You have to be able to play with the Excel spreadsheet in front of the client to make the deal work. Yeah. So even though the AI machine can do these things at 90% confidence interval, I still think we're going to need people there getting things done. We've never proven that we can get something done without human intervention, without human logic, and without human interface.
But we've never had something that futurists were calling the singularity, and that's when the machines get so smart that they know 1 billion times all human knowledge, and this time could be different.
This time could be different, and we said this time could be different before.
We'd probably be dead. Anyway, no, we're both young, and now we might live forever with AI. Anyway, thank you. We'll be Scott Bucks will be right back.
Welcome back to Squawk Box. A massive deal this morning. OpenAI now raising $110 billion in new funding. It values the company at $730 billion. Investors in the round include SoftBank, NVIDIA, and importantly, the biggest one now, Amazon, committing $50 billion in funding for this round, and the pair now announcing a new multi-year strategic partnership which may reshuffle the landscape of AI all over again. Joining us now for a first on CNBC interview is Amazon CEO Andy Jassy and OpenAI CEO Sam Altman. Good morning to both of you on what appears to be a watershed transaction. Sam, I'll start with you. $110 billion, $730 billion valuation, but explain, if you could, how you think this deal shifts the balance. I was suggesting it shifts the balance in large part because the relationship you've had for so very long was with Microsoft, and now you have Amazon as well, and in certain cases on an exclusive basis for a big part of the next push.
Good morning. Thanks for having us. We're super excited about this deal. We will continue to have a great relationship with Microsoft. We're excited to have a great relationship with Amazon. AI is going to happen everywhere. It's transforming the whole economy, and the world needs a lot of collective computing power to meet the demand. The world also needs a lot of new kinds of products, and we'll continue to do our work with Microsoft, but we're very excited about the new product work we'll do together with Amazon. And I think, as you said, it will be a great, very long-term partnership.
We're going to get into all of it. Andy, $50 billion, a huge investment from Amazon. As part of that investment, there's a whole bunch of component parts around the partnership that you're going to have with this company. But interestingly, in the press release, you talk about $15 billion up front, $35 billion that will come after if certain conditions are met. And I think there's going to be a lot of people who are going to read that and say, what does that mean?
Well, thanks for having me. I appreciate it, and we're excited about what we announced. And yeah, we have a significant investment that we're making. It's in two tranches, as we mentioned, and the first tranche will be the next month here, and $15 billion, and the second tranche will come when certain milestones are met. And we're excited about the investment we're making. If you think about it, it's so early right now in the AI space, and OpenAI is off to an amazing start. They're going to be one of the very big winners, we believe, long term. I think we can help them quite a bit as part of this partnership. I think just having their offerings available in Bedrock, being able to leverage Trainium, which gives them 30 to 40% better price performance, matters a lot in AI. And I think it's going to be a very strong long-term partnership where we're going to also be happy about the investment. It'll yield a good return for Amazon over a long period of time.
So, Andy, one of the things that's interesting about this is OpenAI, it says, will consume 2 gigawatts of Trainium capacity through AWS infrastructure to support the demand for what's called stateful runtime, environment frontier, and other advanced workloads, some of which is going to be exclusive to Amazon. My question to you is twofold. One is, how long is that exclusivity period for? And two, how much revenue do you imagine you will ultimately get paid by OpenAI?
Well, there are multiple components of this. If you think about we've collaborated and invented together on a stateful runtime environment powered by OpenAI's GPT models that will be available in Bedrock. And if you think about if you're an AI application developer, you don't want to start from scratch every time you're actually using models, and so being able to access state, whether it's memory or identity, or being able to call tools or call out to compute, being able to do that in a stateful way where we're together training that stateful runtime environment on AWS's infrastructure. There's nothing else like that today. It's really the next generation of how AI developers are going to build their AI applications. And then, the training, today we now have the 2 largest AI labs who are both significantly betting on Trainium, which is exciting. And, and the relationship we're building is very unique and it's long term, and we'll have this partnership for a long time.
Sam, can you speak to that in terms of just what you think the business ultimately looks like with Amazon? Obviously, they just made a big $200 billion infrastructure investment. A lot of people had asked questions about it, and now this may very well be part of that answer.
Yeah, we continue to see just rapidly growing demand. The Codex in particular, I think it grew like 30-something% in the last week. And that is an indication of what's happening with enterprise and what people are ready to do now. As we started to look at the growth that is coming, we realized we did not have enough compute to support that. We're excited, thrilled to get this additional training capacity, and I think it'll go to great use with customers. We also think, as Andy was saying, that Amazon can deliver so much more to us in terms of new demand and new opportunities in the market, that there will be huge incremental revenue here into the whole ecosystem, and we're thrilled to get to do that.
One question which I imagine investors will ask, which relates to maybe the question I asked Andy about the conditions on the 50 billion. It sounds like it comes in tranches, Sam, 15 now, 35 later with some kind of condition. And I just wonder whether that is similar in terms of the terms for every other investor in this round. There's been lots of speculation that one of the things that every investor in these new rounds wants, of course, is an eventual IPO.
We are open to going public at the right time. There are advantages to being private. There are clear advantages to being public. In addition to all of the reasons that we get more access to capital, I also think that if these AI companies are as important as we think they may end up being, we want all investors to have access to them. So yes, there is definitely some excitement from various investors of ours to go public, and it is something that we are open to doing, but we need to figure out the right time to do it.
Sam, help me with this though, because you know that people oftentimes look at some of these transactions as what they call circular. They look and say, a vendor effectively is going to make an investment in your company, and on the other end, you are going to be making effectively an investment or buy services from that company. How do you think we should think about that?
I get where the concern comes from, but I don't think it matches my understanding of how this all works. This only makes sense if new revenue flows into the whole AI ecosystem. If people are not willing to pay for the services that we and others offer, if there's not new economic value being committed, then the whole thing doesn't work, and it would be circular. But revenue for us, for other companies in the industry, is growing extremely quickly, and that's how the whole thing works. Now, given the huge amounts of money that have to go into building out this infrastructure ahead of the revenue, there are various things where people, finance chips, invest in each other's companies and all of that. But that is like a financial engineering part of this, and the whole thing relies on us going off or other people going off and selling these products and services. So as long as the revenue keeps growing, which it looks like it is, I mean, demand is just a huge part of my day is figuring out how we're going to get more capacity and how we're allocating the capacity we have, then I don't think it looks circular, even though the need to finance this, given the huge amounts of money involved, does require a lot of parties to do deals together.
Andy, how do you think about that?
I see them as different. I think that OpenAI wouldn't use Trainium if it wasn't compelling for them. The fact being able to save 30 to 40% in price performance, that's a big deal when you do AI at the scale that OpenAI does. And I would also say that for us, the investment is because of what I said earlier, which is, this is the most significant transformation in technology, maybe business in our lifetimes. And we're incredibly, even though it's growing really quickly, we're incredibly early in this. And OpenAI is going to be one of the really big winners here. And I think we can help them be more successful, as I mentioned earlier. And we're going to like that investment over a long period of time.
Andy, you had announced earlier this year that you're going to be spending $200 billion. There were a lot of folks in the investment community that said, oh my goodness, that's a lot of money. And I suggested just now that maybe this was part of the answer. Did you have line of sight, if you will, that this was a deal like this was possible at that point?
Yes. Sam and I have been talking in our teams for a while, and that was very much in our projections at that time. And, as I said during the call, when we said we were going to spend about $200 billion in CapEx this year, we have very strong demand signals, very clear line of sight to those. This is a good example of that. Remember, the capital that we spend in 26 is for infrastructure that will be put in place, 18 to 24 months later. And so we have very high confidence that we're going to be able to monetize what we're spending, and we're going to like the economics a lot in that business.
And when you think about that investment, and maybe both of you can speak to this, do you think there's genuinely just a massive upfront cost, and at some point that the cost really does tail off, or from where you sit today, I mean, this is what I think some people are concerned about, is that it's just an exponential cost, that it's just going to be year after year after year, and there's not going to be a moment where the investment stops, if you will.
I'll start. The way the AWS business works in such a way where the faster we grow, the more capital we put out there, and because the model works, we're investing in capital in data centers, power, land, chips, hardware, networking gear. So all this infrastructure, 18 to 24 months in advance of when we can monetize it. And then we spend the money in the first year, but a lot of these assets that we're investing in are 30 to 40 year useful life assets, like a data center. And so what happens is you spend the money in year one, but then you actually monetize it over a long period of time, and you really like the return on invested capital over time. You saw that in the early days of AWS, as we were growing like crazy just on the CPU side, where we were investing a lot of capital, and the free cash flow looks different than it does once the growth rates start to level off. And so as the growth rates are really high, we'll spend more capital, but we like the operating income and the return on invested income over a long period of time, because those assets we can monetize over a long period of time.
Sam, how do you think about that? And both on the CapEx side for some of the folks providing these data centers, but also for your own business?
Yeah, I very much agree with what Andy said. The investment needs to happen early, but the revenue growth and the ability to monetize that investment looks like it will continue to be steep over a long period of time. And like Andy, the more we see revenue growing, the more we see demand growing, the more we want to invest to be able to serve that on this 18 to 24 month lead time. So the fraction of revenue that goes into training will come down, but the total amount of capital that goes into training, I expect that to continue to increase, but I expect what Andy said to really hold true. Now, as the industry matures, when Andy says 30 to 40% less expensive Trainium, that's a big deal. Everyone's very focused on how we're going to bring costs of delivering these services down. People joke in our industry about intelligence too cheap to meter, but we want to get as close to that dream as possible. And getting very capital efficient on delivering these services at huge scale is how we see this working.
And back to this exclusivity idea in terms of this statefulness effort. How long will this be with Amazon? Is it possible you're going to want to do this? I imagine other people are going to want to do this with you. I mean, this is sort of the next frontier of what agentic AI looks like, Sam.
Yeah, Andy can talk about timelines and stuff if he'd like to, but we want to have a long, deep relationship here. We've done this in the past. We and still have a long stateless API exclusivity with Microsoft. And there's a nice thing about aligning with a partner on a piece of technology. And this is a place where I think an approach where we're really going to go together and do this together will be great for both companies.
Andy, one of the things I imagine people are going to be asking this morning is you've had a long relationship with Anthropic and Claude, and you had an early investment with them. How does this change that dynamic, if it does at all?
We still have a very strong relationship with Anthropic. Remember, we have lots of customers who run Claude models in Bedrock. Anthropic has been early and very substantial customers and users of Trainium. They're training their next version of Claude as we speak on top of Trainium. And we have a significant investment in Anthropic as well. And they've always had multiple partners, and we do too. And so that relationship will stay strong. And we're really excited about the partnership we're building over a long period of time with OpenAI.
Hey, Sam, while I have you here, just because I know everybody's fascinated about it, it's sort of the story in the news this morning beyond this big news that you've just announced, which is this debate between the Pentagon and Anthropic about how to use these large language models and whether they can be used improperly and what kind of rules should be placed around them. What do you think?
Look, first of all, the government, the Pentagon needs AI models. They need AI partners. This is like clear, and I think Anthropic and others have said they understand that as well. I don't personally think the Pentagon should be threatening DPA against these companies, but I also think that companies that choose to work with the Pentagon, as long as it is going to comply with legal protections and the sort of the few red lines that the field that we have, I think we share with Anthropic, and that other companies also independently agree with. I think it is important to do that. I've been, for all the differences I have with Anthropic, I mostly trust them as a company, and I think they really do care about safety, and I've been happy that they've been supporting our warfighters. I'm not sure where this is going to go.
In terms of OpenAI and where you go, $730 billion, a huge valuation, and $110 billion provides you what runway in terms of when you think about the timing of what that capital gives you, and then to the extent that you may think you need more capital in the future?
I don't know the exact date, but it's a very long runway. I expect we will need more capital. I don't know what the form will be. It may not, there's like a lot of ways we could continue to finance growth. But this is like a long runway from now.
Related to that, and maybe Andy can speak to this, the other big story of the morning, which relates very much to AI, and I think we're all trying to understand it. Andy, you and I have talked about jobs for a long time in AI. Jack Dorsey just announced a plan that effectively cuts 40% of his staff because he believes that AI is going to allow him to be just as productive, if not more so. And I wonder what your reaction is to that, and what you think it portends for the rest of us, if you will.
Well, I haven't really digested that news very much, and I think every company is going to make their own decisions on these things. And my view of it is what we've talked about in the past, Andrew, which is just, I think that this is the most transformational technology shift that we've seen in our lifetime. I think it's going to impact the way we all do our work, and I do believe that a lot of the jobs that we've thrown human beings at the last 20 or 30 years, you won't need as many human beings doing those same jobs. But I also think there are going to be other jobs created, and that has always happened in every technology shift. And 15 years ago, there was no such thing as a cloud solutions architect, and today there are tens of thousands, maybe 100,000 plus of these types of jobs. So we will have lots of new jobs, and and there'll be some sort of transition, and we'll all work through it together.
Sam, before we let you go, one of the things that people have always talked about is AGI. You and I have talked about AGI for a long time. One of the deals that or terms you had in one of your earlier deals with Microsoft had to do with, what happens once you get to AGI. So I was going to ask you whether any of those terms exist either in this fundraising round, and sort of how far you think we are to that now.
I can't tell you the exact date that AGI arrives, and also, it's gotten to the point where people define it in different ways. The field is clearly making rapid progress, so I don't want to give a timeline, but if you look at what the current models are capable of, you hear people say, man, it feels like something I didn't expect to see this fast, or I didn't expect to see this in my lifetime. I expect continued steep progress from here. I think we are all going to be surprised about the amount of AI progress the field sees this year, probably every year after that. So I don't have a timeline to give you, but it does feel like we are making maybe faster progress than even I expected.
Does that change any of the deals, though? Are there these AGI term limits, if you will, in any of these transactions you're doing?
The Microsoft one has one, as you mentioned. But
going
even
forward
towards AGI, we'll have like a very strong, long relationship with Microsoft. We're not, given that we think it's like a nearer term thing now, we're not doing new deals that stop when AGI gets reached.
Fair enough. Sam and Andy, congratulations on the deal. It is a big one, a big tectonic shift in the AI business, and we appreciate you joining us first after the deal was.
We are delighted to get to work together. Thank you.
Great to see you both.
Looking forward to it. Thanks for having me.
You bet. Thanks.
All right, let's take a look at, no, just kidding. Make sure you join us Monday. We got to go. Squawk on the Street begins right now.
Good Friday. Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. We close out the month of February with some pre-market losses. Dow may not hang on to that 10th monthly win streak. A lot of drama today in AI, media, private credit, and inflation as January core PPI runs hot, but the 10-year falls below 4. Our roadmap begins with this last trading day of the month. S&P's on pace for the worst monthly performance since April of last year.
Plus OpenAI, you just heard, of course, Sam Altman, Andy Jassy. They close a $110 billion funding round. It includes Amazon, of course, NVIDIA, and SoftBank, as we've been reporting. OpenAI's Sam Altman and Amazon's Andy Jassy just finished speaking with CNBC a few moments ago about that partnership. And Paramount Skydance is the winner for the battle over Warner Brothers Discovery. Netflix bowing out. We'll have all the details on what to expect from here.
Let's begin with market reaction. First to the hot PPI number, Jim. Core PPI 3.6, that's going to be the biggest gain in almost a year.
Yeah, look, it's disappointing, but I do look to the bonds. The bonds are the ultimate arbiter, and they're dismissing that number. We're saying that we're in a rockier time. I'm going to go with dismissing that number. I don't believe that core inflation will be as bad 6 months from now. That number's bad. That number's bad. And you could say, well, listen, Jim, you've fallen prey to the president and to Kevin Marsh. I just see in individual aspects of CPI, where I think we get hit hard, things are getting better. Things getting better in rent. We've seen natural gas come down. Almost all the foods that I follow have come down.
I mean, oil today above 67. It's going to take you back to August. We're probably going to get a 3 handle on retail gas next week.
Well, look, oil, I still believe, and I know that this is something that a cynic would say, are you crazy, that there is a lot of oil in the world, and that this is because of the Iranian tension, and that's why I'm betting that all of it will go back. Look, I am a creature of the 10-year. And when the 10-year goes our way, and that means when it goes under these levels, I think there's so many things that are great that can develop that gives Warsh the opportunity to cut the short end. I like it. David, I've got to tell you, if you had told me 2 months ago that OpenAI would get this money, I would say yes, hallelujah. They're not going to be the Achilles heel.
Right.
If you told me there were going to be giant deals like this Paramount, I would say, holy cow, M&A's back. Instead, we have the market down huge. What is wrong here?
Well, I mean, there's so many different things coming at us this morning, I think, trying to sort of make sense of them all. It's not that easy.
You're supposed to say, oh, it's all bad.
No, I mean, that 10-year, by the way, what is that reflective of? Is that good or bad? I mean, are there credit issues starting to happen? Is there a flight to quality in some way happening?
Well, when you see this on the PPI, you could say that there is flight to quality. I come back and say it's an awful hard market.
There's this underlying theme I keep hearing, or worry, not theme, worry about credit. It's very hard to grasp because there's a little BDC here that, well, it didn't go as well, and there's one over here, and there's one here, but is it really a sign of anything significant? And by the way, none of it seems to have to do with software companies unable to pay back loans. Then you've got the block news, guys, from last night, which
right, well, that's the definitive.
Everybody, of course, talking about that.
No one talking about how poorly the company's been run. No one's talking about the fact that it's bloated.
Right.
Instead, they're just saying, wow, this is it. It's the beginning.
Well, except for Jack, who is literally responding to comments on X about how they did overhire after COVID.
Right. Well, I mean, they should also. One of the things he always says is, let's get some revenue growth too. But yeah, I mean, there's one of those things we can say, okay, it's finally happening. You don't need Salesforce. You don't need Workday. We're back in that world.
We're back with that.
We're in Monday.
And by the way, we're back. We should point out, yesterday was a very tough day for hedge funds. Nobody cries for hedge funds, but because so many of the stocks they were short, which includes so many of the software companies, rocked higher. You had the semis turn around the other way. So now we're dealing with the return to theme, which is software is going to be disintermediated. And by the way, nobody's going to have a job. Your point is an important one, I think, Jim, and many people have been echoing it in that Jack Dorsey typically ran bloated companies.
Right.
Twitter being an example where Elon Musk came in, whether you like it or not, and cut 75% of the workforce. But, people have pointed me to market cap versus employees at Robinhood or Coinbase, where the market cap versus employees is so far higher than at Block.
So his Eureka moment was what?
Well,
Right, is it that we can just work it, that you hire somebody and the code writes the code so we don't need the people?
I do think, you know what, I noted two things in Dorsey's letter and then in the Spotify co-CEO as well from their call. And we actually made them up because they both point to the same thing happening in December. And that's what this market has been dealing with. Jack Dorsey, I believe we were one of the first. We were the first agentic, coming out. Wait, sorry, this is the Spotify CEO. A lot of things happened in December. Coming out with Claude, we crossed the threshold where things just started working. A lot's actually changed very recently. When I speak to my most senior engineers, the best developers, they actually say they haven't written a single line of code since December. Now you have Dorsey saying, I believe we were one of the first. We were the first to the agentic harness out in the market. Something happened in December of last year, just last year, where the models got an order of magnitude more capable and more intelligent, and it's really shown a path forward in terms of what we're able to do. And that's where we are right now,
Yes,
guys.
that's where we are. Look, it's very positive. It's positive. You could say, wait a second, it's not good for white collar. I can tell you there's plenty of white collar jobs out there. What I think it's really big for is this is the fourth industrial revolution that Jensen Wong talked about. Ironic that Jensen stock is the worst acting, and I think that is something that could turn.
You do. Because this reported the information about Google striking a deal with Meta. We had Lisa Su on this week. Meta AMD. None of those conversations are having much to do with NVIDIA.
Meta would buy anything it can get. From my sources, there's nothing that Meta wouldn't buy, and that they're not getting as many. They can't get all the NVIDIA they want. As we talked to CoreWeave, we'll know that. I think that also Amazon's got its chip that it loves so much, and people would say, well, wait a second, OpenAI is not going to use NVIDIA. Are you kidding me? NVIDIA is sharpening rivalry. NVIDIA has everyone on allocation. It does not have enough chips. So, don't cry for me, NVIDIA. Buy NVIDIA. Don't cry. Buy.
I mean, Jim, we went into the print at 195 or so.
I mean, the narrative follows the trade. I've always seen that. If the trade comes down, we suddenly look for things that are bad for NVIDIA. Is this the day to buy NVIDIA? Look, NVIDIA is for sale. We know that. We know that I'm sure Salesforce gives up everything that it had yesterday because it's software.
Yes.
I think that if we want to go buy XYZ, we have to have a reason beyond firing people.
We do, I would assume.
Right.
Yeah.
I mean, they did. And by the way, Block did raise their gross profit forecast for the year to 18%.
I like.
growth.
I want more growth. They really haven't grown the way I want.
I mean, that kind of a response in the stock market is certainly going to be noticed by many CEOs who are saying, oh, look, I'm going to get rewarded by cutting jobs and replacing them with AI. Whether or not Block was bloated, as seems perhaps was the case.
But look, we can shoot everything. We can do what we did on Monday. We felt ridiculous after Monday. I think a lot of people felt.
I didn't feel ridiculous. Did you? Why did you? Why did you feel?
No, it felt fine.
Yeah, it felt good.
I respect Michael Sembler's work more than I respect the work of the
Citridi research.
Well, just saying, look, we need
whatever
people.
That was.
We need people. If you go into one of the things that people were talking about in that piece, well, real estate, we don't need people anymore. And Michael said, look, real estate has been a function of the computer for a long time. It's just that you need to sell. You need people. People weren't friction in his note. People were valuable. In the Monday tsunami piece,
I hear it.
People were viewed as
They did say that.
And I don't think people are friction. And I think when you say that people are friction, you're doing something that I've always heard mayors do.
To read the Greg piece today in the Wall Street Journal, Carl, because it was a positive light, and I always like Greg on saying everybody's worried about this, and it never has happened, and citing a lot of reasons why perhaps.
We're going to talk to Drew Mattis later today. Similar thesis that this is not going to be an apocalypse of employment.
Look, think about it. When the computer beat the mainframe, everyone thought it was over, and then look, I can get tired of showing it, but I mean, you got this device. And this device has produced millions upon millions of jobs. And I'm with Jensen. He didn't talk much about the Industrial Revolution, but I do think that this will all turn out positive. I think it's positive for Amazon. No one seems to think that Jassy is a winner today.
Let's get to the big news involving OpenAI, the maker, of course, of important AI models, doing this deal with Amazon this morning. Maker ChatGPT raising $110 billion in new funding, valuing at $730. Round includes investments from SoftBank, NVIDIA, Amazon. which is deepening its relationship with the AI giant through this multi-year strategic partnership. Amazon will invest $50 billion in OpenAI, starting with an initial 15, followed by another $35 billion in the coming months when certain conditions are met. I think some of those involve an IPO. Andy Jassy, Sam Altman joined Squawk a few moments ago. Here's what Altman said about the demand for compute.
We continue to see just rapidly growing demand. The Codex in particular, I think it grew like 30-something% in the last week. And that is an indication of what's happening with enterprise and what people are ready to do now. As we started to look at the growth that is coming, we realized we did not have enough compute to support that. We're excited, thrilled to get this additional Trainium capacity, and I think it'll go to great use with customers.
They're going to run a couple gigawatts on Trainium.
Yes, they are. And look, Trainium's got supply. Google has supply. NVIDIA, maybe not as much supply as you think because they're giving it to everybody. I mean, that NVIDIA call, by the way, was not just about the hyperscalers. Matter of fact, the hyperscalers, while important, weren't as important as some of the other new users. And David, let's go back to that moment where we were saying, oh, come on, how can OpenAI really, with the lawsuit, the Musk lawsuit,
which is still coming, by the way,
right, with the erratic behavior, some people thought, I think that you might have thought it was somewhat erratic, and then next thing you know, they get the money and we're negative.
Yeah.
We're negative today? Yeah, you know, these are things that I prayed for. I was so afraid that the OpenAI would not get the money, and I would be here saying, you know what, this is just going to be a nuclear winner. No, we didn't get a nuclear winner. Maybe nuclear power, but nuclear winner, no. And everyone's viewing everything as negative. I'm listening to Jassy. I'm saying, yes, Amazon. This is the great. Amazon down $1.50. People are misinterpreting these things because they're forgetting what life was like when Anthropic got the big. You know, they got the big money.
Well, they're both getting the big money.
Wait, but there is CoreWeave's getting the big money.
We'll have CoreWeave on.
Who's not? Okay, let me ask you, who's not getting the big money?
I don't know, Jim. Who's not getting the big money?
Well, getting big money used to be very positive.
And
not today.
We'll get to Dell eventually, maybe.
Yeah, Dell is going to be up today. There's a big move today.
It's just a buyback.
But
just kidding.
Stepping back for a minute, just to talk about OpenAI, this $110 billion raise is now obviously it is from name brand companies. It's SoftBank, it's NVIDIA, it's Amazon. Has been reported for quite some time. It's not clear exactly what some of those things that have to be met along the way for them to have all the money are. But $110 billion in a private fundraising round. I mean, think about when SpaceX, which is, you know, going to go public at some point, probably early summer, we'll see. When it comes public, they're talking about raising $50 billion. Just to put that in perspective. By the way, that would be one of the biggest IPOs of all time, if not the biggest raise. And yet you're talking about $110 billion raised privately. When OpenAI does go public, my guess is they'll probably raise less than they raised just now.
This is great for the economy. It's great for the economy. It's not zero sum. You've got these companies and they'll be creating new jobs after new jobs and new companies after new companies.
Wait, OpenAI is helping create new jobs? I mean, maybe for OpenAI, but they're going to, aren't they creating this software along with Anthropic that's going to actually replace jobs?
It's removing jobs.
Yeah. No, you will be able to start. Okay, I know a company just started on OpenAI. And got five. I'm going to be small. Okay, starts $5 million and you better valuation of 50. And I just see that that's typical.
You know, you just mentioned the Citrini report, which is all about companies doubling down on investment and firing workers, and that's exactly what our A block's been all about.
Well, no. I think I am saying that we will regret that view. That we are going to be
happening like today.
But we're in a new industrial revolution, and we're not in the part where you're winning yet. You're in the part where you're spending.
Can we get to the part where we're winning?
When you talk to InTrader, and InTrader will say we're winning now, he's wrong.
Or when we know that, there won't be a 15% unemployment rate and even higher amongst white-collar workers. Can we get to that point where we know the answer?
So let's just double down on the bug you with.
I don't know.
Double down on the bug you with.
You want it both ways.
Wells Fargo, bring back the stagecoach.
You want it both ways. You're like, spending all that, and it's all going to be great. You want it both ways. Right? You believe it will be both ways. Do you want to punch me in the face?
Yes! I'm going to give you a Hawaiian punch. Yes, because you're not seeing the upside. We are going to have an optimist who's going to come on in a moment. and he's going to tell us about all the jobs that will be created once he's done his build out, which is unfortunately in like 2050.
The whole, the person who sells the shovel says there's gold in them hills.
By the way, guys, I did on the OpenAI thing. I mean, again, we got a joint statement from OpenAI and Microsoft, of course, in which they talk about having worked together since 2019, and the partnership remains strong. You know, NVIDIA here, it is $30 billion. Again, I'd like to understand, you know, there are certain things in terms of delivery of GPUs that have to do with when they deliver the money. But I guess, Jim, to your point, that money's going to go out towards compute from OpenAI, which does kind of get us towards our next guest.
I am not going to be pessimistic when the 10-year's going down in yield. I'm not going to be pessimistic when OpenAI, which at one point I thought couldn't get the money, got the money. Not going to be negative when I see what Dell did, and I'm not going to be negative because how much business does CoreWeave have, Mr. Michael Trader? How much? In terms of he is his founder and all that stuff.
Oh, welcome to Post 9, by the way. Thank you for being here.
I got a little caught up. Got a little caught up there.
All right.
All right. How much business do you have versus how much more could you? Orders versus what you can do.
Okay, so I've come on the show. I've kind of been in the press a lot. The demand for the infrastructure has been relentless. It's been relentless for 3 years. We have never wavered from that position. Our clients are increasing the demand signals that they're giving us. They are broadening across the economy. They're moving from, you know, just the AI labs and the clouds into the enterprise, into the sovereigns. You know, the business signals are overwhelming. We are constrained by our ability to deliver more capacity to the market.
Okay, so listen, that's a possible story. Only one of the analysts thought it was bad. Every other analyst congratulated you. The stock is down very badly. You were in the business of trading. What's wrong with the stock, or what's wrong with your narrative?
Look, you know, end of the day, my job here is to drive value and take advantage of this generational opportunity to build infrastructure in a global build out of compute. And we are doing an unbelievable job of that. We are scaling into this. We made an intentional decision to accelerate our builds, understanding that there was going to be a margin hit. But this is a once in a generation moment. And our job is to go out and to secure as much capacity as we can so we can satisfy the demands of our clients to deliver compute.
Okay, is there, I'm going to give it to my colleagues, but is there some level where you're saying, you know what, we're done with losing money. Let's stop losing money. Losing money's bad. I mean, I know that you've been able to sell a lot of stock. Congratulations, you made a lot of money. It's very positive. But how about the fact that, like, the shareholders? At what point do you just say, you know what, guys, we will reap what we've sowed?
Look, the way that this business works is you make an investment today and you sell compute for 5 years. So every dollar that we're putting to work today is ensuring that we are going to earn dollars over the next 5 years. So we like the return profile on the investment. We talked about this yesterday on earnings that, you know, a stabilized data center is going to throw off a margin in the mid-20s. That is a very, very healthy return for us. It gives us the scale to be able to build and monetize across our platform. I was on with NVIDIA, with Jensen last month, where I talked about the fact that because they are adopting our reference architecture, it's going to give us the ability to generate returns off of other people's GPUs. They get to build the infrastructure, and we get to bring the software layer, which we are so good at, to be able to expand our TAM, expand our addressable market so that we can generate returns from folks that want to control the physical infrastructure themselves. We think it's an incredible opportunity. We think it's a high margin business that will be additive to the basic business that we have built so far. Our business is success-based. The stock is going to move where the stock is going to move. I understand the concerns that people have as they see us allocating a massive scale of money to this market, but the truth of the matter is Our backlog is enormous. We are going to be delivering compute to the most important, to the largest companies in the world. We're going to be delivering compute to the broadest component of the economy. We're doing our job. This is what we're supposed to be doing.
Michael, you know, you are relying to a certain extent, though, on financing, obviously, to run your business at this point. And there are some concerns, recent concerns, let's call it, broadly speaking, about the credit markets. We'll see what happens. But are you concerned at all that your cost of capital may have to rise as a result, perhaps, of a lack of liquidity out there and things of that nature?
So that narrative is out there, but the data does not support it in any way, shape, or form. Our cost of capital over the last 12 months has come down 300 basis points. When you take 300 basis points and you calculate it across the debt load that we're carrying, that's an additional $700 million of savings for our company. It's come down 600 basis points over the past 2 years. When we went out into the market in December with a convertible note, we were 8x oversubscribed. The demand for our paper is relentless. When we use the delayed draw facility level financing, which is basically where we take the box that I talked about and we take the contract and the GPUs and all of the assets and push them down, there are in excess of 200 different financing counterparties that want to participate in funding us. The depth of the market on the capital front for our paper is enormous. It's something we have cultivated from the start. We understood that you needed a broad universe of different counterparties to ensure that you had access to the capital to continue to grow and cultivate the business the way that we have. We believe that there is an enormous amount of capital out there for our business, and we believe that our cost of capital will continue to come down with amazing implications for our business.
Have you seen any of this polling data? There was a report out this week from this firm Echelon that said a plurality of voters would oppose a data center being built in their community. Is that a common view?
So, look, we've talked about this a lot, right? It is imperative for all of the participants, all of the stakeholders in artificial intelligence to be very cognizant of the impact that the bills that they're doing and the jobs impact are included in the way that they think about and address this. We have spent an enormous amount of time and energy within our company ensuring that we are working with the local communities where these data centers are going, making sure that there are job programs in there, making sure that we are working through the concerns, and most importantly, making sure that we are paying our fair share so that we do not inadvertently impact the cost of power within those communities. It is something that's been a huge priority for us.
Right, you did Bitcoin, you know, the stock market. There'll be people who say, all this sounds like 1999 with the fiber build out. All of it sounds like the circular, you get money, you get money. Could you please put a fork in that theory?
Look, the way that we have built our business is on success. We go out, we sell a contract to Microsoft, to Meta, to OpenAI, to the strongest companies in the space. Once we have executed that contract, we go out and we purchase the infrastructure, build it, and deliver it for the next 5 or 6 years. That business is not build it and it will come. The fiber business was lay the fiber and loads will get there. We are doing it exactly in the opposite direction. We are securing the demand from creditworthy counterparties, and then we are delivering it to them over 5 years. It is why we have the confidence to invest, and it's why our lenders have the confidence to invest in us at ever cheaper rates.
Finally, Michael, I'm just curious. OpenAI raises $110 billion privately, obviously with big names. When you hear that, what goes through your head?
Look, OpenAI is one of the most amazing companies that has ever existed. They are going to change the landscape of the world. That's one vector. The other vector is, wow, the credit quality of my backlog just got stronger, and I'm really excited about that too.
Well, look, we want to thank Michael Educator. You're always on. It's terrific. Again, the analysts, largely positive. I don't want people to think that it was bad because the stock is down. As you told me last night, the narrative is following the trade. Thank you so much for coming on.
Thank you, guys.
Thanks, Michael. Talk to you soon. All right, still to come, we're going to break down the latest, of course, when it comes to the end of the battle for Warner Brothers Discovery. Netflix bows out. You can see that stock is going to be up sharply. Let's give you another look, though, at the broader market here as we get set to begin trading for the final day of the week. About 4.5 minutes from now, we are looking for a sharply lower open. We're squawking the street in a minute. Busy day here, of course, as we finish up the week of trading. We're looking for a sharply down open. Let's get to a quick mad dash.
What happens if you blow the numbers away? What happens if you have the costs under control? What happens if you're taking big share? You get Dell's quarter. This was a monumental quarter for Dell. A lot of people, including I saw a double downgrade on Morgan Stanley not that long ago, worried about, what are they worried about? The cost of memory. Stop it. Memory did not play a role. They've got really good relationships with the memory producers, and I really feel that this was a quarter that distinguishes Dell as the winner in this space.
You do, winner.
Yes, and remember HP used to be very, very competitive.
I know, well that implies that they are not the winner.
Yeah, they're not, no, and it really matters a great deal. You know, David, when people talk about a company like Dell, they say, yeah, but how are they going to get from Micron? What do they get from SK Hynix? Do they have enough from Samsung? They can't meet demand. These guys met the demand perfectly. And I think it's really important because the bears were so out waiting for some of this, and the buyback is gigantic. Gigantic buyback. So let's keep in mind, not everything was negative from last night. Dell was just incredible. Now, Morgan Stanley said we simply don't believe hardware vendors can raise prices
Let's get the opening bell on the CBC Real-Time Exchange. And the big board today, it's the 13th annual Connor Group IPO Summit.
I'm here.
The NASDAQ biotech company.
Oh, God, it's over
Generate
8:30?
Biomedicines, Jim, as we're back to that old 68.50.
Well, it is going to be a struggle today because people want to buy stocks, they see bonds. What
You see my support
they're
line,
doing.
head and shoulders.
Then when you look at the makeup of the stocks, what's really working, again, it's commodity stocks. And they've got David's worries in their head. I saw yesterday the Harvey Schwartz interview with Leslie Picker. It was a meaningful interview.
Okay.
And I felt...
Harvey Schwartz is the CEO of Carlyle.
Carlyle.
Yes.
Heavyweight.
In all ways, yes.
Yeah. And, you know, look, and then I see that there's a little fund by Apollo that
Come on
that's
now.
not doing well, or I see the...
That's right.
Right.
KKR yesterday, an Apollo
KKR.
fund that had it was like a 3%.
Can we go down anymore?
So that's an
And
Achilles
then,
heel.
yeah, and there are people looking for these to try and, frankly, scare people. But there's also a belief.
Wait a second. That's exactly what I said last night. Did you watch my show?
No.
You watch my show as much as my mother
There's some
does.
BlackRock action in there. There was the Blue Owl conference call this week. High yield spreads are up almost 300
Look,
bits.
I'm not going away. Look, I followed that Blue Owl when Mr. Packer spoke with us, and I've tried to get... And I've come back and said there's just a lot of people who want to scare people about it. The fundamental thing that I am concerned about is that NVIDIA did have a great quarter, and the stock is going the wrong way. And that does matter.
You see what I see?
I'm not a business.
Say yes.
A fulcrum of the
We'll all get along just
Everyone
fine.
wants to buy other chips because they think that NVIDIA's too expensive, but NVIDIA's sold out anyway.
Before we get back to NVIDIA, just staying on Blue
Oh,
Owl.
shit,
and
double bottom, baby.
Point out the alternative asset managers down again. It has been a horrible year to own those stocks. Blackstone down 26%, Apollo down 25%, KKR down 30%, Blue Owl down 28%, and on from there, Ares down 30%. Just not pretty, Carl.
It is pretty.
Continues, and again,
Beautiful.
whether it's overblown, this fear, or not,
It's
is
overblown.
something that people are talking about, and it's got me, as many others, at least focused on these various scenarios and just keeping an eye on things. You heard Educator, though, say, I mean, talk about a company that's relying on an enormous amount of access to financing. That's the kinds of things that are important here. He says, listen,
I'm not scared.
It's only gone one way down.
Right. Financials are the worst performing sector of the year. 4-week outflows, Jim.
I'm not scared.
Last week, biggest since April.
Right, and we did have, you go back to the nuclear winter piece we saw Monday, they were talking about in the end credit dries up and that really hurts the banks. I'm not buying that either, but
I ain't either.
You gotta let it run its course. They're doing the CoreWeave call.
What are you
Everyone's very
buying?
excited about all the money that CoreWeave is spending. And so if you were a regular non-CoreWeave fan, might say, I'm upset
Brandy.
that they are spending.
Do you think it's crowding out other good investment in America?
I think this is the best investment we've ever had.
So it's the best thing we've got.
And the telephone rings.
Look, I mean, somebody asked me the other day, Jim, how can you be so positive about it? And I say, okay.
Always clean. This is James. May I help you?
I know that there's this smartest guy in the room thing.
Smartest
These
guy in the
are
room.
people
It's
who are
true.
Really good business people.
I
When
am.
I want to go against them, I better have some. Even when, now,
I am the smartest guy in the room.
It's not in that echelon. But even if you try to pick apart the deal that they did to be able to provide some liquidity to one of their funds, it actually, if it's what they said, it's okay.
Yeah.
But you did say earlier in the week you're not buying this PAR stuff, in your words.
Well, I mean, I think if you pick certain loans,
Yes.
you can get more. And again, we asked whether they cherry picked, which is different from picking. Look, I spent a lot of time. Look, the Bears will over me saying, "Listen, Blue Owl's the Achilles heel." I think the Achilles heel. I thought the whole was OpenAI. I thought OpenAI was like the biggest sucking chest wound in history.
Yeah, well,
I mean,
so,
people.
by the way, yeah, that, in part because you were saying that. It was only 6 weeks ago. You were literally sitting here going, OpenAI.
Well, yes, because they didn't have the Okay?
Okay.
Hey, you know what? Hey, you know what? Anthropic so got the money that they thumbed their nose at the...
That's another important story. We've got a lot of stories this morning to cover. Dario Modet talking about their discussions with the Department of War and basically saying, Carl, we're not going to comply with what they want in terms of tools that could lead to autonomous weapons and
mass surveillance.
Thank you.
Yes.
Mass surveillance.
By the way, have you seen the comments from the Undersecretary of War, Emil Michael, calling Dario a liar, saying he thinks he's a god? Although there's fresh comments today, I think he was on another network, where he said that we'll see what happens today. The U.S. did make some concessions, and they will be having some conversations.
In part, it does go to the importance that Anthropic already has in the Pentagon and in various weapons programs, I guess.
Here's your poll back.
With some of the,
Prepare ye in the name of the Lord.
And what do you
From Washboardjim.
They've been approved in ways that others have not at this point. But you'd have to imagine if they were to.
The crowd's going wild here at the sports arena. We've got our third crow right now for the pullback. This is what we've been waiting for. Yes. Who's that guy? He's watching real close. We have the higher lows. Inside candle for a hard money. Boom! The 27th. The 686s. Right about now. She was getting ready to get a shot. There it is. I think this is the perfect spot right here. The 686s at $1.08. Please. Okay. He's trying his best here. Oh. Uh-oh. It's already done its thing. God, I wanted it bad. I'd have been in and out of that one. He's watching real close. Okay, we're coming back down to Papa. You tried. Yes. Streak 686.00. Missed that one. Do I see a continuation coming? Well, of course. Can we get it at a better price? Yes, right here. Okay. Prepare ye in the name of the Lord. There's 108. Nope. The market makers are trying. Yep, there it is. Thank you very much. Thank you very much. Cook 2 pound halai. It's at 102 right now. Crowd's going wild here at the sports arena. Can he get away with it? Can he get away with it? Can he get away with it? No. Oh, God. No. We have opened the doors up to maybe a megaphone pattern. Or we still hold the quad bottom. And there's my other support. Back at 97. AMD down 402, Tesla down $5, and Nvidia down to 180.57. AVGO down to 314. That's getting close. blanket. Here we go. Bam. You're at the 63 EMA, folks. At the 63 EMA. Shake it off. Jim, we were worried about you. And I had to call up my Aunt Esther. And Esther, we thought Jim was stuck in that trade. Damn, if he didn't pull it off again. I don't know how he do it.
Jim Bob.
He should have added on. Uh-oh. Uh-oh. Thank you very much. I did it, man.
Dude, XLF is getting wrecked. Oh my God, those PPI numbers freaking. Ugh.
Who's this?
XLF is getting wrecked.
Oh.
Rates are getting wrecked. XLF is a straight knife. It's like MA said this morning, with those numbers that came out this morning, rate cuts are off the table probably.
Oh.
So the bank's dumping is not a surprise to me. Thinking about taking some longer dated, like 30 to 45 day XLF calls.
IWM. Watch IWM. Tuesday low. Or Monday. And Friday. Tuesday. IWM. I don't know how he does it, but he's doing it. There it is.
Don't mind me, I'm just trying to figure out where the bottom of this son is.
The guy yesterday said we couldn't find the bottom. I think you're full of shit. I can do it.
XLF has a foot wall at 51 even, but the hourly can go to 50, 25. I'm gonna set an alert at 56. I'll buy me some March 20th. 51 and a half, no, 52 calls. Yeah, that's the plan. you see where they went over the 13 Fs for all these big hedge funds, and they were dumping Mag 7 and getting into things like airlines?
Nope.
A lot of them friggin' went into AAL.
Well, I heard airlines was going to be good this year.
I mean, they agree. They moved, their 13 F filing showed a ton of money flowing into airlines.
Getting ready to trade SPY again.
I ain't done anything today but
This will be my third one.
down stocks.
The 686 is at 98.94. Oh, there it goes back down.
Yeah, it's staying under that 5-minute cloud.
Oak.
Not breaking my rule today.
He's not going to do it.
Refuse. Beat myself up all night.
Oh, he did?
Oh yeah. Had a bad day yesterday, man. It wasn't a large amount of money. It was only like $2 grand, but still, it was my mental state that it affected more than anything.
Well, we've had a surveillance of support level for the last 6 minutes. Right here. Needs to do something. Meta hit support. Nvidia has a new low. We'll bounce on Apple. I'm in the SPY. I think I'm going to go have something to eat soon. We're watching AMD. We're also watching IWM here. It's held support at the 260.29 level. 260.29.
Hourly support on that.
Uh-oh.
Hourly support is going to be
Just dropped.
around 258.50.
Oh.
It'll be a triple bottom on the hourly, actually.
Oh. It's not supposed to do that.
That 260 does have to put support though.
working for this.
One minute till rollover.
There we go. Give it to my reversal. Jimmy was worried for a second. $113.
I'm in the IWM 261s at 80.
Oh, beautiful. Look at that. Left shoulder, right shoulder, right shoulder. $94 to $106. Which I think we're going to break out more. Right now you're flirting with resistance. Time for an apple cider. I'll be right back. Woo! Thank you much. To the 200. You're in the toilet. Some of the best trades come off the toilet seat. Ladies and gentlemen, just as saw Washboardjim take this off the right shoulder. The second time I gave an exclusive lesson about the inverse head and shoulders. We got the left shoulder, left shoulder, left shoulder, left shoulder, right shoulder, right shoulder. Boom! to the 200 out of the trade. 3 white soldiers. That's how you do it. Now I'm going to go, and I'll be right back. We'll see if there's any cleavage on here. That was on the 1 minute time frame. Now it's getting ready again. Pay attention. Children, get at your battle stations. Young adults and transsexuals, gather at your battle stations. Anybody that's new to listening to the room, this is a gay-friendly room. Ain't that right, Randy? Nancy, did you put a volume in that last coffee, baby? Because it looks like it wants to break out.
All right, I'm out.
Oh, oh shit. Good exit idea. Right now you're at the 200 here. Oh.
Yeah, I had 10 contracts. I wasn't going to hold very long.
Oh.
And of course now it's 120. Of course.
Yeah, on 131. The 686s. Randy's still in them. Jimmy. Since this has become gay friendly, Randy's got more balls than all of us.
Balls. He said balls. Everything looks like it found the bottom temporarily.
YouTube's going, what? I need to tell my boyfriend Clarence.
I need $1 more on that XLF so I can buy those calls.
YouTube's going, what? It's trying to break. Oh my gosh. It's going. Nothing holding it back now.
Britain pulled its staff from Iran due to the security situation.
Uh-oh. They don't sound good.
Damn, lunch lady. You tried to shorten the video after it already lost $30? You got balls. Nope. Randy ain't got the biggest balls.
$1.40, $1.50. Jimmy says nothing to hold it back. But maybe this resistance right here, maybe. I'll be right back. Thank you very much. I don't see no cleavage. Oak. Huh. Oh. Pull back. This is our pull back here. Let's see if the market wants to behave. We want you at 117. Oh yeah. I got it. Oh yeah, 3 black crows and oh no. I want to behave. Behave. Oh. Okay. Problem here on the west corridor. You're looking for the market to behave. Oh. More. You got the VWAP. We can do it. May there be peace in the valley for me. Get my tea. Oh, 63. Trump's America is losing the crown. A new market order is rising. I don't know about that. Let's go. Blanket. See, dummy didn't add any. I'd be out by now. 112. Our ticket. 117. Uh-oh. He's at 117. So we pulled right back above where my first entry was. Keep going. Does anybody see the shoulder line? Like to Jim. It's right around 685. And the SPX is trying to flirt with yesterday's support, which now becomes resistance.
Did you see what happened to Mara
No, I did not.
after earnings last night?
No.
Oh my God.
The way you talk about it, I have to look it up. Oh, yep. Financial results. The company announced collaboration with Starwood Capital Group.
Yep.
Oh. Target is $11.
It was that announcement.
Yep. Better show this to Vegas. Oh man, that hits the spot. IWM's at the 63 on the 1 minute, trying to break it. It broke it before. This is the second time. After the break, I think you'll come up to a triple top. Just under 262.
Yeah, so I got hit up pretty good today.
Uh-oh. Can't have that.
I sold some 15 cash secured puts on it.
I'm debating on getting out of SPY here, but we got kind of a, oh, there we go. I mean, just another 10 cents. If you're in this trade with Bobo, you're approaching a head and shoulders, which could be now. Oh, what's that mean, Jimmy? Secure your profits. Because I am.
Another one that got beat up if y'all are looking for like some CSPs or some YOLOs or whatever. So Rich Tech Robotics, RR. They're down 6%.
were yakking about CRWV this morning. Down $20.
Or we after earnings last night.
Yeah. Well, from yesterday morning.
But they had earnings last night, too, though.
Price target been raised to 125 by D.A. Davison. Cantor Fitzgerald reiterates overweight, maintains a 131 price target. What do you think about that? Citizens reiterates market outperform on CoreWeave, maintains a 180 price target. Evercore 150. Well, these guys, I'll tell you if this thing's oversold or what. It won't take very long. Not really. It's not oversold. This could be a good scalper, day trade.
Tell you what, dude, freaking Bitcoin does not look impressive on the 4 hour.
Oh.
It's back under the cloud. You can go back down to 60. All the clouds are bear stacked.
I'm going to show these boys how to trade. Who wants to be first in line?
I needed that yesterday.
Oh. Randy, you want to be first in line? Might be painful. Uh-oh, I just saw something. Definitely Head and Shoulders has been the theme. No, it could go lower, a little bit lower on core weave to go long. Everybody's upgrading it, so I think people are buying into it. So Washboardjim will be setting an alert right at 76.21.
Damn, Apple's getting beat up. It ain't bouncing like the rest of the market.
There it is. I'm ready now. Oh, it says right here, Sneaky Snake trading strategy has a price target to 115 and maintains outperformed, reiterates outperformed on CoreWeave with an idea of entry right around $76.21. You see that down there in the headlines? Say yes, Randy. Yep.
Damn, they ain't done beating up XLF. That 30-minute wick is ridiculous.
Uh-oh. I see something going to happen here real soon. On the SPX. We got a yin-yang going on with the head and shoulders. Trying to break the 63. And that's all on the 1 minute. Now I'm going to go to the cloud. Cloud. If I can find it. You're going to go straight to the SPY. Right now he's going to first look at the 1 minute. Uh-oh. Okay. Then he's going to look at the 5 minute. We're way oversold. This could be it. This could be it, folks. Pay real close attention. The 686s. Oh, I should think about tomorrow. I got time for one more trade. Maybe. And he's flipping over to the next day. He's made a business decision, which is, we all know what day that is. It's on the 2nd of March. The 690 strike. These are the calls at a dollar. Ooh, turn your head for a second. They're at $1.04. Sure you. No, I'm really upset. Right there could have been $100. Now I'm going into the next day. Do you understand? Yes, Jim, I'm scared of you. Oh, gosh. $6.90s. Let's try his best. You can do it. Oh, that's not where I want that. So the 5 minute doesn't want to break the 50. It's had more hits on the 50. It broke it once. These are the 690s. Let's redo this. March 2nd. Strike is $6.90. $690. And I'm not in them right now. should be, but I'm not. We're waiting for a pullback of some sort. So how do I do that? Well, I go to the 1 minute. Let's go ahead and copy this here. So when I get on the 1 minute, I'll find a better entry. Well, on the 5 minute, we got to put this price line in here. Right there. And yesterday we made the alert line pink for Pride Day and Retail Traders Room, and we'll continue that today. But this will be a solid. See, I don't think it's going to let me do it. Again, the gay line has been shut out. Must now notice that triple top break. Did I just see what I saw? Or am I seeing something else? I just saw what I saw. So them things went from $1 all the way to 130. I'm on the tweezer bottom on the gay line bounce. The pink line at 684.12. Very interesting, ain't that? Just for that, I'll take another sip of my apple cider. Oh my gosh. That was real good. Look at that. Back to the 100. We got the 100 EMA, 200 SMA, and the 200 EMA. That's on the 5 minute. That really sucked. I remember what I was going to do now. I was going to go to the 1 minute, look for entry. Oh, look. Oh, it took that trade. Oh. Now we have a problem. That's it. Intraday double top. If we break that, we go much higher. You understand? Okay, get ready. Do it. Pull back double top. There's support right there. Oh. $684.72, right to the penny. that's right in the middle of that flag. So these are 690 strikes for tomorrow, Monday, on the 2nd, for $1.20. I don't know. I think it would go a little bit deeper right about now. $129. Boom. 138. $141. Ladies and gentlemen, we're at resistance on the SPX at the 200 EMA. We broke free from the QQQ. We are snuggled up at resistance on the 1 minute on the IWM at the 200 EMA. And we have a shooting star, which could be a reversible hammer, off the 50 SMA on the 1 minute on the SPY, baby. And that's the way it looks. Oh my. Yes, may I help you? Yes, we were watching you on YouTube, and Jim, we noticed every once in a while you flip through and look at your watch list and call off these stocks and say, well, we're here, we're there, we're everywhere. Like the IWM resistance level there at 262, you called that earlier. I have to say, man, you nailed it. Right to the penny. So, what do you eat for breakfast? Well, I have 2 smelts cooked over easy, 1 smoked inside of a cracker with a cheese omelet. Prepare ye. As we were watching everything hit resistance levels, things started to pull back. So we have 3 black crows on the SPY with a meteorite as a 3rd crow. Off the 21 EMA on the 1 minute time frame on the SPY. We've bounced off VWAP twice on the SPY today. And the gay trend line is at 684.12, which is today's pivot point. Ain't that named appropriately? 684.12. Oh, Rubio to travel to Israel to discuss Iran. Reminds me of a Beach Boys tune. Okay, we're now at 120. The calls are now at 120. These are the SPY for next week. He's at the bottom of the cloud. And we're at the 1 minute. Last time we were down here, we bounced. Now I still have a support level off this 50 SMA. So if I was to go in this trade, I'd go in small. And if we knife to the 50, I'd go bigger. Here's the 69 strikes. Prepare ye. Prepare ye. 690s. Come on, you get down there. Give 110. Crowd's going loud at the sports arena. There it is. Uh-oh. Perfect. 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 He's taking his first dip in the pond right here at 110, right where I wanted it. off the 63 and the 200. What's the SPY? Day trade scalp. You could call it either any way you want. Oh, we don't need pullback here. Oh, you could have got a nice price right there. Eight. Break it. We're now at 120. So we took these at 110. You could have got them a little bit cheaper. Off the 63. What is that I see in? That's 3 black crows. And that's on the 2-minute tweezer bottom inverted hammer up to 63 EMA on the 2-minute time frame. How's he do it? Oh, this would be perfect for a nice win for my lunch. Did you just hit the 200 EMA? Yes, I did. Boom. Can you hit the SMA? Yes, we can. Do you want to exit the trade? Yes, you do. Uh-oh. Woo! Uh-oh. 125. From Washboardjim, the founder of the Sneaky Snake Trading Strategy, where I jump in at one. Ooh, what is that? At 110 to 1.25. Thank you very much. What'd you think about that, Randy? On a good day, I usually can sneak a good trade or two in while I'm eating. 131. No 3 black crows. This one here had a hammer. This one had an inverted hammer and a hammer. On the 5 minute, 2 minute, 2 minute, 2 minute, 2 minute, 2 minute.
Netflix, we started seeing these bids kind of moving to the upside fairly aggressively, getting out of their real niche of the market, and that's really why investors were not happy, and the reason why the stock was sliding to the downside. In fact, any type of optimism that we would see that Netflix would not purchase Warner Brothers Discovery, the stock would move higher, and then we would see, obviously, a little bit of a re-raise when it comes to their offer. So Netflix is a little bit more of a unique product. They probably will look at other areas and avenues within this market, especially when you're looking at live sports. It seems to gain a lot of traction for them. And for Paramount, once again, they had a stale portfolio. This is going to add to that portfolio, and that's why you're getting that enthusiasm, that reaction there. And we'll see if this actually does pan out for them. At least for now, it does seem like the market is really enthusiastic about it.
Well, Kevin, we appreciate you being with us to break down the latest and arguably my favorite story in the markets right now. Really appreciate that. Kevin Green, our senior equities contributor. Also want to broaden out the conversation. Just take a look at the market action that we're seeing today. Joining us to help us do that, Andrew Ahrens, founder and partner at Synergy Advisory Management Group. Andrew, great to have you with us. I'd love to get your thoughts on this sea of red I'm seeing on the big board right now. We had that hotter than expected inflation print this morning. Some AI fears getting stoked by Block's announcement of its workforce reduction. What are some of your thoughts on the action we've seen this week?
Yeah, well, we've definitely seen a volatile market here, and you know, this is kind of the time of year that we see a little bit of volatility over the last couple of years, and we're definitely seeing that. But you know, earnings do look really good. I mean, the earnings season was very, very good. A lot of stocks, even you know, in the chip sector, are still doing very well. I know the stocks are down today. But, you know, I think when we get this kind of volatility, it's definitely a time to consider, you know, buying the dip on some of these stocks. I see the market quite a bit higher, you know, as we move throughout the year here. And, you know, I'm still looking for a cut in rates, and, you know, it may be postponed a little bit. But my feeling is you know, earnings are looking very, very good here. And, you know, I highlighted a couple of stocks that I think are good, you know, buys here. On some of them are a little bit on the pullback. One of the stocks I like was Netflix, and they came out with some interesting news. The stock was down 40%, you know, with regards to not knowing what's going to happen with the Warner Brothers acquisition. And we see today that, you know, they're not going to be in it, and the stock looks like it's, you know, up quite a bit today. And I think the stock, you know, may move quite a bit higher here for Netflix.
And Andrew, let's talk about Netflix as one of your picks. There was a lot of commentary when P-Sky got this 7-day waiver period to have their potentially superior deal looked at. It has been determined to be superior. Netflix now out of the process. But a lot of articles and commentary from the sell side started coming out saying if Netflix loses this, it's actually better for Netflix, for its balance sheet. Investors didn't want this deal. Do you agree with that? Do you subscribe to that?
You know, I think so. I mean, I think that, you know, when the stock goes down 40%, you know, I mean, such a dominant player, a lot of things just didn't look right with the debt situation for Warner Brothers. And, you know, they seem to be getting into other avenues with sports, and that might be something that they could pick up on in the future. But, you know, I think that this may be good for Netflix stock right here. And I think, you know, the stock may move up quite a bit, in my opinion.
And staying with Netflix here and its growth projections, you know, they've had surging ad revenue. It's looking like a potential growth component for them. How material can advertising really be to the overall business with how Netflix currently operates?
Yeah, well, I mean, Netflix right now, the advertising revenue is surging. I think it's less than 10% right now. So there's a lot of room for growth there. And, you know, that could be definitely something that helps move the stock quite a bit higher in the future.
All right, and then let's talk about another pick that you sent over here. You like AMD. You're bullish on advanced micro devices. How much of the AI optimism around AMD, you know, obviously we have some AI pessimism at play here too, but is already priced into the stock at the levels we're at right now?
Well, you know, I think the stock could really still be cheap here, in my opinion. AMD is... They had a $100 billion AI chip deal with Meta this past week, and the AI PC upgrade still coming here. And the revenue is expected to be 14 to 15 billion in 2026. So I think the stock still looks cheap, and I would be buying on any pullback.
And so in a pullback or a dip buying scenario here for AMD, yes, those present a good opportunity, but do you have any longer term concerns about AMD, about the PC cycle, about rising prices, supply constraints, this whole AI conversation blowing up, the potential for a bubble here?
Damn.
Yeah, I don't really see that we're in a bubble right now. I still say that we're still early on right now. There's definitely a lot of volatility. We're a little bit in unknown, you know, charted waters here, but, you know, my feeling is we're going to see a lot of these stocks, NVIDIA and AMD, trade up quite a bit in the next couple of years.
And your other pick you sent over, completely different space. We're going into fast casual dining here with Cava. They had a really nice earnings surprise, you know, sent them moving higher year to date and now up 37%. You know, have we missed the dip on this one, Andrew?
No, you know, I don't think so. I mean, we're still 40% off the all-time highs right now on Cava. And, you know, I had recommended it a few months ago, and, you know, the stock had moved up and then it moved down, and now we're seeing it move back up again. But I think we're going to see Cava do well. They surpassed $1 billion in revenue for the first time in 2025. They're doing an aggressive market expansion with 1,000 stores by 2032. So I think, you know, and they're following the Chipotle playbook, and we all know how successful that's been.
Yeah, it certainly was. And I want to talk about the Fed, too, before we have to say goodbye, because you mentioned them in your first answer, and rate cuts. What is your outlook right now for the Fed moving forward, especially with the new data point, delayed data point we got this morning?
Yeah, I mean, I think we're going to probably be delayed, I think, until June or maybe even later with the rate cut here. But I definitely think it's coming. And, you know, we're seeing the 30-year mortgage at the lowest rates it's been, I think, since 2022, I just saw. So I definitely think we're going to get these rate cuts, and that should spur on the market. So I'm very optimistic this year.
And what happens to your optimistic thesis if we don't get these cuts, if the easing is delayed beyond June? What's the biggest risk that could derail your bull market thesis?
Well, there's a lot of things that could happen. We don't know what's going to happen with, like, geopolitical risks at all times, right? So we just don't know what's going to happen in the market. But the stocks, the earnings still look very, very good. And we just had a really good earnings season, and I think we're going to see that moving forward.
Well, Andrew, always a pleasure to talk to you. Thank you for being with us today. I hope you have a wonderful weekend. That's Andrew Ahrens, founder and partner at Synergy Advisory Management Group. And we've got lots more for you today on Trading 360. Next, we've got the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the technicals. Tim Bowen will be here with his picks. Block, CSX Corp, and AST Space Mobile. That's next on Trading 360 on Schwab Network.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Aw, she's got your smile. Carl. Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need, all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
Schwab helps me generate retirement income. All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome back to Trading 360. I'm Marley Hayden. It's time for the big three. We've got 3 stocks, 3 charts today. Rick Ducat will take us through the charts. Here to take us through his picks today, Tim Bowen, Chief Technical Trainer at StocksToTrade.com. Tim, great to have you with us. We've got a red day for your day on the big three today. We got that hotter than expected PPI this morning. What are your thoughts on what we're seeing in the markets today?
Well, my thoughts are kind of related to one of the ideas that I have for you. The news dropped last night on Block's earnings, and basically Block XYZ cutting roughly half of their workforce. And I think that is kind of reflected in the market today. Now, I know it's just one stock, but there's all of this anxiety out there about AI replacing jobs, replacing workers, etc. And now I think there's a different story with Block that I'll come back to. But, at the end of the day, we know that since COVID, the market is very driven by retail. I mean, like the explosion of retail trading over the last few years is, in my opinion, kind of taken over, the steering wheel of the market. And when you think about all of these people with, good paying white collar jobs, there are a lot of people that have money in the market. And if they see stuff like Block, I think that brings in anxiety. The market hates uncertainty. So I think a lot of people might be, pulling back because they're worried that maybe they're working at the next block, etc. Now, what excites me as a guy who hasn't had a job since he delivered pizza in college is the trading opportunities. I just think that, unfortunately, I don't want anyone to lose their job. I think a lot of these tech companies are going to be following this to, basically improve the balance sheet, get people excited about the stock. And, you look at Block, the 5-year chart, basically upper left to lower right, the first appreciable bounce is today in the last 5 years. And I think it's a good company. I respect Jack. I think he's a great visionary, but kind of like Apple with Tim Cook and Steve Jobs. Steve Jobs was a great visionary, not the best manager, and I think that's kind of what Block needs. But that being said, I just think there's a lot of fear around that first wave of supposed AI job cuts.
Certainly, and it's a narrative I think a lot of people are trying to fight as well. Say, oh no, we won't replace humans, they'll work alongside humans. And here's our first concrete example of replacing nearly 50% of your workforce. They say they're doing it proactively, but I would like to get your thoughts too before we take a look at the technicals on Block here, Tim, just about how much of this move was taken out of the Elon Musk playbook, because Jack Dorsey and Elon Musk have a pretty well-documented relationship, and he did a similar move at, I think it was still Twitter, it may have been X at that point, but early on in the early stages of that transition had a similar move there. But also hard to ignore the other point you brought up, that other companies are going to see the reaction to this announcement, and it may make it look appealing.
Yeah, I mean, I looked at
Man,
one
look
of
at that.
the first ones that I thought of this morning is like Facebook. Facebook has 75,000 employees. I'm just like, wow, is that really necessary?
3 black crows.
Zuck is looking over at Jack and saying maybe, and Elon, maybe I should do the same thing. But that's I think, as you mentioned, when Elon bought Twitter, first thing he did was come in, clean house. And I mean, I'm a heavy Twitter user, been using it for 15 years. It got way better, way more features, way more, traffic, etc. So I think a lot of these companies, especially tech companies like a Block, again, I will say it over and over again. I don't want anyone to lose their job, but I just think there's been a lot of fluff.
Say it over and over and over again.
Just kind of hiring
People will.
because the market's been hot. They got money flowing in. Let's just hire for something to do. And I think Block got ahead of itself, and I'm guessing no Block customer will see any difference on Monday or the week after that. And it just improves the prospects of the company long term, and hence the stock.
All right, Rick, so let's take a look at the technical setup here for Block. Even with this move that we're seeing today, they are still trading negative on the year. So what's the technical setup showing us when we look at this chart?
Well, a big push to the upside, obviously, here, but still one that remains within some boundaries that we previously could have highlighted here. For starters, you can see we have this trend line connecting these 2 points. That's about where we've topped out so far today. So if you were to extrapolate it, put it across the lows, it gives you this channel-type shape here between our 2 parallel lines. We can also think about some horizontal price levels that stand out. First, we have relative highs here near 68. That might be a potential stopping point to the upside, but also 72, a consistent floor, and then the starting point for a major breakdown. Then it was tested once more as resistance. Old support becoming new resistance is a common theme that you see in trading here. Certainly doesn't play out every time, but in this case, it's pretty obvious that that was the mark to beat to the upside here. Now we can see as well the low that we established around here near 58, then became resistance once more. We dropped off following some of the information that came out in the previous weeks here. Then we formed another high near 55. So 55, 58, 68, and 72. Those are kind of the important price levels to keep in mind based on our prior activity. Now when we look at our moving averages, we have in one fell swoop taken out 3 of our moving averages, and well, I guess 2 fell swoops. It was 2 days technically here, but we took out 2 of them very quickly, rapid succession here with our gap up. 61 is roughly our quarterly EMA in gold here, and 67 is our yearly EMA. So those are 2 convenient areas to look for support or resistance here based on those moving averages. Now we can see that RSI has crossed above our 50 midline here. So look for price to take out some old key levels, and for RSI to also push into the overbought area. That would be a sign of further strength to come potentially. Now volume profile shows that the heavy concentration trading area here, 61 to 66. Price is kind of right smack in the middle of that. Things things pick up again here, 58 to 55, and then things are much quieter until we get to about 75 all the way up here.
690s
right now
again.
we're trading about 13% higher on block, around just under $62 right now. Have given up a little bit of the move to the upside that we've seen, but still heavily positive so far following that layoff announcement and its earnings.
Oh,
I want to move to
shush.
freight now,
Oh,
Tim.
Marley, what'd you wear today?
Corp, take us through this one.
Marley's wearing
so
pants or a
the
skirt.
ideas, obviously, like every week, I kind of sandwich with two very speculative. The middle, CSX, really a safe play, but this is one I shared a couple weeks ago on that breakout, basically that break of that triple top right there. Just been marching along nicely, and you're seeing all of this data of freight, expanding in the U.S. Saw a tweet a little while ago that the USA now produces more oil than Saudi Arabia and Russia combined, and more natural gas than Russia, Iran, and China combined. So that freight, that reindustrialization of America I've talked about, plus oil and gas, it's got to get to the ports somehow to be exported. It's got to get to the refineries. So I just kind of view CSX as, like I said, sandwiching that kind of safer play for a stock that maybe, some of the viewers aren't in love with, something more speculative like XYZ or the next idea.
All right, Rick, so as we look at the technicals here on CSX, wow, I can see a really steep upward channel here. Take us through what you're seeing here.
Right, so what we had in this one, around 37 here, 37.25 to get kind of granular. A repeated high point here. We had kind of this W-shaped price activity that gave us this triple top, and then we started to push above. The resistance became supportive. Then we took off to the upside here. So today we took a little bit of a dip out of our channel, but we seem to be right on the border of that trend line once more here. We had our highs 42.82 that still stand out. Along the way to some of the pauses that we saw, some of the high points, 41.73 right about there, and then a high and then subsequent low around 40 as well. It can be kind of tricky to find relevant points during a climb that is so steep and so quick, but those are some that stand out as potential ideas of
Fibonacci reversal.
You can see that our 5-day EMA 42.35, our weekly EMA in dark blue is around where price is sitting right now. 21-day EMA in teal, our monthly EMA 40.80. So that could be another potentially supportive area. A little bit of a bearish divergence here as well. RSI showing slowing momentum despite being in the overbought area here as price made higher closes. So a bit of a mismatch there, not exactly what you want to see if you're bullish in a name, but at the same time there's nuance to this. It doesn't just mean price is going to collapse. It just means things are slowing down and we're starting to take kind of a pause. So this could be merely a consolidative phase before the next leg up. It would be another way of looking at it here. So wait for some kind of price breakout to help solidify and help inform your trading decisions. Volume, pretty clearly, this is the main area. 35 to 37 roughly is the obvious heavy trading area that matches up with a lot of the time we spent in our range. A little pocket up here too between about 41 to 42. That could be another foothold in the shorter term.
Solidify.
Now we are at 42.54 for CSX, pretty much flat on the day. Your last pick today, Tim, we know you love space. We've got a space one here, AST Space Mobile. I know you like this company, so take us through why you're even more bullish on this one.
I still remember a few weeks ago when you asked me if I was ready, I was going to be like the first guy to live in space, and I said I hope so. But yeah. Listen, it's a sector I've been very, very bullish for quite some time, but ASTS kind of first showed up on, I built an AI to look for kind of like hot sector theme stocks, and this first hit back last summer in the 30s, obviously been a little choppy, but uptrending since then. Now, what I like about it, I always want to anxiously wait for Rick's breakdowns, but what I see is a stock that kind of fell apart, had a little bit of a rough patch after the breakout, but starting to build a nice base here. And what I like about it is, it's kind of a sympathy play to the SpaceX IPO, which is, we still don't know exactly when, but it's upcoming. I just think a lot of people, as that hype continues to build around SpaceX, are going to be looking for these plays that they can trade right away. And if ASTS can hold this base right here, as long as it doesn't break down, I think it's got a great chance of kind of retesting those recent highs. Again, really just kind of tagging along on the hype of SpaceX.
All right, so as we tag along on the potential SpaceX IPO and a move that we might see alongside of that, Rick, what is the technical setup right now for AST Space Mobile?
I mean, the possibilities of space are infinite. You know, like there's so much to see that we couldn't even understand what could happen yet. So an interesting idea to be sure. But what we see here is here's kind of the ascent that Tim was talking about. We reached our highs 129.89. That was around where we had our best close was 121. So it can be good to think about the best close and the best intraday highs if we're approaching resistance areas once more. So other things that we can see, 108 was a high point here, 93 was a gap level there where things started. Then we have a range here, a pretty small range between roughly 78 to about 88 or so about a 10-point range here. Looks like we also have earnings coming up soon too as well, so something else to consider. Recent lows here, 69 and 61. We haven't really tested those yet either. For now, we've held a pretty consistent floor near this level around 78. So that seems like a potential point for traders to keep their eye on going forward. We are starting to kind of slip below our moving averages a little bit here. They're kind of being dragged downward with our range-bound price activity. Moving averages tend to cluster together and drift sideways along with price. It takes a while for them to catch up. They are lagging indicators. That's one of the kind of inherent drawbacks of them here. But we can see that for now, the trend would be more geared toward the downside, though earnings could very quickly rewrite that story. Momentum compressing here, pretty common as we head into earnings once again. So not too much to make of that in this case. Our volume profile shows here we have a node near 81 to 88. We're starting to drift below that level. There's another pocket of activity here, 70 to 76. Beyond that, 54 and 46 to the downside is another important range here. 110 and 117 to the upside. A little lump of activity there as well.
Yeah, right now trading just below $80, and like you mentioned, they've got their earnings coming up on Monday, so a potential catalyst for this name for AST Space Mobile. But Tim, thanks for always being with us, bringing your picks for the big three. That's Tim Bowen, the Chief Technical Trainer at StocksToTrade.com, and of course Rick Ducat, our lead market technician, for always breaking down the technicals for us. Coming up next, we are going to spotlight AvePoint after the company posted its earnings. Stay with us.
My man. Hey! Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Oh, yeah?
Kick off the morning with the data and the decisions moving markets. Morning Trade Live that breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
We're good.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight AvePoint. Joining us now is Jim Cossey, the Chief Financial Officer over at AvePoint. Jim, great to have you with us. Happy Friday to you. Thanks for being with us on the heels of your earnings. So if you wouldn't mind for our viewers, just taking us through what you see as some of the highlights.
Yeah, thanks, Marley. Great to be with you. Yeah, it was a strong Q4, really a strong end to a strong year. We had great growth on the top line. When we think about our ARR growth, 27% year-over-year growth. Revenue growth was also 27% year-over-year growth. So really strong end to the year. And then again, we're focused on profitable growth. So when we think about profitability, for us, we focus on our GAAP operating margins. And those came in at the year at 7.9%. So really strong performance, really good acceleration over the past couple of years. So we're excited. And again, I think we're meeting our customer demands in this new AI world. And I think that momentum is showing.
And Jim, this was your 11th straight quarter of double-digit net new ARR growth, if my math is correct. What's your visibility like into how sustainable that pace is?
Yeah, it's a really good point because, that's what I think many software companies are thinking about and potentially struggling with. We have very good visibility into pipeline in terms of what we look at across the globe. We're fortunate that we not only play in North America, but more than 55% of our ARR is outside of North America. So we have good balance across the globe. And I think that balance has done us well over the years in terms of insulating from any one specific potential issue. And that balance and that visibility into seeing what's happening in those markets has really given us not only the ability to achieve these 11 straight quarters, but also gives us the confidence to continue to do that moving forward.
And Jim, of course, we have to talk about this AI conversation about AI's threat to SaaS and the SaaS apocalypse or the SaaSacre or whatever kitschy term we're going to use to call it. What are your thoughts on this narrative? Is it overblown? Is there anything to it?
Yeah, I think obviously that narrative is out there. And so clearly it's a concern for many investors as to who are going to be the winners, who are going to be the losers in terms of software in this world of AI. We think that our focus has been and continues to be on data security, data governance, and resilience. And so as we think about the world of AI, our solutions actually help our CTOs, CIOs, and companies actually think about making AI an accelerator and not actually a risk. In many organizations today, AI is a major risk. And our solutions, again, focused on that security, governance, and resilience, is taking that AI initiatives by many organizations and making it not a risk, but an accelerator. And that momentum, I think, is really what's resonating and driving our growth.
And when we have this AI conversation, we usually talk about what inning are we in the AI revolution, but specifically as it pertains to AvePoint and data protection and the AI data protection cycle, where are we here in this? How early are we? Are we talking years of runway? Are we talking decades of runway?
Well, it's a great point in terms of how quickly things are accelerating. And, if we were sitting here maybe 20 years ago, we would be talking maybe decades. But that's no longer the case just in terms of the speed and how things are evolving and changing. So I do think we're talking about literally at most years where this transformation and acceleration is happening in real time. One of the things that we've talked about a lot is how many agents are actually deployed within organizations already. And, visibility into that is very low in terms of what's actually happening. So employees are moving at break speed to try and help make their jobs easier. And I think corporations, in terms of managing that and securing that, are kind of trying to play catch up. But I do think we're in the kind of middle innings in terms of where this is headed, but it's moving fast. So it's as if the game is on 2x speed.
And what would you say right now is the biggest misconception in terms of AI's threat to enterprise software?
Well, I think there's a concept that somehow AI will write all software and that somehow the amount of software that's needed to propel us and make us more efficient and effective is somehow finite and limited. And I think one of the things that we've seen over the years is there's an infinite amount of software to be written. And I think AI is clearly going to be a catalyst for helping us do that faster, more efficiently. But I don't think it replaces enterprise software in general. I think it makes us more efficient. It makes us more competitive. And I think that is a benefit to our customers globally, because I think it speeds and accelerates their ability to accomplish their objectives and goals faster. So I don't think it's an ultimate threat completely. There will be winners and losers in terms of the software space. We believe our positioning around security, governance, and resilience positions us well to be on the winning side in the future.
And let's talk about that positioning, because you recently launched a new product here. You launched Agent Pulse. I see it in your earnings report here. What problem is that solving today that wasn't being addressed before?
Well, it touches on what I mentioned a minute ago in terms of this visibility for sure, in terms of agents being deployed by employees and being used by employees, and the company not having any visibility as to those agents and what those agents are doing. And those agents, by definition, are then acting and using data and promoting that data and potentially exposing that data and making it secure risks. So it definitely increases the risk. So for us, Agent Pulse was designed to do two things, or really three things. It was really to create visibility for our customers so they would see what's actually happening. It then secondarily looks to then secure those agents and properly govern those agents. So again, the data that they're managing is not being exposed to people or things that it shouldn't be.
Certainly, we've covered those kinds of stories where people are tricking these chat bots into selling them a car for $1 or giving them information they shouldn't have access to. Very exciting times. Congratulations on your earnings, Jim, and thanks for taking the time to be with us today. That's Jim Cossey, the Chief Financial Officer at AvePoint. Coming up next, we've got the disruptors. Dell is soaring today after its earnings. The company currently on pace for the largest % increase it's seen since March 1st of 2024. We'll take a closer look coming up.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden. It's time now for the Disruptors. George Tillis, our senior markets correspondent, here with today's company, talking about Dell. The company posted strong earnings. The CFO highlighting AI is transforming the company. What can you tell us about these numbers, George? Is a 21% move to the upside for Dell so far today.
Yeah, it's a really nice move for Dell today, and in fact, if you look at the report for Dell, it was actually quite good across the board, even guidance and share buybacks. I'll explain in a sec, but this company is actually front and foremost, if you will, part of the AI revolution. Their infrastructure solutions division actually grew quite a bit, 73% for the quarter year over year, and guidance was higher. The client services group, which includes servers and PCs, memory and storage solutions, also grew, but not as much. And that's important in the context of the move, considering that the infrastructure solutions division is the most profitable component of their business. Now, if you look at the aspects of the EPS numbers, they came in at $3.89, beating the $3.52 estimate. That's higher by 45% compared to last year. And sales came in quite a bit above estimates at $33.3 billion. Up 39% year over year, but really the kicker here is the guidance. If you look at the total server revenue growth going forward for the full fiscal year next, they're looking at a 103% increase. Total revenues up 23%, which is actually quite good considering their trailing revenues. Not to mention, if you look at their infrastructure solutions group for the year, it was up 73%. But the other thing is they guided higher for both next quarter, increasing the range to 290 on the high side from 239, as well as for revenues, quite a bit higher at 35 billion versus 29. They also guided higher for the full fiscal year as well, both on sales and EPS. But at the same time, they also sweetened the deal with an additional dividend of 20% increase, as well as a $10 billion share buyback. So that's why we're seeing a really nice move in this name. And irrespective of the fact that we are seeing some other companies out there that are beating both in earnings, sales, and raising guidance, they're not performing well. I'm going to use Zscaler as an example today because that stock is still trading at a high multiple relative to its own historical averages and above the market average multiple. Dell, in fact, if you look at the forward earnings numbers relative to the current price, it's trading around 10 times forward earnings. So in other words, this one's cheap, and I think the market is rewarding Dell as a result because the valuation was not outstretched, unlike some of the other names which are trading to the downside today.
Yeah, and certainly seeing that reward reflected in the price action, and also this move to the upside turned its year-to-date positive from negative with this move to the upside. So, George, with this big move that we've seen in Dell, how would you go about trading this name post-earnings now?
Well, look, the move today is really bullish. The challenge really lies in a couple things. The market context right now is still kind of iffy, really challenging trading environment. The other thing is there's a possibility that the stock doesn't make much movement in the next couple of weeks, or it could certainly on Monday gap continuation higher from here. So I'm going to play it more conservatively. I'm going to place a bullish trade, but I'm going to use today's range in the context of the price action. So I'm going to sell essentially a March cash secured put below today's low, which is essentially around $136 area. I'm going to sell that put for about $3 a share.
Right in time.
Contract. So in essence, all the stock has to do is hold the 136 level between now and March expiration in 3 weeks, and that $3 will road to zero. Structuring this trade, you have to be willing and able to take ownership if you're assigned shares at 136. Your cost base is at 133.
George.
But again, that $3 premium will erode quickly as long as the stock stays above that.
Yeah, well, right now we're watching this SPY instead of the DELL. Sorry to offend you. But the 690 strike for tomorrow, got $1.10. Sammy, got a booger in my nose. Would you pick it, man? Shit. The 690 strikes at 110. We're bearish. Got a tweezer bottom. Uh-oh. Let's go. I think you can do it. We've seen this before. And what time is it? Oh, it's that time. Behold, long snake. Twist your bottom. When this to hold. Okay. No, 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 no. You can't do this. Problem with that one right there. Well, no, in the 1 minute, I might have waited. Oh. Uh-oh. Well, it kind of sucks I didn't add. We're at the 63. That's at 114, 115. Ooh, 116, 17. Oh, uh-oh. Oh. Woo! How'd they do it? Oh my. We were sitting here watching it, and all of a sudden, Jim said, he did it 110, and it went down a little bit on him. He wasn't scared. No, I'm above the 50. I'm 122, please. Bam. It all started like this. Thank you very much. Amazing grace. I'll take that A plus. 6905. Uh-oh. Uh-oh. Oh, Sheba. I saw that F minus. First thing popped in my mind was MA. Kind of like an actor, you know, you get, once you're a star of one program, you're always a star. Magnificent disagrees. Okay. What's going to happen next? Uh-oh! Uh-oh. We were sitting here, and Jim said, what's going to happen next? And all of a sudden, the SPY broke out. Man, I'm looking at 686.20 by the end of the day. Uh-oh, I see a shoulder line. I see a shoulder line. See, you get very nasty right here. And we just broke it. Just like that right there. See it? Now we're going to pull back, and then retest and break out. Oh, Little bitty reversal. Another tweezer bottom. Kind of looking halfway decent. That was on the 1 minute. And on the 2. Just as clean. Trying. Boom. Looking things off.
Of the show, that too has the up arrow there. We did talk, also mention that there's an upgrade with that. Kevin, some of your thoughts. We were talking, of course, about how oil has been so hot and off the 67 level, the 66.59. That's something we know. The 10-year bond yield dropping to 3.97. What do you think about today right now?
Oh, I think today's trading day is driven by several things. I think the PPI data that came in. Remember, in my career, watching inflation data, there's 4 readings in inflation. inflation that come out during the month. It's wages in payrolls, it's CPI, it's PCE coming out as part of income and outlays, and then it's PPI, a distant fourth. And you know how I know? These numbers, Tom mentioned, they weren't great numbers, but the 10-year yield barely moved on that. And that's been the history of PPI data, is there's just not a big market reaction like you would get from some of the others. Obviously, PCE is the Fed's preferred measurement. CPI is the #1 inflation data point, and wages is always important in part of non-farm payroll. So I think the market is not worried about the PPI data as much. However, they are worried about what's going on still in software in terms of information technology. That clear leadership in the market continues to struggle, and I think geopolitics. Crude oil, even though it's off its highs, crude oil is showing some large amounts of risk premium that's making, #1, the market soften. But Tom made a good point. If you're trading these markets hour by hour, they are already significantly off their lows today. So this market, with yields looking now below 4%, there's dip buyers out there for sure on a Friday, Nicole, to end the month of February.
That's right. I mean, the financials and tech are down, but the up arrows are coming from healthcare and also consumer staples, utilities, energy. And to your point, I mean, I would say most people would agree with you. PPI never as important as the other measures that we use for inflation. However, on this kind of day, I also think you throw in the geopolitics that you mentioned, and that's one of the reasons why we're seeing people going to gold and why we're seeing the bond yields coming down for the 10-year bond. Because, even if they thought there might be some inflation or no inflation or jobs or no jobs, I think that right now front and center are some of the other geopolitical stories that are moving things around. VIX was above 21 today. Right now it's in the 19 range, but still up 7%. So that's the environment we're in. And the NASDAQ, which you both mentioned, down 6 of 7 days and having the worst month since last March. Let's get to the block earnings, XYZ. We look at this. And what do you think about the fact that they're laying off 40% of the employees? Thank you, AI. Tom?
Yeah, this, AI disruption, that's what it goes into. You listen to some of the commentaries from Jack Dorsey, the CEO. He said they're doing it from a position of strength, right? And that a lot of the tasks that their employees were doing are now getting taken over by internal AI technology that they've had and they've created, and it's going to make them leaner. That's why you're seeing the stock pop here. That it might be a little bit of a short squeeze. Remember, the bar was really low going into this report. We're only back to levels, guys, that this stock was at a month ago. So keep that in mind. Relief rally here, but this is definitely maybe a benefit as far as employee costs. That's one of the biggest costs out there for the technology companies. If they're laying off 4,000 out of 10,000 workers, eventually, after taking the initial charge, that might help them. The earnings side of their business, the profits grew 17%, so that was a positive sign. We talked to Lightfolio yesterday about XYZ, and they were pretty positive on the commentary from the company and the direction that they're going. But take this all with a grain of salt. Jack Dorsey came out and said, hey, this is going to be, we're early to the party as far as AI maybe taking jobs here, and that other technologies might be lagging and be late to this layoff party that we're talking about. Hopefully that does not happen, and hopefully AI replaces quite a few of these jobs also, like we've seen in technology repeatedly over the past 25, 30 years, where, yeah, there might be some disruptions, but eventually leads to actually more jobs. But if you look at maybe the response in the stock, maybe some short covering, good earnings, that also lent some credence to the move that we're seeing. But we're off of those highs. It's a big red candle now. And we're only back to levels that we saw just a month ago. But good earnings, but yeah, not good for your outlook on jobs if this is going to be something that becomes more commonplace here in the near term.
Yeah, Kevin?
Well, all you have to do to look at how important block or XYZ is, look at the 10-year chart of this stock. It went from about $8, $8.50 when it started to $289 at its peak. And now, before today, it was close to $55. Now they're laying off 40% of their staff. Jack Dorsey's legacy is under a little bit of scrutiny here, right? As I'm not sure he has the ability to manage the day-to-day. Great ideas, right? Twitter, great idea. Block, great, unbelievable idea that he has, but he hasn't shown really the ability to manage these companies over a long period of time. And so that 10-year chart says a lot about this company. And so the layoffs are massive. That is not a subtle drop in their workforce. That is 40%. And now here comes more scrutiny of Jack Dorsey because he just spent $68 million on a company-wide event. So I'm not sure that this recovery, and Tom mentioned, the stock was right here just a week or so ago. So this is a recovery back to some levels, but the long-term chart and the long-term progress of this company, very alarming and not a great track record here, Nicole. So this company, when it started and its ability to revolutionize small business, was an incredibly aspirational company. I'm not sure where they got off track, but hopefully this will streamline the company, allow them to keep doing business. Very shaky though, in my eyes.
Look, and even some of the analysts think that the reduction of the workforce could be a big risk. I mean, I know the stock is jumping 14% today, but you're taking a risk when you're sort of moving in this way, and 40% is no joke. The stock, as you noted, is up 14%, gapping higher, but over, I was going to say year to date 4%, but I'd rather even take, something high. It used to be 82 bucks. And so what happens next for this kind of company? Let's turn our attention over to the biggest story ever, the saga of what was to happen with Warner Brothers Discovery. And so now we know that Netflix is stepping aside. Ted Sarandos was at the White House yesterday. We know Netflix may have faced more regulatory hurdles than the Paramount deal because Netflix and Warner Brothers had this, 1 in 3 streamers. And so might have had that. Also, they were going to just buy part, right? And Paramount and there was question whether or not Netflix was overpaying. And now Paramount comes in, juices its bid, and that $31 a share. And it looks like, as financial journalists, we may be able to put this one to bed, or maybe not. I don't know, Tom.
Yeah, the soap opera's over, or mostly over at this point. We've been talking about this, the potential deal for months. And you brought up a good point. There were senators and Congress people out there that were pushing back against this. So who knows if Netflix would have won, that this would have even gone through at all. So I think this is, obviously the reaction to Netflix stock over the past week. It's up 18% this week. Remember, it started moving higher when some of the odds that Paramount was actually going to win this bid, this stock was trading below 80 bucks just over a week ago. So we've already seen, some pushback into this stock. Maybe people trying to buy the slide that we had seen. Still down 30% from those all-time highs that we saw in mid-2025.
Getting back down there again.
This is a benefit for shareholders of Netflix because they were scratching their heads. They were selling
getting mine.
Asking questions later with the thought.
Whoa. Hold on here. Huh. Oh, she looks sexy right here. $6.90s. He's thinking about it again. 106. James, yes, do it. He's doing it. Get it. Oh God. No. He's got 106. You can do it. 1.06. Ooh. Okay. Well, we might go to the gay line again. The pivot point. I got 690s at 106. $1.06. No. No. Down 60. I'm gonna go down another one. Yeah. Come on. Oh, more drama.
Sure. You know, there is a certain amount of weeds we have to get through in this market right now. So if you were looking at something to give yourself more duration for these stocks to recover and get back to where they were. Remember, like Tom mentioned, Amazon was a $250 stock not very long ago. So I looked at something in a longer term. So I went up to the May expiration. 77 days is my length on this. The move out till May expiration is exactly $32 expected move, up or down. You get that in the right-hand column of the Thinkorswim platform, $32. So what I looked at is a unbalanced call butterfly. This paper money trade buys the 210 strike, just a slightly out of the money strike, and then sells two of the May 15th 240 strike. So a $30 wide call vertical. Then against that, I sold the 240, 250 call vertical. So an unbalanced butterfly, a $30 wide call vertical financed by a short $10 wide call vertical. I put that in about $8.55, trading about $8.50 right now, so just about a nickel lower. But as you know, that $30 call vertical, that's where this max profit lies, right around that 240 level. So if you get that rally back, Tom, the break even, it's the long strike 210 plus whatever that debit paid is, so it's about 218.50 would be the break even right now. The risk on the trade, Tom, is the debit paid, as you know, and you've got 77 days, Tom, 2.5 months.
Yeah, let's break this one down, because you did give yourself duration, and you're going to capture another earnings event. Last year they reported on May 1st, so most likely company's going to report around the end of April, early May, so keep that in mind. But going out, as Kevin mentioned, 77 days till expiration. You got over 2 months in this position. But here's, let's break it down. Buying one of the May 210 calls, selling two of the May 240 calls, buying one of the 250 strike calls. Unbalanced, broken wing, call butterfly here to the upside, paying roughly about just over $8.50 debit. There's your risk, $855 per spread, with that break even of 218.55 to the upside. On this one, if you look at that on a percentage basis, it's about $10 above the current share price. On a percentage basis, not that much, even with 77 days to expiration. Apex of profitability, as you can see here from the risk profile, at or near that 240 strike where you're short two options now. But even if the stock continues to rally, goes to new all-time highs above the 250 level, you still have more than a double in profitability on this trade. So Kevin's given himself duration on this trade. Percentage move to the upside to get above that break even isn't that great, but I think the key on this type of strategy is you've got to have that longer term outlook on the stock. It gives you that time for this trade to develop to get to above that break even at 218.55 for profitability on this one. But keep in mind, on butterflies like this, you'll get some, if you see this stock move above 220, 225, 230, it'll start expanding in price, but it really starts to expand as it gets closer to expiration, so keep that in mind. But 855 debit on the bullish call butterfly, unbalanced call butterfly here. Kevin, I went a little bit different direction here, bearish, but I went a little bit more passive and a lot less time in my position. So I went out to the March monthly options here, so 21 days to expiration, just 3 weeks, where I looked at selling an out-of-the-money call vertical, neutral to bearish, selling the 215 call, and then buying the 225 strike call. So just a short $10 wide neutral to bearish call vertical. You're going to collect roughly, when I looked at this earlier, it was trading about 250. It's still trading about 250. That's what you can potentially make. $250 per spread with about $750 in risk, but that's all the way above the 225 level. Kevin, this is more passive, better probability of success, but that's why I've got more risk than potential reward on this out of the money short call vertical.
Yeah, you lowered your short call strike inside that expected move, made it a $10 wide spread. That the trade-off there's trade-off in options every day. It gives you a little more premium. This would be a trade that you might do, number one, if you're bearish on Amazon, right? Because it's relatively short term and it's a bearish trade. But also you could do this trade if you were long Amazon in your portfolio and wanted to hedge against, number one, upside or downside, or doing nothing, right? The question you always make on a long spread versus a short spread. And my trade, my unbalanced butterfly, needs movement to be successful. Tom's needs nothing to be successful. If the stock stays right here, he would max out on his profitability. So there's the trade-offs that we go through all the time, Nicole. One is a more passive look on the bearish side. One's a more aggressive, longer-term look on the bullish side. Both have a chance to be successful.
Look, this is a record funding round, and most of these Mag 7 names are still down year to date. Great look there at Amazon, gentlemen. Tom White and Kevin Hinks, thank you for that. Coming up next, it's cash tags.
So the team from Likefolio will give us the very latest on their sentiment data on Norwegian Cruise Line, which is set to report its earnings before the bell on Monday, and we'll get you ready for that fast market. We'll be right back.
Hi, I'm Alex.
I'm Jane.
And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market right here on Schwab Network. I'm Nicole Petalides alongside Kevin Hicks. He's ready too, live in San Diego, the site where we'll have this weekend's Charles Schwab Market Drive. So everybody's excited to see Kevin and the gang there. In the meantime, and I know he's excited to see everybody who's attending. In the meantime, we look at hashtags and we bring in Landon Swan, co-founder of Likefolio, and looking at Norwegian Cruise Line ahead of the earnings that's due out in the morning. I know you have a lot of data, sentiment data as well. The stock has been a great performer, 33% higher in 3 months. It's been outperforming some of the peers. Energy prices are higher, so I think many names that have to do with energy are a little lower. Also, you have the Mexico story, maybe that, the cruise lines are redirecting, things like that. But more importantly, at Likefolio, you have sentiment data that's really crucial. Let's hear more about that, Landon.
Yeah, absolutely. So, what we're doing is we're tracking when people talk about, Norwegian or its competitors, or just going on cruises in general, what their experiences are like. Are they booking? Are they not booking? All of that. And it's pretty interesting what we're able to find. Now, what we're seeing overall in the industry is stronger demand for sure, accelerating demand. And this is not just pent up from COVID. That's kind of in the past now. So this is actually just people more interested in taking cruises. However, when you look at the competition, Norwegians, they're gaining, they're taking advantage of this stronger demand, but they're not doing as well as Royal Caribbean or Carnival. And so that's interesting when we look at, what's going on inside, kind of peek under the hood a little bit. They are, Norwegian's doing a good job of getting passenger tickets revenue up. I think it was 18%. The ticket count is up 13%, and they're getting the per guest revenue up significantly. That's specialty dinners, Wi-Fi, spa, excursions, things like that. And we're seeing that people are booking that before the trip. They're treating this as sort of an all-in, mentality when they're going on vacation. However, we've got some negative sentiment around just the experience, and it's, some people talking about being nickel and dime, that it's, constantly asking for more money. So that goes back to that per guest revenue increasing. So they're doing a good job, but they're irritating some customers, not all customers, but definitely some customers. But overall the reviews are pretty positive. Great ships, great crew, things like that. But we do see just in general strength in the industry or in the sector, but Norwegian's not taking advantage of it as much as some of its competition. We're expecting, industry is expecting 11% increase in revenue, 8% increase in earnings. They had a great quarter last time, but we're just worried that with the recent run-up, maybe it's getting a little bit ahead of itself. Again, on the other side though, the PE ratio is so low compared to its competition, it's kind of almost a value play at this point.
Landon, there are some interesting things about Norwegian that differentiates them from the other. They're number 3, right? Royal Caribbean's the biggest, about 90 boats. Then we get Royal Caribbean's number 2. They're about 64 boats. But this stock really didn't recover that well from COVID. If you look at a 10-year chart, their stock was in the low 60s in COVID and really has struggled to recover. Now they've got some activist investors. Elliott's got about a 10% stake, and they're coming with some reconstruction and some accelerated debt payments, and they want changes made to this company. This is a company doing well, but seems to be underperforming based on the others and based on some of their peers. And remember, this sector of the U.S. economy that's enormously popular is starting to get populated with some competition for them. And so this company is not without risk, even though they hold about 13%. They're solid third place, but there's some people nipping at its heels, Landon. There's a reason why this stock is cheap, and the Elliott Investment talked about all the things that they're not doing well. It sounds like they're in store for some big changes coming up.
They may be. I mean, when you look at what Elliott said and what they're demanding, or what they're asking for, I should say, and sort of management's reaction to that, it was almost a brush off, right? It's like, you know what, let us run the company is kind of the way that I took it. We'll see how much they push and how much that do they give into that, or do they make those changes? I know that Norwegian, they recently locked in a long-term shipbuilding contract through 2037. So while that may secure some favorable pricing on materials and labor, that's also going to decrease significantly your flexibility for changes in strategy. I mean, can you imagine booking something 10 years out, we're locking it in? I mean, that's a crazy business, but that's what you're dealing with these massive ships. So it's going to be interesting to see how that plays out. When we look at their last quarter, and they had a very strong quarter, but they missed on revenue and beat on earnings, which is an unusual combination, but it tells us that they're definitely cutting costs while they're expanding their margins, which everyone loves to hear that. But you definitely want to get they want to beat on revenue, obviously. Even though it was up, people were expecting a little bit more. So now what are we looking for this quarter? We're looking at plus 11% on revenue. I think they'll probably hit those numbers, but with the recent run up in the stock, it's gone from 17 to 25. Even though it's been kind of a ho-hum year, just like Nicole pointed out, if you look at the last little run up, that gives us a clue into investor confidence, and I think investors are a little bit more confident heading into this. And you can see here on the chart with our data, the blue line's our data, the white line is the stock price. We're pretty much in line. We had a little bit of a spike on demand not too long ago, but it's sort of normalized back to the mean. And I don't think that there's a huge surprise coming in either direction. And when we look at this one overall, the Likefolio data, everything coming into it, we're slightly bullish on it. Maybe not enough to place a trade, slightly bullish, but it really comes down to the reason that we are slightly bullish comes down to that valuation. I mean, you've got Carnival and Royal Caribbean with PE ranges in the mid-teens, PE ratios in the mid-teens, whereas Norwegian Cruise Line's forward-looking PEs around 9. So it's, if you can get some strategy shifts, if you can get some restructuring, maybe this is a good buy long-term. It's going to be really interesting to see how they address that activist investor Elliott in this earnings report, because that letter came out, I think, 10 days ago. So this is still pretty fresh on investors' minds, and now management they have to address it very directly, and we'll see what that entails. But overall, Likefolio data is generally very positive on the industry and positive on Norwegian, but not as much as the other two.
All right, look, and I also just took a peek at Viking, which has gone from $31 up to $81 as a new 52-week high. But we'll watch all of these names. I know that just recently we were talking about Royal Caribbean and the record bookings for cruises, the pace that they had been seeing. So as you noted, Landon, I mean, there's definitely a lot of demand out there. Landon Swan, thank you so much, co-founder of Likefolio. Thank you. So we'll bring in Tom White back in. And so, Tom, what are your thoughts when you look at Norwegian?
Yeah, it seems like, we talk about the cruise lines with Likefolio on a quarterly basis, and CCL, that used to be the laggard as far as their data goes. They've actually jumped to the top, so it's execution at this point, and maybe that's why you're seeing activist investor, commentary coming out right now, is the fact that maybe this management team is just not executing well, because if you look at what they've seen as far as bookings, and the growth that this segment has seen within the travel industry, it's been exponential, and Norwegian hasn't, participated in a lot of the rally that the other two the other two big ones, RCL and CCL, have done recently. So, Kevin, when you look at this, they report on Monday morning. It's a low price stock. The option market pricing in for next week's options about $2.50 either way, but that's for the entire week, and they report on Monday morning. How do you want to look at this one from an example trade?
So the one thing you can't argue is this is the third largest cruise line maker that has a very low valuation. Landon was correct on that, way below the peers. And now they have activist investors that see that. So change is coming, could be very positive for this as a recovery. Remember, if you look at a long-term chart, their stock price hasn't recovered from the COVID drop. It's basically flatlined for the last 10 years. Now, here's the thing. Giving yourself a long-term, I went back and gave myself some duration, Tom, and gave myself what is more considered a stock replacement strategy. It's in the diagonal family, right? But what I did was I went out to the April 17th. So I gave myself, 49 days, April 17th, and I bought the 22 call, so $2.50 in the money, Tom. Then I went to simply next week and sold the 27 call. And I did that for about $3.35, trading about $3.25 now. So it's about a dime cheaper, but this is a call diagonal.
Walk away, and there it is
gives you a little
again.
bigger delta. It's about a 42 delta on this. Why? Because my long call is $2.50 in money, so it gives me a little bigger delta there. So this is a way, instead of buying the stock and selling a call, this is a way to do it for significantly less money, less capital outlay than you did before. So the call diagonal, or in some cases the nickname for it is the stock replacement strategy. Buying the 22, selling the 27, about a 330 debit, 325, 335, something in that range, Tom. And the risk on this trade is always the debit paid. And if the market allows you, you can extend duration on this trade and chip away at that net debit. And when you do that, Tom, you chip away at the break-even price.
Yeah, let's break this one down. Bullish call diagonal. As Kevin mentioned, this could be used as a stock replacement because you're buying that deep in the money call out in the April monthly cycle that expires in 49 days. It's got a 73 delta, that 22 call on this strategy. So buying the April 22 strike call, selling the February or the March 6th weekly 27 strike call. So a bullish $5 wide call diagonal, paying roughly about a 335 debit. That's going to be your risk, or 305 debit, I think we've got on there on the screen. That's going to be your max loss, is the debit that you pay. So if you pay $325, that's going to be your risk, $325 per spread. You can see here the break even on this trade, because you're buying that deep in the money call, anything above about 24.5, where we are right now, is going to be potential profitability. And because you're paying less than the width of this call diagonal, $5 wide call diagonal, you're paying 305, 325, 330, around those levels. It's less. So anything above about 24.5 is going to be potential profitability. And as Kevin mentioned, as you get closer to expiration on your short option, that you sold on the 27 strike in the March 6th weekly options. As you get closer, you'll have that potential to roll or adjust that short call. And the idea is to collect credits that reduces risk, increases potential profitability. But you've got multiple opportunities or potential for that rolling of the short call on this. You can see here the apex of profitability right at or near that 27 strike on this this call diagonal that's bullish to the upside, and you're taking advantage of that vol dispersion. That lowers the entry point price, where you're buying about a 60% implied volatility on aggregate, selling about a 90% implied volatility on aggregate on this bullish call diagonal. It kind of sets up with Likefolio's data here, Nicole.
And it was great to speak to Landon and get some of the insights there from the Likefolio proprietary data that they have. It's so great to see you both. A nice breakdown, great trades that people like to take down. In the meantime, coming up next, we're going to break it all down and look at Palantir. George Sillis is standing
In the
by.
meantime...
And Palantir has lost a third of its value since the peak that we saw back in November when it was at $207. It's currently at $135, but there's still a lot of optimism surrounding the name and even an upgrade today. We'll be right back.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market right here on Schwab Network. It's time for the breakdown. UBS upgrading Palantir to a buy today from a neutral rating and putting a $180 price target. The firm said the company is a premier growth story in software and that Palantir at the nexus of the two most powerful spending trends, AI and data. All right, let's break it down. Joining me right now, senior markets correspondent George Sillis is with me, and we were noting what a sell-off the company has seen. But the last quarter, someone like Dan Ives was very impressed. A lot of folks were impressed, but it has seen a significant sell-off. Some of your thoughts on the Palantir story?
Well, I think this is interesting. I mean, first, if you look at the stock, at least year to date, it's down about 23%, and that's to be expected. I mean, this is essentially an AI play, but also more in line with software as a service. And I think that's the interesting thing about this one right now is there's a lot of talk about AI and Anthropic and ChatGPT displacing many of the software companies, especially the application software names. But one of the things you got to keep in mind is AI needs to be hosted across multiple platforms, like ERP platforms like Oracle, for instance, the cloud, Microsoft, if you will, and Google. And of course, Amazon Web Services or Azure for Microsoft. But nonetheless, if you look at Palantir itself, one of the interesting things I think about it is that the defense business constitutes a large percent of their sales, and we've started to hear that there are some concerns about AI displacing some of the defense security needs from a technology standpoint. So, I think this company essentially has a lot of protection, and that's its government contracts. Not to mention, it's becoming more in line with a central processing database server company as well. And I think that's important in the context of its moat from a durable competitive advantage relative to the other software names out there, especially the application software names, which have been, for lack of a better word, decimated. Many of them are down about 50 to 60% in the last few months. But Palantir, if you look at the call by UBS, they're still seeing some bullish trends in sales. They upgraded their target to 180 buy versus a neutral rating on the stock, and they see this pullback as an opportunity, considering that if you look at the sales in 2026 at $7.3 billion compared to the trailing 4 quarters around 4.5 billion. That's a 70% increase. And they're also looking at stable growth in margins near 50% range on a net income basis. So they're seeing significant profit growth estimates for Palantir going forward. And nonetheless, again, it's still trading a little bit lofty of a multiple, around 73 times 2026 earnings.
And as I noted, we did see UBS with a buy rating at a 180, and we had Rosenblatt with a buy and a 150 target. George Sillis, thank you so much. Let's bring back Tom White and Kevin Hinks here to take a look. Tom, your thoughts here on Palantir?
Well, yeah, you talk about the growth rate, right, over 70%. That was spectacular on their last earnings, but the stock still fell on those. And you look at the commercial side of their business, last quarter it grew 137% year over year on this. So they're expanding, not only working with the government, but also into the commercial side, and that's a big growth engine moving forward. I think one of the caveats we always talk about when we list, and discuss Palantir is the fact that the valuations are still elevated. The forward PE is still over 100 on this stock, even with the 35% pullback that we've seen. Now, UBS says take advantage of this pullback and buy the stock, but then you start looking at valuations, maybe AI disruption. But one of the keys with Palantir is you look for a true competitor within this space. They don't have one at this point. So that's always been, I think the golden goose here for Palantir is that they don't have a true competitor, and they continue to grow at these rates that double, triple what we've seen in other software names. They're actually monetizing AI right now, and that's the benefit that the market gives them and the higher valuation that they give them, even with this 35% pullback. So I looked at a strategy that, just like Kevin's, that we talked about earlier, I'm giving myself duration on a directional bullish trade here. And I went out to that same April monthly option, or the April monthly options that expire in 49 days, and looked at buying an at-the-money 135 strike call, then to offset some of the costs on it, sell the 155 strike call. So a bullish $20 wide call vertical. You're going to pay roughly, we've got 770 debit here, trading closer to 710 right now because the stock has pulled back with the overall market. But the debit you pay on this, whether it's 770 or 720 or 710, that's going to be your risk. So $770, $710, depends on what you pay for this one. But if you pay at 770 debit, it takes your break even to 142.70 to the upside on this one. So Kevin, it's directionally bullish. You're offsetting a lot of the costs on that bullish 135 call that you're buying by selling the 155 call, and it kind of sets up with what the option market's pricing in into that April expiration.
Tom, we don't know when the sentiment will change, right? Or when Palantir has gone through its corrective phase. It seems to be firming up here between 130 and 135, but we don't know. So how can you combat that? You give yourself duration, you give yourself controlled risk or definition in terms of risk, and you put on a trade that gives you that all the way out till April monthly expiration, and you give yourself a chance to make double, almost 3 times your money if you're correct, but around 2.5 times, something like that. But this is a risk-defined strategy pointing to the upside, giving yourself a delta on the upside, but controlling the risk, because we don't know, right? When will these software companies turn? If they even will. So, but that's how you control the risk. Doing a long call vertical.
There she goes.
Give yourself some duration, some time for that to happen, and understanding the risk involved. It's the debit paid, Tom.
Yeah, and I think one of the keys is that break even 142.70 if you pay 770 debit. That's only about 5.5% above the current share price. I mean, we've seen Palantir move double digits on a percentage basis. So keep that in mind also. This gives you some flexibility as far as trade management goes also, because you're buying a directional vertical. Yeah, you need to move to the upside, but also if this thing starts to expand in price and maybe you did multiple contracts, you could potentially start parsing down your position or close all of it if the market's open and it allows you to. So it gives us some flexibility as far as trade management on this bullish call vertical as an example here in Palantir, Nicole.
Yeah, and you know, Tom and Kevin, I really think about the moat that Palantir has, the government contracts, and if you look at a 3-year chart and you got in some time ago, this was a $7 stock 3 years ago. So, you know, yes, it's off its highs, but still has had an incredible run over those years. It's great to see you both, Tom White, Kevin Hanks, and thank you, friends, for being with me here on Fast Market. So I'll meet you again at 2 p.m. Eastern Time for the watch list. To join me then. Next Gen Investing is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome to Next Gen Investing and happy Friday. I'm Jenny Horn. Let's check out how markets are faring. Of course, about 3.5 hours into the trading day. We are seeing some weakness today, pretty broad-based as the S&Ps are down now about 0.75%. The Dow is down actually 1.3%. The Nasdaq, shockingly, is actually our best performer of the laggards today, down about 0.5%, while the Russell 2000 is also lower, now substantially by about 2%. So stocks pretty broadly dropping in Friday's session after the latest producer price index data came in much hotter than expected, adding sticky inflation to a list of growing concerns right now, causing turbulence just over the last month. But as we do close out the month of February, all 4 major averages are not only pacing to close out the week lower, but 3 of our 4 major averages, excluding the Russell 2000, are expected to post losses now on a month-to-date basis. The NASDAQ right now pacing to close out this month down 2.5%. But throughout the next hour, we will focus on the individual stock stories shaping today's markets. We'll kick things off with some earnings movers to keep on your Friday radar. We'll also be talking through the technicals in both Netflix and Paramount Skydance, as Netflix is stepping away from its bid for Warner Brothers Discovery, and both shares are rallying today. Shares of Block are also higher on the session after CEO Jack Dorsey disclosed they will be replacing nearly half of their workforce with AI. And we'll close out the show with under 30. Fig shares also climbing to levels not seen in nearly 4 years after delivering fourth quarter numbers that blew past the street's expectations. But here now to help us kick off the show today is Sam Bottas, host for the Schwab Network. And so Sam, I know that today does mark the end of trading for February. It has been a busy February. I mean, just from a market standpoint, there's been a lot going on day to day. So what sticks out to you when looking back at the last week and last month?
Well, it feels like a year, doesn't it, Jenny? I mean, there's just so much going on. Is it September yet? No, it's the only end of February. Look, this is where we stand. I mean, there's a lot of moving parts going into this weekend, even just today. I mean, it feels like we're just drinking from a fire hose. I sound like a broken record, like I say that every day, but there are just so many moving parts right now. Let's start with the PPI, for instance. I mean, the fact that we got a hotter print here and the wholesale prices are remaining sticky when it comes to some of those producers is just piling on just another worry on top of a lot of the concerns that were already in these markets and had really rattled investors. And you talk about some of the credit risk, I mean, particularly in private markets right now. I mean, we're talking about a UK mortgage company today being the latest, really putting the markets on edge about the financials here. And so that is where we're seeing that sector underperforming very much across the broad landscape here. And then obviously you have AI concerns in this market as well. Everything from the valuation story, the capex indigestion that we've been witnessing, not to mention the funding as well, the ROI, and you know, some of these companies tapping the debt markets. So there's just so much going on, and I think that's really reflected in the kind of trading action we're seeing today, where it's a lot more defensive. Obviously, consumer staples, healthcare, for instance, utilities catching a bid, energy, it is an all-time high as well. No doubt it's tracking those oil prices. Just keeping an eye on WTI and Brent right now. We're ticking higher. I'm looking at some of the lines coming from the Trump administration right now, heading into the weekend around Iran off the back of some of these talks. So just sprinkle some geopolitics in there. Why don't we as well? So obviously there is a lot going on here, not to mention obviously some of the earnings which you and I are going to get across. I think, you know, one of the big stories in the markets today has also been the fact that the bonds are catching a bid. So clearly with everything that I just mentioned, there is this flight to safety. There are some of these concerns, and we've seen the 10-year dip below that 4% now.
Yeah, and I think an interesting call out as well. And I mean, the fact that we are seeing crude oil also higher pretty substantially today. The crude oil futures up to about 2.4%. And another strong session for gold. Well, Bitcoin, I mean, continues to fall. Bitcoin futures also down about 2.5%. So I agree. It's even beyond just some of the broad headlines. I mean, there's so many stories to get through. So we'll start off with the earnings moves, at least as far as some of the strength that we're seeing today.
Snake break up, pull back.
One of the best
Little
performers
boom.
500 today. I mean, I read the earnings report.
Symmetrical flag.
Move, and I could not believe my eyes, Sam, because yes, this was a phenomenal story. I mean, the fact that AI server demand is exploding, for a company like Dell to see a 21% jump, I mean, this even gets me excited, frankly.
Yeah, look, there is a good story in all of this sort of unsettling news and developments and headlines we're tracking today, and that is Dell. I mean, this is really around the narrative that they've put up here, particularly with respect to the margins and memory story. Let me run you through these numbers with the Q4 earnings. Obviously, we did see a beat here, $3.89 versus the $3.52, which was estimated on adjusted EPS of revenue of $33.38 billion versus the expectation of $31.9 billion here. We saw the AI server orders rising to $34 billion last quarter. So fourth quarter AI server revenue grew more than 340%. So yeah, you don't have to double take to look at those numbers when you see those triple-digit percentages there, Jenny. That is right. That is exactly what they reported here. So a lot of strength coming from them. Obviously with that...
She's right. Well, we got a flag setting up on SPY. Sure do.
All right, I'm back.
Oh, he's back.
Had to get some customer work out of the way.
Oh, very good.
Do you see my screen?
No, I'm watching SPY here, yeah. Screen C.
You see this Head and Shoulders forming on ES?
Oh, I gotta see what this is. Yeah. Head and Shoulders or inverse?
I mean, this is that AI tool that I use that automatically scopes it out. And
Oh, yeah.
what patterns are. It draws it itself. Kind of cool. That's what I like about Trading View. It's got a bunch of cool add-ons to it. Now, it'll show you what's forming. It doesn't mean it's a Head and Shoulders. It means it's forming a Head and Shoulders. It could always break out. But, I mean, if you were drawing the line yourself, you'd do the same thing. Just because it's forming doesn't mean it's going to finish.
Yep. Correct. 100%.
Is livid in here? 'Cause I'm about to blow y'all's minds. I swear to God.
Hello. Uh-oh. Here it goes.
I've never seen anything like what I'm about to post.
Let me see it.
Oh my God.
Bring it on.
This is absolutely insane.
Bring it on.
I watched this last night because I like to sit around and watch music at night.
Oh.
I tried to find this band for like 45 minutes before I actually got up off the couch and came into YouTube and saw that every single thing in this video is AI. The entire video, all the people, all the actors, the song, the crowd, all of it is AI.
Music.
That is oh my God, that is so freaking mind blowing because this shit looks like real people and right off Netflix. Like this is insane how good AI is now. Not to mention that the song is ridiculously bad. That is the best looking AI I've ever seen in my life. Like that's what Netflix is gonna do. I'm so mad that I can't download that song.
You can't?
I mean, it's not a real song. It's not a real band.
Oh.
AI made it up. I guess I could find something that can rip the audio out of YouTube. That'd be great.
He's watching his trade here. I think we're going to come down and touch it for the third time.
Yeah.
Prepare ye.
He is a football ES that's been holding up all day.
Yep. I got a...
But if you do break that neckline on that Head and Shoulders, it's probably going to be bad.
Here it is. We're going to find out. Randy, if you can count to 3, you can trade with me.
Okay, I'll shut up now unless I have something interesting to say. I just wanted y'all to see that because that's the best
Say
thing
it.
I've ever seen in my life.
I got something interesting to say. 1, 2, 3. You see it? Funky.
I see it.
And if you go to your /ES, you got a Head and Shoulders. Inverse head and shoulders.
Yeah, I'm on the one.
On the 5 minute. On the /ES.
Oh, it is, yeah.
He's watching it real close here. I'm not in it though. $690s. SPX. Man, it just looks so yummy. Flagging. Meta pulled back after a couple good days. And Apple just had a new low 3 minutes ago. Paging NVIDIA. Nearing a double bottom, NVIDIA. We're at the bottom of the flag. If you can count to 3, you can trade with me. Now we're sitting at the bottom of the flag on the 3rd spot. This is the sweet spot. Does it have the mustard? I don't know. Oh, it doesn't have the mustard. Well, Pilly. I was ready to go $50,000 in that trade. 500 contracts. Watch him turn his head, and the thing bounces. Come on, man. Come on, man. Well,
under yesterday's low.
Yeah, we got orders stacked under us a long, long way. Like all the way down to 68.35, and I'm not talking about little orders. I'm talking about there's 350, there's 320, there's 220. Like, the 6860 level's been holding, but it's the third time we've cracked it, but fourth time we cracked it today.
Yeah, I'm looking at buying if 83.29 doesn't hold this late sale.
Doesn't look great. Everything I'm looking at doesn't look great for the upside.
Let's see.
We got some put support, but I don't know if that's gonna hold. Nobody can say they didn't know it was coming though, because every single day we've been seeing 2 and 3 times, sometimes 4 times as many puts, all just calls for freaking SPY for 3 weeks now.
yep.
Did you see that video, Livid?
In the room, yeah.
Watch it tonight. I started to watch it, but then I saw
I figured with you and all your little song making, you're gonna freaking have your mind blown by that damn thing.
Yes, looks like shit.
Well, this needs to be getting hold. Ah, yeah, we could double bottom all the way down here at freaking 42. Yeah, so that's what I'm thinking too.
You're right back.
Ruffle, that might be the worst idea I've ever seen anybody put on a Discord. I don't know who let you near a brokerage, but they need their hand slapped. noticed 5 puts coming in over the last 3 minutes.
More drama.
Yeah, now they're buying put sweeps above asking.
Oh.
Orders in the last 4 minutes. Okay, where's my major? Got to mark out the other page. $67.50 to $67.75. If we bust through there next week, it's going to be a bloodbath.
Little bouncer.
We held that 68-60 level on the 5 minute. It wicked up right to it.
Mm-hmm.
Get some volume to come into this though. There's nothing.
Yeah. I mean, with what's going on today, I don't think a lot of people are going to be positioning today. I think they're already positioned, and that's what we saw over the last few weeks. Like, look what's above us and what's below us. It's not. It's not something that makes me think, oh, even though this line is holding for the time being. Those aren't the blocks that I'm used to seeing. Those are big.
Do.
People been sitting there all day too, haven't they?
Mm-hmm.
she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab. We have everything we need all in one place.
I can set up her college fund.
I've been learning about trading strategies.
Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a map?
Schwab!
Invest your way with Schwab. Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back to Next Gen Investing. We've got now a fresh look at this morning's inflation read with wholesale levels that are coming in hotter than expected. So joining us now to break down today's PPI report is Ali Melli, founder and chief investment officer and managing partner of Monticello Capital Partners. Ali, thank you so much for joining us today, and of course, happy Friday. What really stuck out to you the most in today's PPI report?
Thank you very much for having me. The thing that struck me was, first of all, it was more driven by services. But then if you look at the components of services, essentially it was really driven by distributive services, which, even though it's called services, it is more a goods measure. Effectively, it's not reported as part of PPI goods. But distributive services are
CPI goods
that wholesale distributors, domestic really wholesale distributors charge. That was the driver of the PPI beat. And that is interesting if you put that in contrast with CPI coming milder than expected. And essentially, we have CPI getting closer to 2%, but you have PPI increasing.
Okay, so walk us through how we're seeing hyperscaler AI CapEx really showing up now in PPI, and why this pressure could be seen as structural, perhaps not temporary.
Absolutely. So one of the things that we noticed is that it could be early signs of AI CapEx showing up in PPI, and that's because if you look at the data center build-out, essentially that shows up through this wholesaler. Like you have a lot of equipment, you have data equipment itself, you have power equipment, you need to have cooling systems, you need to have concrete, and you also have people, i.e. the data center operators and data center developers, who are willing to pay a lot, and they are sort of not that cost sensitive when it comes to how much they are willing to pay, because if our hyperscalers are willing to spend hundreds of billions of dollars to develop data center, no one wants to be the one who is lagging because they wanted to cut or manage their expenses when it comes to construction expenses, paying for concrete, paying for cooling systems. And that is putting a lot of price pressure on the wholesale prices. So I would say that whenever you see suddenly like margins increase as much, and in this particular case, it was 14.4% wholesaler margin increase, that's because you have a buyer base that is probably not that price sensitive. And it's interesting because you are seeing that in the wholesale PPI, you are not seeing in the consumer PPI.
Okay, and that speaks to kind of my next question. With producers, of course, seeing inflation that consumers have not yet, we're left with, two possible outcomes. Either prices eventually pass through to CPI, or corporations see their margins get squeezed. So from your perspective, which do you think is most likely?
We think it's most likely that the margins would get squeezed, because we are already seeing effectively that a lot of the CapEx that is showing in this PPI are incurred by companies that are going to be losing money. They have products that are loss leaders. Last time we were able to have an inside look at OpenAI, they were having significant losses. And I imagine a lot of front end of the AI revolution, a lot of those companies are in the mood where they are losing money. And even if you look at hyperscalers, they are having capex, but that capex is not necessarily showing up dollar for dollar in increase in revenues. That they are showing revenue growth, but there is an income growth, but that income growth has not necessarily kept pace with the size and speed by which capex is expanding. So if I was to make a bet, I would probably pick that corporate profits are going to be squeezed a little bit. And right now we are at historical all-time highs when it comes to corporate profits. It went from 8% of GDP to before the financial crisis to around 16% of GDP, and that's historical highs. So there could be a pull to mean or reversion to mean when it comes to corporate profits. And we are seeing some signs of that by looking at the amount of losses that some of AI companies are showing in their operations.
No, absolutely. I mean, we talk about it every single day on the show. There's always another story about, I mean, like right now margins being squeezed in terms of the more mid to long-term perspective. And I'm curious your thoughts on if today's PPI does change at all the outlook for rate cuts this year, or is it perhaps more noise than a real meaningful signal for the Fed?
Well, we think that if the components of this PPI, and especially if the thesis around the PPI increase being driven by corporate capex and mainly impacted by AI comes to fruition, that's a structural driver of higher PPIs. The Fed has declared in the past when the CPI was high that they don't care about CPI, maybe they care about PCE and other measures that are directly led to PPI. I'm always a little bit skeptical of Fed when they said that, because I felt Fed was always, over the past 16 years, has always been looking for an excuse to either cut rates or expand its balance sheet, even when it was not warranted. But right now, they're getting to a point where, because PPI flows through to PCE, it makes it harder for the Fed to cut rates. And we think that might actually force the Fed's hand and make the Fed continue to pause cutting interest rates. And on the other side, it might also increase the pressure on the Fed to reduce its balance sheet size. The reason that there is so much financing available for data center build-out, some of it was provided by private credit firms, some of it we are seeing signs of that in the way some of the private credit companies are under pressure. That was enabled by the Fed expanding its balance sheet and keeping interest rates low. So you can argue that it is the Fed policy that has encouraged the post-COVID capex on the corporate world, and that post-COVID capex is now starting to show in PPI inflation metrics. And the solution for that is for the Fed to start reducing the size of its balance sheet and for the Fed to take a tough stand on inflation.
Yeah, I think a great call out. I mean, some of these credit companies, I feel like it's a flag that is being ignored or maybe dismissed maybe too much by the market, because I think it is also a really important underlying story of also it's driving just overall macro weakness right now. But we so appreciate it, and really great summation of what we're seeing from an inflation standpoint, as well as just the Fed's expectations for this year, and of course, corporations and the broader margin story. So we appreciate it. Ali Melli, founder and chief investment officer and managing partner of Monticello Capital Partners. Now coming up next, it's time for Under 30, and we are looking at the big upside move today in FIGS, with shares pacing for their highest close in nearly 4 years. George Schultz will walk us through the move coming up next.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. Shares of FIGS are climbing after the company blew past the street's expectations and said it expects revenue growth in the current year, despite the ongoing news with tariffs, of course, the 15% global tariff imposed by President Trump. But joining me now is George Tillis, senior markets correspondent for the network. And so, George, a 25.4% move to the upside today. What did the street very clearly like about this report?
Well, I'll say this: I'm not surprised to see this this move in the stock. This is really a story stock. I think we've covered this multiple years ago, but essentially it's a direct-to-consumer healthcare apparel and lifestyle company. So the primary sales for their end customers are scrubs and scrub uniforms and PPE equipment for doctors and nurses and healthcare workers. But they also have a lifestyle and leisure apparel brand, as well as accessories and footwear. So the situation is that if you look at the price action in the last 5 years, it's been down. It's starting to actually look very constructive price-wise, breaking out of a 3-year trading range, and duly so. And the reason I say this, if you look at the report in terms of earnings and revenues, they were quite good. They posted 10 cents of adjusted profits. They were only expecting 2 cents, and this is important because that 2 cent estimate was near that break-even level we always talk about. And when you beat these numbers, which are already at these inflection point levels by quite a large margin, which they did as a business, you see a big price reaction. And then the sales numbers also came in well above estimates at 201 million versus 165 million. So that was 33% increase in sales. But the breakdown too of their sales shows improving, because about 80% of their total sales come from scrubs for doctors and nurses and healthcare workers. That division grew 35%. Non-scrub wear grew 26%. So a good composition into their higher margin, higher sale product lines. But their international sales, I think, were important here in terms of grew 28% year over year versus USA 11%. So you talk about tariffs at the beginning of the segment, Jenny. One way to offset the tariff impact for imports is sell overseas, which they're doing. And they increased not only their sales overseas, but total company-wide net interest margins for the quarter were 9%. And that was significantly above 3% 4-quarter averages, and earnings EBITDA margins at 13% versus 6%. So they're more than doubling EBITDA margins for the quarter relative to their 4-quarter average. And that is creating a pretty substantive move in the stock price as a result.
Okay, and is there a degree of this company being relatively insulated? Because it's to me, like, in its own niche. I'm not sure, like, the competitive threat that they face, but I mean, I do feel like this is something where if you are a purchaser of this, product from an employer's enterprise standpoint, I feel like there is a stickiness there.
Yeah, and the thing about it is it's a brand. And so if you consider the power of brands in retail, Jenny, they're very powerful. So once brands get traction, for whatever reason, they seem to take off. And that's why retail stocks, apparel, accessory stocks, in many cases, when you catch them, they actually perform better than some technology names, just because brand traction, marketing, recognition, and of course adoption by a particular cohort of people, in this case medical workers, becomes popular, and that causes pretty powerful trends in sales and earnings and improved operating leverage. And that's what I see here is really significantly improved operating leverage, and that's creating an inflation in the stock price. I mean, there's no other way to put it. And if you look at the earnings estimates for this full year, prior to the release of earnings, it was only 11 cents. Remember, this quarter they reported 10 cents just for the quarter. So that's creating a massive adjustment now in the earnings growth plus the profit growth, and sales going forward in next year are expected to be 750 million versus 630 million in the last 4 quarters. So they're expecting, double-digit revenue growth, improving EBITDA growth, and you're seeing a pretty significant improvement in stock price. Like I said to start the segment, I look for stocks that are breaking out of a basing trading range. If you look at the weekly chart on this on a 5-year level, this name is breaking out of that range.
Yeah, and having, again, a really nice move today, despite the fact that we are still lower in our 4 major averages, but a 25% decline. I mean, hitting a 3-year high today for FIGs. So appreciate it, George Tillis, for all that breakdown and a nice way to close out our show today. That'll do it for Next Gen Investing for this Friday. Thanks for tuning in all week long. Have a wonderful weekend. The watch list is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Hey Bob. Hey Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Is it time?
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We're coming to you live from the floor of the New York Stock Exchange to the corner of Wall and Broadway with a big show for you today. Of course, we're going to talk all about NVIDIA, Salesforce, and so many of the other names that reported this week. And tech, obviously, under pressure. We're seeing the NASDAQ for this month down 2.7%. Its worst month since March of 2025. Ben Emmons standing by, taking a closer look at what's happening in private credit and some of the concerns that are happening there to the overall market. And the big interview, Zscaler CFO Kevin Rubin will join us and talk all about the company's fourth quarter earnings and the state of cybersecurity, what you need to know. In the meantime, we take a quick look here at the markets. As I mentioned, the NASDAQ down for the month, down 2.7%. The S&P is also lower, down 1.2% for the month, and the Dow is right on the threshold. You know, whether or not it might be 10 months in a row of gains, but the sell-off here is weighing. The S&P's at 68.57 right now, down 52 points. The NASDAQ is down 158 points. The Dow is losing 612 points. And the small caps are down 2% today, but higher for the month. In fact, up a quarter of
604.
Dollar, right now we're looking at oil and gold, both higher. Oil's back to the 67 level. Tensions with Iran. We've heard a lot of the rhetoric pertaining from the president. Also, the gold trade there up above 5,200, so 52.65 a troy ounce of $71. 397 on the 10-year bond yield. I mean, that is a big deal. And also, we've seen mortgage rates with a 5-handle. US dollar 97.57, and the Bitcoin trade 65,630. And right now we go for the bigger picture. Ed O'Gorman's with us, CEO, CIO, River Wealth Advisors. Thank you so much for being with us. So it looks like last trading day here of February in the first 2 months.
/ES at the VWAP.
Your thoughts on the action we've been seeing and how you're feeling overall?
I think overall feeling pretty good. Looking at earnings this past quarter, really strong. Again, 5th consecutive quarter of double-digit earnings growth. Really good news generally from corporate America. What we're seeing in the market is some interesting nervousness around AI, what the read-through is on the long-term impact of AI, and certainly certain sectors really getting beaten up over that, whether it's software or most recently fintech.
Trade.
What do you think about the little bit hotter than expected PPI today?
Yeah,
did it
well, hotter than
too much
expected.
Or not really.
Well, I think the important thing about getting a hot read on PPI,
Baby, don't worry.
certainly is whether or not it reads through to the consumer and how it might impact Fed policy going forward. The expectation for Fed
time.
to continue kind of with the dovish stance through the end of the year, a couple of cuts between now and the end of the year. If we start to see inflation really sort of peak a little bit higher, that could sort of recalibrate what we expect from the Fed, which certainly could impact equity markets.
I thought it was interesting just when I was looking at different sectors. I mean, we know software has been so out of favor, year to date down 23%. And even the XLF, I was looking at
Trying
about 6% and down this month.
to
When you look at
die.
sectors, and I'll get to overall tech in a moment, but when you look at software or financials or any other sector in particular, some thoughts?
Yeah, I got some thoughts.
Yeah, when I think when you're looking
Smooch,
inside
smooch.
of technology, certain subsectors absolutely appear to be oversold at this point, especially when we're at, significant scale software service companies that are very highly integrated with their customers. I think the concerns around AI are a bit overblown in some of those pockets of the market. Likewise, what we're seeing in financials, concern over MFS, most recently bankruptcy there. Again, you tend to see the baby go out with the bathwater, and we want to look for opportunities in those scenarios to build new or add to positions.
So, what I think about here, NVIDIA, for example, you saw the reaction to the markets for NVIDIA. What did you think? By the way, I also saw CalPERS, the California Pension Fund buying NVIDIA today. I thought that was interesting.
Yeah, I think certainly, again, it's indicative of just the overall theme of nervousness around AI, and that we've seen not only NVIDIA, but of other companies really dominate the market over the past couple of years. And, the rotation out of, what has been mega cap growth into other sectors of the market. For those that are underinvested, when you get a pullback in a company like NVIDIA that clearly had a very strong earnings print, that's an opportunity to build that position if you hadn't been fully invested already.
I'm looking at Apollo, which is one of the big losers on the S&P 500. In fact, it's down 8.5% right now. We think about private credit. Why are there so many worries, and are they merited?
Yeah, so there are definite worries there, right? The worries earlier sort of started with the software concerns and the fact that many of these private credit entities are fairly heavily invested in software, or heavily funding software, I should say. And, that was sort of a double down in the fact that Apollo, among a few other entities, were identified as being holders or lenders to MFS, which, of course, just announced insolvency. So I think the concern is that it's very much an opaque market. There's not a whole lot of transparency into just what the exposures are within the private credit market. It's become a very significant piece of the overall capital structure out there, and the fact that it's hard to really get a read on where the problems might be until they really hit the main line in the front page. And so I think there is legitimate concerns because of the size of this market that if we start to see some unwind, it could have knock-on effects.
So the AI fear is mounting somewhat, at least in some parts. I'll also mention that KKR, for example, is in the worst performers today, too. That's down 7.3%. What do you buy? What are you telling people, buy this now to make money?
Well, I think for starters, again, for those that are underinvested in some of the tech AI, larger cap software, this is probably a pretty good buying opportunity. But for long-term investors, I think it's all about staying diversified. So, if you were in some of these mega caps tech names that have really had outstanding performance, ideally you've been trimming those positions and rotating into other sectors of the market. I think in the intermediate term, expectation is that the rotation continues, that more cyclical parts of the market, staples, industrials, utilities, to some degree, parts of the market that are going to really benefit from this significant capex coming out of the AI.
Three black crows
are likely going to be more stable places to sit and hopefully appreciate some gains over the coming months.
Ed O'Gorman, thank you. River Wealth Advisors, good to see you, Ed. Thanks. So some of the big stories we continue to follow. Kevin Hinks is joining me, host of Fast Market here on
685s.
So you're looking at Block. Good news, at least for the stock. We saw the stock moving off the arrow, but this big layoff.
Buy
some people who are
for
questioning
Mara.
about it. Your thoughts?
Tuesday, Monday.
You're right, Nicole. It's good news for the stock today. I don't know if it's good news for the long term
685s.
of the company, but cutting your overall headcount from 10,000 by 4,000 people, that can't be a great day for the company. Now, their chairman claims that this represents, an AI-driven productivity, arguing that smaller intelligence-native teams can operate more efficiently. So he's justifying that AI is creating this. Now, does that plant the seed of uncertainty in other firms that may need to lay off, or is this a problem specific to a company like Block that really has a bit of a checkered history, although their cash app actually put up some record numbers in the last quarter? So trying to figure out exactly what this means for a company like used to be Square, right? Used to be SQ. Now they named it Block. Now they changed their call letters to XYZ. It's really hard to get a constant theme or consistency from this group. So yeah, this is certainly a relief rally in the underlying shares. Not sure how good it is for the long-term health of the company, though, Nicole.
Yeah, and the question is how many jobs will be lost due to AI? While some are being created, right? There have been predictions ranging from, I just looked it up on my phone, displacement of hundreds of millions of jobs globally by 2030 to 35. Some forecasts suggest a net positive in job creation. Any thoughts on it?
There's always changes in job. The one thing we can count on in our lives, Nicole, is change. I'm on this program talking to you because trading floors closed down, right? When trading floors went electronic. So there's always changes in the business cycle, and jobs that are lost create new jobs that are created. So there's always going to be that change, but there is rampant fear that they will create big layoffs like you see in Block. Now, I don't know. We don't know if this has more to do with the health of Square as a company, or is it AI driven? It's hard to figure out, Nicole.
Yeah, understood. So you're watching some of the tech stocks here. Take a look at that. What are your thoughts?
It's an interesting, there's a fascinating day setting up here in terms of a trading perspective. Right now, Nicole, 7 of the 11 sectors in the S&P 500 are higher. 7 of 11. Yet, the S&P is down just under 0.8%. But the next place your eye should go is the equal weight. Equal weight's only down about 0.25%. So there is, the problems, information technology, such a big swath of the S&P 500 is lower, and financials are lower, Nicole. And financials, it's really showing weakness. When you look at the financials, it's really showing weakness in the banks and the capital markets. Insurance is doing okay. Financial services is doing okay. But those two sectors within the sector of banks and capital markets are getting creamed today. And then obviously, there's some very big names in that. There's JP Morgan, Bank of America, Wells Fargo in the banks. There's Morgan Stanley, Goldman Sachs, BlackRock, all these other names in the capital markets that are getting hit hard today. So interesting. It's the information technology that's heavy, and it's financials that are really heavy today.
Yeah, I mean, I mentioned those financials from early this morning. I think that's been a big story. A lot of folks have financials in their 401ks and IRAs. I saw Bank of America a short time ago down about 5%. It's its worst performance since last year for a single day percentage sell-off. So it really shows you that these financials are getting pretty much hit hard, down over 2% this month and down year to date 6% for the XLF. Kevin Hinks, great to see you. Thank you so much. Coming up next, Options Corner. Rick Ducat is standing by, and he'll highlight the unusual options activity from the day and how investors are looking to trade on recent news of Netflix, Dell, and MetLife. We'll be right back.
experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. All right, last trading day for the month of February. It's going to be March when we get back here, okay? It'll be spring. Let's talk about what we're seeing in the markets. I want to get to the unusual options trades that we're seeing. Rick Ducat has those lined up for us. But first here, Rick, good afternoon to you and a market thought.
Rick. Yeah, good afternoon. An interesting, tumultuous day to be sure.
Tumultuous?
To conclude our last trading day.
That's a tough word.
The obvious big news is the Netflix.
Tumultuous.
Paramount Skydance wrangling here over Warner Brothers. We'll talk about that more in a minute.
2 hours to install,
And the interior even despite some of these big swings, the ES, the S&P 500 futures haven't really taken out any significant lower levels here.
Fully finished, including two-bedroom.
I guess a bit that the Russell futures are down over 2% at this point, as small caps are generally
a living room, a bathroom, and a kitchen.
Kind of way to look at things here. But VIX just shy of 21 now as well. It should be a pretty interesting start to March. We can see that March 20th, a big options expiration month here as well, coming up soon in the horizon. So a lot to think about going forward.
Yeah, the VIX is up 11% right now. I mean, it shows this elevated level. We'll have Apple on March 4th, right? Some news there, their big event, and also waiting on the mini Mac and AI, agentic AI. So there are some things to look forward to. And of course, lots of geopolitical stories brewing. Let's get to more on the Warner Brothers, Paramount, Netflix story, because you actually found a trade pertaining to that.
Not just a trade, a big, huge, giant, two trades actually. And when we think about it, obviously that's one of the big stories of today. Netflix and Paramount, both two of the top movers in the S&P. Despite one winning and one losing, Netflix does seem to have perhaps lost at this point here, but still number 4 gainer in the S&P. And I'm kind of starting to wonder almost, is this like a Pyrrhic victory for Paramount? It seems like they've paid a very rich, kind of handsome price for Warner Brothers to the tune of $111 billion here. Netflix has been so badly beaten up recently. Now we're getting this kind of relief bounce here. They also get to walk away scot-free with an extra $2.8 billion breakup fee from the deal. Meanwhile, Paramount is finding itself with, the owner of something that hasn't exactly been doing all that great either during a time of extreme disruption for everything involving tech. I mean, we haven't even really considered what effects generative AI could have on the movie industry. I don't really like the thought of that. But I mean, it's here. It's going to happen one way or the other. So it's a lot of big question marks here during this very major acquisition. Nonetheless, I mean, the trading has been extremely interesting. We saw huge trades in Netflix recently, massive volumes, massive dollar amounts. Today is perhaps one of the biggest ones of all that I've seen. It's 2 separate trades done at the same time, minus 90,000 August 21st, 105 call, and also at the same time, minus 90,000 August 21st, 125 strike call at a net credit of 774. So this equates to a $69.6 million credit received here. So really, really, really large numbers here. Max loss potentially could be unlimited if these are indeed naked short calls here. The stock could go theoretically up to infinity and expose you to these extreme risks here. If it is a covered call type of position, though, combined combined with an existing stock position, that would be a very different story. That would be much lower of a risk outlook for that type of trade here. The break even, 112.74 for both of them put together, about 18.7% to the upside. The expected move for this time horizon, which is about 175 days out, about 23% roughly. So the break even is within that range, but it's kind of at the upper end of that area here. So this is a trade that would be more of a higher probability setup here, looking for it to just kind of stay below that break-even level. These types of trades are more of a softer target where you don't need a big push beyond the break-even price to get some profitability beyond the debit that you paid in the case of a long options or long spread here. In this case, just kind of looking to establish a ceiling after this rather momentous news we've seen today.
Yeah, and look, I saw that now it's being reported to Reuters, by Reuters, that Paramount is expected to get the EU approval for the Warner Brothers deal with ease. And that was one of the hurdles, I think, for Netflix, was that we're going to combine the #1 and #3 streamers. And, there was some concerns about regulatory approval. That was at least one part of the story. Very interesting. And Netflix, as you noted, a nice day here, up 13%, and also resuming the repurchase program. Some extra money flying around now, so they could do that. Let's get to Dell. I mean, when we think about Dell, which is up more than 10% today, just the AI hardware demand helped to boost things, huh? Tell us about the trade.
Yeah, #2 mover in the S&P today. Big push to the upside here, taking out some notable previous high points. And what does Dell do? They make PCs and laptops and other computer hardware. Kind of a difficult time for that particular space because AI companies and the related industry is snapping up all the available chips and memory that are out there. So it's kind of putting the squeeze on everything else here. Consumer prices for this type of equipment is going up rather markedly here to deal with the increased demand and supply crunches that we're seeing here. But on the other hand, this is actually perhaps even better news for Dell, though, because despite the negative headwinds in that area, Dell saw incredibly strong demand for its AI servers. We saw that they had a $43 billion backlog here for some of their technology. So a very interesting situation that's kind of the good is seeming to outweigh the bad for this particular company. So price opened up for the day around some old highs near about 140 or so. They've so far held on. Bank of America analysts noted stronger than expected guidance. They raised their price target to 155 from 135 and kept their buy rating. We also saw Mizuho raise their price target today, 180 from 175. They kept their buy. Piper Sandler are kind of the odd man out today, though, in terms of sentiment. They actually cut their price target, 167 from 172, while keeping their buy rating. So kind of an interesting mix of analyst coverage today. So now the trading question, another short call trade here, minus 2,500, April 17th, 160 strike calls at a 475 credit here. So again, neutral to bearish outlook, looking for a ceiling on the price activity. That 160 strike price matches up with an old gap level that we saw near the highs from November 4th, I believe, early November here. So it's seeming to have its eye on that general area for a ceiling, perhaps for the gap to be filled even, but not fully make it beyond that level. The trade in question, $1.1 million credit received here. Again, max loss potentially could be unlimited theoretically there. Our break even, 164.75, about a little over 11% to the upside. Expected move does encompass that range, 14.7% during our 49 days till expiration here. So a shorter term trade than our previous one for less money as well, but still, a big trade. It can be kind of you can get a skewed sense of the dollar amounts here when we talk about some of these massive trades here, but anything over $1 million is pretty noteworthy for most stock symbols here. This trade also was about 1% of the total market here. The sizzle in Dell today relative to its 5-day moving average of options volume came in at 8.2, so very heavy activity.
what a difference between hardware and software, right? I mean, we talked about AI demand for this hardware and the revenue growth of 34% and the move here of 22% for Dell, as you noted, a best performer in the S&P 500, second best performer. It's just great, pretty unbelievable to see this nice move here. Let's get to MetLife. Your thoughts?
Yeah, insurance company here, and not really a ton of specific news. We did see a price target cut from Wells Fargo recently here, but other than that, it was pretty dry in terms of any interesting news coverage. But you know, the trades that we saw were very outsized for this symbol here. We saw it was a straddle type of trade, plus 5,000, January 15th, 70 strike straddle. So buying the 70 strike calls and buying the 70 strike puts at the same time at a total net debit of 1647. So a very big premium paid for this one as well. $8.2 million debit paid would be the max loss for this trade. And this is one where you would need a big move in either direction here over the course of a little under a year here. The break evens are 53.53 and 86.47 here. So looking for a push beyond either of those boundaries, you would need a bit more of a move to the downside. That's about 27% away. Meanwhile, the upside break even is 18.5%. Either way, though, expected move during that time horizon, according to the options market here, about 27% plus or minus either direction. So it would need a bit of a push to get through that negative break even. The positive upside break even seems more probable at this time here. But this trade in question, 10,000 lot, if you put the two legs of the option together, only about 22,500 options traded in this symbol at the time I checked here. So this trade was 44% of the total market. The sizzle 6.2 shows a very elevated activity in this symbol that's a little more quiet.
Look, I mean, as you mentioned, the winners on the S&P 500, I can't believe that Paramount's up to 23% right now. That's a huge move. And Dell, which you talked about, up 22%. Block, Netflix, AES, Autodesk, Lennox are among the other winners. Great to see you, Rick Ducat, on Options Corner. Thank you very much for a look at those names. Coming up, we're looking at the impact that private credit really is having on the market today. Ben Emmons is standing by from FedWatch Advisors. Why it matters, the exposure that names like Apollo and KKR and Blackstone, what exposure do they have to tech, and why is the group under some scrutiny?
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green. I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back. the watch list. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange, and we have a lot of movers to take a look. Southwest Airlines, in fact, TD Cowen upgrading Southwest Airlines to a buy, hiking the price target up to $66, up from $50. The stock's at $49 right now. The analysts expect Southwest to raise its guidance next quarter thanks to the strengthening demand in the airline industry. Then there are shares of Duolingo. Those are plunging down 17% or so, and earnings, which saw decelerating user growth, are weighing on the stock. It's a language learning company and said it will now invest more in its free tier of service with hopes it will reach 100 million daily active users by the year 2028. The stock is down about 80% from its all-time highs. Love to talk the big picture, and great to have with me our next guest, Ben Emmons, CIO, founder of FedWatch Advisors. So glad you're with us because there's so much talk about private credit and the worries. I mean, you're seeing Apollo and KKR and others to the downside. It's the exposure to AI, I believe. I mean, what do you think is happening here? Is it a big deal?
Hi, Nicole. Happy Friday. Yes, it is somewhat of a big deal, I think, by now. You know, for a couple of years now, there have been sort of tentative signs about that in these private credit pools, there were some impairments happening. But it was always sold like to institutional and retail investors like, well, this is really stable. We have private equity firms that are backing these loans, so there's much more control over payments of those borrowers. And therefore the default should be very low. But what we're seeing right now playing out the last few weeks, and in particularly this week, is you're getting one after the other coming out with that they either have a markdown in their portfolio, or they're falling behind on payments in their portfolio, or they're dealing with outflows and redemptions, or they're having even to deal with other lenders that are subject to fraud, like what's happening in the UK overnight. And suddenly the picture starts to emerge of this is a bigger credit issue than perhaps thought. And it's sort of playing in the markets now alongside the software AI story that we every day see, whether that's the software companies itself or the impact it could have on future employment. You tie the two and two together. If private credit starts to become very challenging, and it does finance a lot in the economy, and we're having already an employment uncertainty about AI, yeah, you're getting the macroeconomic effect being priced in. I think that's why the banks are down today, all these cyclical stocks are down, exactly for that reason.
Yeah, they've been down. I mean, the banks have had a tough time of it. You know, and we think about the loans. What kind of loans specifically are you most concerned about?
Well, actually, three types there. You know, there's, I guess, in this space too, some kind of financial engineering, right? Meaning they offer to people payment in kind loans, which kind of gives you the option to not pay interest for periods of time, kind of like what happened in mortgages. But they also have these loans where they combine lenders together in one loan called dual tranche or unitranching. And although that can work in the good times, if things change, some of these loans are becoming problematic. So there was a statistic out the other day that the payment in kind loans, big loans, right, basically fallen in arrears up to about 10 to 15% of the total big loans outstanding. That was kind of a scary statistic. So the private credit loans are really what they are, private loans. You know, you and I could get a loan like this and start a company, but that it's also about like that you're having borrowers who are either companies that are very cyclical, or you're dealing with these like particular sort of specific loans like payment in kind. And I think this is the risk from here, that we're getting more stress seen there from there.
You know, and so much of this also has to do with software, I think, right? It's part of the software story. Is that right? So is it similar or different than 2008? I mean, when I think about 2008, I mean, that really was all those subprime mortgages that were supposed to be backed. They were basically loaning money to folks so everybody could own a house, and saying, oh, look, yeah, I know you're a high-risk person, but we'll call it subprime. And that's where the whole, you know, thing blew up. I mean, that was a big part of it. Is this similar or different? It sounds different.
It's definitely different that way, because one, we don't have subprime lending itself in private credit, fortunately. That's not happened yet. And two, as you mentioned, it's more loans to companies than individuals. But there is other similarity that's about these specific types of loans. Like in subprime, you had like interest only, and negative amortization loans, those sort of like financial engineering, that eventually became a problem. Right? People fell behind in the loan payments, like we're seeing slowly playing out in private credit. But the other difference obviously is that subprime loans were securitized to put in CDOs and all kinds of other structures. That's not happened here with private credit, fortunately. But that being said though, private credit industry itself is about $1.5 trillion, and they've lent to companies that employing about anywhere between 100 and 1,000 employees. The estimation is that they've created about 1 to 2 million jobs by lending to companies. And that's, I think, where the macro risk is, Nicole, when you're getting more stresses in private credit, there'll be less of that credit extended, and it could affect actually employment. That's where the similarities between subprime and private credit that way, because when people fell behind on subprime, yeah, it caused a huge amount of unemployment. So that's why I'm worried about that. It could become a bigger macro effect.
And look, just quickly now, what's your advice to investors here? I mean, so much is being spent on AI, and that should then, you know, help with GDP and productivity and even jobs to a certain extent, that companies should feel better. Fundamentals and earnings have been pretty good. What's your advice to investors today?
Yeah, I think you shouldn't paint the private credit industry with one brush, right? There's definitely really good companies out there that actually have good control over their lending. So there's always winners and losers. So I won't just bail out of private credit altogether if you say you've invested in a private fund or even in one of those ETFs. On the other hand, as you mentioned, like there's a lot of positive underlying trends happening because of productivity investment. And we're seeing it playing out. So I think the industrials, the staples, the materials, and the energy sector are really the sectors, I think, that have a leadership for the economy this year as all those investments happening. So I would stick with that part of the market, which is outperforming clearly the cyclical and the technology AI sector.
All right, Ben Emmons, FedWatch Advisors, thank you. It's great to see you. Really appreciate it. All right, coming up next, we have the CFO of Zscaler to talk about the solid earnings that the company saw, the outlook for cybersecurity, the watch list. We'll be right back.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. A lot of action here. We have a player from the New York Giants, guests visiting, and stocks are to the downside as we wrap up this month of February. In the meantime, Zscaler in focus. The company really had a solid quarter, beating on the top and bottom line. But what's with the outlook, and what do we need to know about cybersecurity? That's why we bring in Zscaler CFO.
That's why.
With us. Thank you so much
Again, you're
for
smart.
being here today. So it's really been a solid quarter for
I
you.
love her.
How does the outlook look? I mean, what went right for you in the quarter, and does that translate into the new year? Because there are some concerns that maybe guidance is a little lower.
Yeah, thank you for having us. It's a great opportunity to talk about the quarter. We're super pleased with the results that we put up for the first half of the year. Some proof points in terms of performance. We grew revenue by 26% year over year. We grew ARR by 25%. We put up a record level of operating income for the period.
Record level.
And we are one of a very few number of elite companies who have
Elite.
consistently exceeded the rule of 40, which just demonstrates our disciplined approach towards
Disciplined.
growth. So we're very excited with what we saw in the quarter. We saw a record number of large deals for a Q2 in the quarter, which
I didn't see any.
Representation of the strength that we've seen in the business. Sales productivity has continued to improve.
Liar.
Which is also something that we look at internally to gauge confidence in how we think about going forward. Our net new business for the first half of this year, excluding the recent acquisition of Red Canary, was up 10%. And that compares to 1% last year.
Whoa.
And when we look at guidance, to your point about looking forward, we actually raised guidance and now expect net new ARR to be 9.5% for the year. And that's up from 6.7% that we originally guided, excluding the contributions of our recent acquisition of Red Canary. So I think there's a lot to be really optimistic and positive about.
It is.
Yeah, tell me more about raising guidance. I just need some clarity there on that.
Yeah, so
we raise on.
So we raised across the board. We raised our expectations for
How'd you get away with that?
ARR and operating income, which are the three metrics that we look at. We also raised free cash flow expectations and margin for the year. So as we position ourselves for the second half of our fiscal 26, we feel really good about what we're coming into.
Right, understood. I mean, really, I think you had demand across all your metrics, right? I mean, it was broad-based, your demand, was it not? Cybersecurity is so important more than ever. How so? Where did you see the most demand?
Yeah, so for sure. I mean, we have seen continued threat escalation. And one area in particular that we're spending a lot of focus on is AI, right? You start to think about the impact that AI has and agent-to-agent communication as that proliferates across organizations. You need a way to be able to securely enable those communications. And we strongly believe that zero trust, inline communication across our global Zscaler Zero Trust Exchange is the only way to really securely, at autonomous speed, be able to secure agent communication. You're not talking about user-to-user interactions that are at human speed. You're talking about a mass explosion of communications that are happening at autonomous speed. And so that's very exciting. We had a big launch earlier in January on our AI offerings and how we're looking forward. And there's been a real lot of interest and demand as we move into the back half.
Yeah, let's talk about the, growth, organic growth and growth through acquisition. You talked about some of the past acquisitions. You have SquareX. Do you plan to continue to grow in that way, where it's through acquisition and less so through the organic growth? And which is okay with me. I'm not saying one's right or wrong. It's exciting that you're able to make these acquisitions. Tell me about the growth prospects.
Yeah, so if we just look at the inorganic business, we have continued to see 20% plus growth organically, and that is a core focus of us. We have historically looked at M&A as a way to accelerate roadmap and identify leading edge technology to incorporate into our larger platform. And that is a lever we will continue to use as we look forward. We've done 3 acquisitions this year, SquareX being the most recent, and it really is a great opportunity for us to expand the breadth of the platform.
So tell me, last but not least, the competition, the cloud security industry. I was just seeing the thousands and thousands of attempts. It's sort of scary. What's your competition like? What sets Zscaler apart?
Yeah, I mean, Zscaler is by far the largest security cloud in the world. We operate 160 plus different data centers across the world, inline communication, which is uniquely different than what traditional legacy vendors offer from a cybersecurity perspective. And we do so inline. So we get to see traffic, we get to inspect traffic, and that gives us a very unique and very sizable telemetry set of data. We operate over 50 billion transactions a day, which is more than 20 times what Google searches in a given day are. So we have a massive and unique proprietary set of anonymized data that we can use to help provide significantly better security. We haven't seen a notable shift in the competitive landscape. As I mentioned on the call, our pipeline conversion actually was significantly stronger in Q2. We also have stronger visibility as we go into the back half of the year in terms of pipeline and what that looks like. So we feel really good about where we're sitting competitively.
All right, so a solid quarter, raising the revenue outlook. Kevin Rubin, great to see you, CFO of Zscaler. Thanks for being on with us. Come back with some updates soon. Thank you. Coming up, let's talk about inflation, the economy, the PPI that came in a little bit hotter than expected. What is the Fed going to do this year? And Kevin Walsh in particular. The Watchers will be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm
Sounds
Joe
perfect.
Biles, live from the New York Stock Exchange. When the market moves, we're on it.
We're just not
Getting
moving
the
nowhere.
The strategy and sentiment in real time. Stream Schwab Network
Meta.
at schwabnetwork.com.
Retouch support again. 638.23.
Welcome back to the watch list. Time to take a look at today's PPI print. Our panel is ready. Joining me right now, Elena Yateva, Senior U.S. Economist
Let's talk
at the
about it.
Conference Board's Economy, Strategy, and Finance Center, and Ian Wyatt, Chief Economist at Huntington Bank. Thank you both for being with us. Elena, your thoughts here.
Well, I think it's pretty clear. Today's numbers were hot, and we do see the pass-through of inflation into, into a broader economy. We do see the pass-through of tariffs into a broader economy, and I think that will continue.
You know, when you take a look, we were having a conversation earlier with my friend Kevin Hanks, and we were saying CPI, PPI, wages, PCE. PPI always seems like the last in the line of the four. Ian, what are your thoughts?
Yeah, I think people really need to focus on the PCE piece right now and why that's different than CPI, because for what are you looking for? You're trying to figure out where interest rates are going. And the difference is CPI is much more heavily weighted in terms of housing, much lighter on healthcare. And as we saw in this print, in the PPI report, which includes some of the medical care, a lot of services driven inflation. It's a little less goods driven inflation. And we're seeing housing inflation coming down. So likely we're going out for a while. We're going to have the CPI tracking under PCE inflation. So PCE, although everyone thinks about CPI, PCE is going to be the one that really matters for the Fed, what they focus on the most. And that's still well above their 2% target.
You said you still think they're sticking to 3 cuts, Ian. Is that right?
I'll say second half of the year at this point. I think our initial idea this year was probably maybe one more cut under Powell. At this point, we do see softness in the labor market. So we think that the Fed historically, whether it's a couple of these September moves where they've waited and then moved in September, we saw that for the past 2 years. They basically waited until September both times and then instituted a few cuts. I don't know if they wait all the way till September. We get, Warsh in there. You get a little more dovish mix in the board, but and there is still softness in the labor market. But right now, and we have the other thing to keep in mind, we have a lot of stimulus from the tax bill hitting the economy right now this quarter. So you add that up, it's a little hotter right now. Inflation's a little hotter. You're going to get a little bit of stimulus. The job numbers in January were pretty decent. That isn't really adding up to a picture of more cuts, especially when the Fed has signaled pause. What gets them off pause is something really shifting this dynamic.
Elena, are you focusing on jobs, the K-shaped recovery that may be happening? What say you?
I would just echo Ian's thoughts, and I would just say that, the labor market is doing okay. It's in a fragile state of balance. I would discount the January payrolls report, though, and even the household survey numbers, because the response rate was pretty low, and there's a lot of seasonality in January numbers. What I would like to see is the February report, which is coming out next week, and as Governor Waller suggested basically in the beginning of this week, is that the Fed will need to see what happens with jobs numbers in February to make a better conclusion about what's going on with the labor market. Because again, the January number was pretty interesting, and I don't think it was very reliable. On balance, we also think that a couple of cuts could be possible towards the end of the year, but it will depend on the data. And right now, with the numbers like that we saw this morning, I don't think it's possible. I think that inflation will continue to rise, at least in the first half of the year. We actually conducted a survey in conjunction with the Business Council at the Conference Board, and 71% of CEOs report higher costs from tariffs, and 44 of them are passing those costs on to the consumer. So the tariff story is not over just yet. I think we will see a little bit more inflation before it starts fading towards the end of the year.
Yeah, interesting. And we'll wait for that jobs report next Friday. I mean, for example, Challenger had the big layoffs that they had announced and had gotten in. But as you said, you're waiting for the February report, which will come out on next Friday. Ian, what do you say about, how people are feeling and the tariffs? Really, I mean, there were a lot of people who have come on and said, look, the tariff story is sort of over. We're looking forward. You have the one big beautiful bill. You have fiscal and monetary stimulus. You're going to get some tax returns and things like that. What say you?
Well, I think one thing to keep in mind with inflation, tariffs, all those things is one of the big changes we've had is really immigration policy. And, the decline in immigration we've had really is feeding into, say, lower housing inflation, but we also have a relatively tight lower end of the labor market. If we look at services, if we look at, where is the inflation happening, it's largely at a services-driven inflation dynamic right now. It's a weird dynamic. We're not adding jobs, and to add to Elena's point, we really didn't add any jobs from April through December last year. so over the past year. So January really did mark a departure. We'll see if that's sustained or it gets revised out. Obviously we're early on in revisions, but we had an 8-month plus period with no job growth in this country. So that's really, pretty slow labor market. At the same time, when I talk to employers, what I'm hearing, it's tough to find workers still for those lower end jobs. We're still getting some pass through in inflation. And yes, companies are feeling the ability to raise prices still on the services side. And that's what we saw in this report too, in the PPI report. Goods inflation was up, but services inflation was up more.
And, I also continue to think about private credit. I know that some of the financials are, talk about de-risking a bit, but financials have been down, and that too could be something that plays in to the markets or overall sentiment and things like that. Yelena Shoyeteva and also Ian Wyatt, thank you both for being with us. Appreciate it. I'm Nicole Petalides. So glad you're with us every single day here on Schwab Network at 9 a.m. and 2 p.m. I see you every single day. Keep it right here. Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is if they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with
2 more minutes
accuracy and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Good afternoon, everybody. Happy Friday. We made it. It's 3 p.m. here on Wall Street, and this is Market on Close. I'm Sam Bartas, coming to you live from the floor of the New York Stock Exchange.
So let's take a look at what is coming up on today's show. We've been very busy here today, so we will check in on CoreWeave after shares have fallen 20% in reaction to its latest earnings. We'll break down the report and see what lacked this quarter. Later, we'll be joined by the co-founder and CEO of the LiDAR company Ava after its latest quarterly report. And we'll check in on the gold and silver trade as the metals have rebounded from their January correction. But for now, let's take a look at where markets stand with about an hour to go here. And obviously, we have some more risk-off tone in these markets. Some of the credit risk concerns and AI disruption fears very much weighing on things today. Obviously, we got that hotter than expected PPI report as well. So the fact that wholesale inflation and the producer prices are hanging around for now seem to be really adding to the concerns that were already in these markets. And so we're seeing the Dow Jones taking a leg lower by 1.5%. We've shed about 720 points now. Suffice to say, we have come off the session's lows, but we are still seeing a sea of red out there across our major averages. The Russell 2000 down 2.3%. But it's not all bad. In fact, if you take a look at the sectors, some of those are green as we see more of a defensive trade, your healthcare, energy, which is at an all-time high, as well utilities. Here are the futures products. The big story for us today is a lot of the concerns obviously leading to a bond rally. We've got the 10-year yield sub 4% right now. So of course, this coming despite the fact that we got a hotter than expected PPI print. And of course, this is coming as we do see some of these AI and credit risk concerns in the market. So no doubt, a little bit of a flight to safety as we can see here. US dollar index has shed a bit. It's pulled back slightly here. We're at 97.56 on the Dixie. Gold has been a big story, as I mentioned, as we continue to track this flight to safety, very much up 1.5% at 52.69. We'll discuss some of that trade, the reasons why, obviously, behind that later in the program. We are dealing with geopolitics as well in these markets. So that is, of course, why we have seen this pick up in oil today. We're at $97 a barrel, up almost 3% in trade right now, coming off the back of US-Iran talks, which was said to be positive. But of course, we are monitoring that situation in the Middle East. Not to mention, we've had the tensions flaring up between Pakistan and Afghanistan, weighing on things a bit. And of course, we keep tabs on OPEC Plus, whether they will indeed resume production post Q1 in April. We're keeping an eye on that meeting as well. We continue to see Bitcoin struggling today as well, down 3% at 65,000 and change. So we do have some caution in these markets, given everything I just mentioned, obviously with the financials under some pressure as well. I mentioned energy at an all-time high, but that is, of course, what we are dealing with as we see a more defensive trade for this Friday to really cap off what has been a very busy month here. Obviously, we have a lot of earnings to get to as well, so let's bring in Jenny Horn now for some of today's top movers. Very good morning to you, Jenny. Before we get to some of these earnings, let's talk about what we could say, hopefully, is the grand finale to this drawn-out long season of, twists and turns here. Just talk us through this Paramount story, winning this bidding war for Warner Brothers.
Yes, and what is it? Kind of a shocking move. I guess not if you were looking at the way Netflix was pricing in some of the expectations this week, because Netflix has been on a run. Frankly, so is Paramount actually now, as Paramount is our best performing stock, at least as it stands in the S&P 500 so far this week. But the takeaway is, Netflix is being rewarded, and this is being seen as a strategic reset, not necessarily a failure. So Netflix, of course, declining to match Paramount's guidance is $31 a share, all-cash bid for Warner Brothers Discovery, calling the price no longer financially attractive. Netflix does still walk away with this $2.8 billion breakup fee, which effectively monetizes a deal that it didn't even close. It was seen as like the loser and still does get that breakup fee, but the market is clearly rewarding Netflix for not becoming one of these legacy studio operators and really resisting that more debt-heavy, politically complex merger, frankly. Now, on the other hand, Paramount is still also a big winner of the session, and of course this week and now this month. So Paramount is betting on the future of the company on scale, as well as the IP and further consolidation that's expected to come from this deal. Their bid does value Warner Brothers Discovery at roughly $111 billion, far above Netflix's roughly $83 billion in assets-only deal. But this does now include CBS, CNN, HBO, DC, Warner Brothers Studios, as well as TNT and TBS. and of course then Paramount's own assets. But it's a transformational deal for Paramount, which is definitely being seen as a positive, especially following some of their earnings that gave a lot to still really hope for as far as their legacy TV business, which is just flailing. So is actually Warner Brothers, frankly. But execution risk does still remain high, so the potential payoff is big if we do see this synergy materialize.
Well, we break the 200's the question.
Warner Brothers did determine that this was a superior proposal from Paramount Skydance, which then of course forced the hand a bit of Netflix. But I was reading the deal could be far from done, not to add another leg to this saga, but combining two major studios and two major streaming platforms and two major national news organizations like CBS and CNN does guarantee that we'll still face some intense antitrust scrutiny.
That's right, baby.
Paramount is seeing, of course, this HSR waiting period expire. DOJ, as well as state AGs, more notably in California, and international regulators still do loom, and so that is going to be still more of a 12 to 18-month story, although it has been seen as a bit more of a legal-friendly deal now with Paramount, and as we know, the Ellison family
Tesla's
is very
flagging
close to
out.
the Trump administration, at least they have been. So that was seen as a bit more favorable, but I don't know if it's over yet because of, again, antitrust concerns. But as far as at least the intense scrutiny over the bidding war, we've at least closed, at least for now, that chapter, Sam.
Yes, you took the words out of my mouth. I don't think we're going to be seeing this story go anywhere anytime soon. I think, we're going to be talking about it for quite some time, but at least, this part of the saga, at least this season, has come to an end. But let's move on to some of these earnings. Obviously, the tables seem to have turned because I was talking about this company on your show, Next Gen, earlier today. But just talk us through Dell, the reaction, what you've seen from certainly the analysts and what they've been saying.
Well, yeah, I mean, this is one of the strongest reports we've been able to discuss this week. So, I mean, Dell really coming out of the gate, exploding as far as their AI server demand was concerned. And it really has emerged as one of the clearest and really most, I'd say, up in front now pure play enterprise AI infrastructure winners with record backlogs, accelerating earnings, and improving margins. Their AI optimized server revenue surged a whopping 342% year over year. Dell exited the quarter with a record $43 billion in AI server backlogs and $64 billion in AI orders booked now for fiscal 2026, which gives unusually strong visibility for a hardware company. They saw a massive beat and raise quarter. I mean, margins did hold up better than feared. And aggressive shareholder returns also signaled for their confidence as they did announce this 20% dividend increase and roughly $10 billion worth of expansion.
Well, you can't beat that.
AI revenue is also expected to double yet again in fiscal 2027. So they guided for AI server revenue to be roughly $50 billion in fiscal 2027. That was roughly up 100% year over year. As far as maybe some of the risks and some of the concerns amongst the street,
we're both the cloud
a concern
on
for
spy.
memory and component price inflation. That was not
We're at resistance.
necessarily completely dismissed by management. And AI servers still do carry
We're at the 200.
execution risk. There's supply tightness as far as GPUs, memory,
Boom.
and networking, and that does still remain highly dynamic. And so an environment that we
Just
can
like that.
change, obviously, just even overnight. Their client and their PC business is also still not a growth engine as their consumer PC revenue was flat year over year.
Yeah.
But execution, supply strains, and cost inflation are still major risks for this company going forward. But I mean, applause across the board. It's hard to find what not to like within this report when, again, this was fairly, I'd say, certain that this is seeing at least Dell emerge as this AI server real winner, which has been nice to talk about some of the strength in AI instead of just some of the falling momentum. And obviously that momentum is just being rewarded to some and not others. Dell, a definite winner today.
Yeah, the analysts heaping praise on this company in their notes for today. I mean, I think it's, one thing to say that you've got other parts of the business to lean on to mitigate some of the challenges in memory, but it's another thing to actually come up with a solution rather than just state the problem. And I think that's what's being rewarded here as well, is that they've actually come out and said, we're trying to work with the suppliers to find a sort of flexible and agile way to address all of this as well. Moving on to obviously another earnings report, catching a lot of headlines today for a different reason though. Block is rallying as well, but it's funny because we started the week off talking about that Citrini report, which was fictional, but it did talk about job losses. And here we are with somewhat of an example citing AI. Just talk us through the reaction in that story there, Jenny.
Yeah,
685s are at
trading report
303.
Because I think that echoed a lot of fears that are being somewhat underappreciated by the market right now. And then we saw it, I mean, evidence just in real time from some of the statements we got out of Block. And so hearing from CEO Jack Dorsey posting to shareholders and also taking to social media to disclose that they basically were showing this difficult decision as a company, reducing Block by nearly half from over 10,000 people to just under 6,000, which means that 4,000, of course, are being asked to leave, saying that the core thesis is simple. Intelligence tools have changed what it means to build and to run a company. We're already seeing it internally in the significantly smaller
Jim, your
teams.
taxes are
These
done.
tools they've already been building can do more and do it better, and intelligence tool capabilities are compounding faster every week. And so, well, I can understand the efficiency play here and the fact that they are able to utilize, I mean, the increased technology, and this is exactly what, I mean, like the back end of AI is hoping for. It does also raise a pretty major concern over, you know, what this means for other companies that say, frankly, are also being strapped for cash and not seeing the same growth metrics. I mean, is like this the answer to then just trim your workforce and operate more efficiently? Then what does this mean for like broader labor numbers? I mean, I think this does raise really major concerns. So, I mean, they did see still from the financial report, I mean, like 65 cents a share for earnings that did actually beat slightly, or slightly in line, I guess you would call it. Quarterly revenue, though, did come in slightly lower than what had been expected by the street. But I do think
685s are 320.
40%. I mean, we talk a lot about, you know, 5 to, I'd say, around 15% workforce reductions. And obviously the size of the companies take it into consideration, but I do think this just raises a bigger conversation over, like, adding AI to the workforce comes, but at what risk? Because these are real
Come
jobs.
to a double top.
4,000 jobs that we're discussing that just fell off the table. And frankly, it does, again, really question the role of AI in the work world. But Street rewards this because it's an efficiency play.
I bet the
Does not
SPX
change
paid a
that
lot
the
more.
fundamental story of Block has remained fairly challenged for years now. This does not really change any of those financial metrics, frankly.
Yeah, I mean, I suppose the market just wants to see what happens next as far as how they're going to pull it off as well with respect to some of the efficiency gains too. And Jenny, our laggard for the day heading in the complete opposite direction is Zscaler. Just talk us through what happened there, what did the report say, why are we seeing this sort of reaction?
I know, so a pretty blistering move to the downside in Zscaler today. And I will say that they still do have a best-in-class cybersecurity platform with elite margins, really strong AI-driven demand, and deep enterprise penetration. And so a clean beat across revenue, earnings, and annual recurring revenue. Profitability and efficiency.
Yabba dabba doo!
High levels. Their non-GAAP operating margins are 22%, which was a record high for the company. They're
That's
also
how you do
seeing
it.
some strong platform adoption and AI security trends, like a rapid uptake in AI security.
That's how you do it. Triple bottom, hold, flagging out, boom, double top. L-trids.
Disappoint. We also did see annual recurring revenue growth of around 21%, excluding Red Canary, and net new annual recurring revenue was up 7%, excluding the deal, which was actually slower than historical levels. Their GAAP operating losses and net losses also widened on a year-over-year basis, and
Very nice.
I saw this sentiment described as a nothing new quarter, which is perhaps why, again, given that there's no dramatic inflection in growth or the total addressable market, that there's just a lack of growth story here, and that's also creating a bit of a drag on shares. So growth is normalizing. I think that this
Going
is
higher,
interesting
what?
because I was comparing this name to say some of the moves we've seen, and it's closely linked peers like a CrowdStrike, Palo Alto Networks. I know that they're all different, but they're all broadly speaking cybersecurity. And it's been read as like CrowdStrike right now is seeing its growth really accelerate, and then on the other hand, Palo Alto Networks is seeing its growth stabilize. Zscaler, on the other hand, is more of a recovery story and more of that normalization story for some of their growth metrics, like, I mean, as far as just, you know, overall revenue expectations going forward and just guidance. And so that lack of growth, I think, is where they pale in comparison to some of their peers. But this is a very crowded space, and I do believe there's a definite role for all these AI companies.
I agree with you, Jenny.
World, but now unfortunately a bit in the shadow of, say, like a CrowdStrike and Palo Alto Networks, just based on their quarterly numbers this report. Sam?
I agree.
Yeah, and it also comes at a time, obviously, when we're seeing this so-called SaaS apocalypse. Like, yes, the cybersecurity names have been
That's right.
less affected, you could say, by, you know, some of the shoot first, ask questions later because of the nature of their business with the AI risks that it's posing. But still, I mean, yeah, as you say, consolidation in this space. That's why we're seeing it with Palo Alto as well. Very crowded. Jenny, thank you so much for bringing us all those stories for us today. Have a wonderful weekend. I'll catch you next week.
Yes.
Coming up, we'll keep the earnings discussion going, and we'll break down the report from CoreWeave, which is down big in reaction.
Jenny did a wonderful job.
Next on Market on Close.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The
Very
Watch
good.
List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our Investing Webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Boom. More or less seen that one coming.
On Market on Close, let's dive into CoreWeave earnings, which is down about 20% in reaction to its latest report card. So joining us now is Stephen Dickens, CEO and Principal Analyst over at Hyperframe Research. Stephen, always lovely to see you. Look, this stock is getting smoked today, and the reasons I'm seeing out there for that is that the market is punishing those who are not being profitable. Obviously, we saw that miss on EPS, or not proving to be profitable. Spending plans overshadowing some of the good sales because actually the revenue was in triple digits, and the guidance pretty much coming in line. So it feels like there is just no room for error. Do you think it's justified to move 20% lower?
Very justified, baby.
So Sam, thank you for having me on the show first off. I don't get into it. I mean, it's fantastic to watch what happens with the markets does after an earnings print. I look at the fundamentals and as a
he looks at the fundamentals.
This company's in a build-out phase.
Well, he can't trade.
They're trying to land grab. We're seeing a pivot from training to inference. And
You can't trade.
Capture that. They've got a huge backlog.
That's right.
Looking here, it's about.
Now look at the fundamentals on the fundamentals right up.
66.8 to be correct, and they're looking to deploy 30 to 35 billion in capital expenditures to build into that demand. So these guys are a specialist neo cloud. They're building out this capacity ahead of demand. But every GPU that they power on is being used. So it's kind of.
I think something's going to have to happen.
Be thinking about these guys, I think 20% is a bit brutal in my mind. But
bullshit.
As I say, I don't follow that and track that on the equity side.
No, but it's certainly interesting as far as the fact that the market doesn't seem to be buying what you've observed here. You know, obviously, as a tech analyst, following the fundamentals of this company. And I've got to say, you know, Michael Intrader was here.
Glad we have an
today.
understanding.
I was speaking to him. And, you know, he was really pushing back on some of these concerns.
He's
in
a
the market
fundamental
right now.
trader.
You know, he then
The
went
worst
into
kind.
another interview here on the floor where he did talk about the demand
Well, he
for
says.
infrastructure being relentless, were his words. He
They would
says that
trade like
there
them
has to be
communists and
demand signals,
retail
and that's forming
traders.
across the economy. It's just that the fact that they're constrained by capacity now. So I'm just wondering, you know, what are they going to say? I mean, why isn't the market buying that right now? I mean, is there something else that's going on? I mean, are they worried about the financing here?
We've had all the talk, Sam, about the AI bubble, people comparing this to the broadband build out in '99 ahead of the internet. I think what's different now is back then we talked about dark fiber. Nobody's talking about dark GPUs. As soon as they can get access to these,
We were talking about that years
they turn
ago.
them on and the demand is rampant. So, is that demand believable?
No.
I think if you look at a cloud provider who's managed to get to 5 billion in the last 12 months as revenue, that's the fastest ever. I need to go back and look at some of those numbers and claims from the early days of AWS and Oracle and
Them were the days.
Google and Azure.
Oh, looky here.
But I don't
SPY's
think I
about to
would've
hit
said that in an SEC
685.96.
if it wasn't the case.
The 200
So I've got to
SMA.
believe CoreWeave. I haven't done the diligence, but I've got to believe those guys. To get to that fast a revenue is really impressive. So
Thank
I
you.
think there is a deeper story.
Once
here.
I found
think
the
this is
sneaky
just
snake
as
trading
you
strategy, it wasn't
listened
hard
to
at
the
all.
segment Before, talking about a flight to safety. That's everything from gold and bonds and Bitcoin and a whole bunch of other things. I think what we're seeing is that these guys have just had the wrong day to announce their earnings. If we were talking about this 2 weeks ago, may have been a different story. So I think, Sam, I think they're caught in wider market headwinds.
Slick.
Yeah, it's a good way to put it because we've also got some of the concerns around the credit risks in these markets, not to mention what's happening over in the UK with some of these mortgage companies as well, which some of the banks seem to have exposure to. But, you know, Mike was also addressing some of the credit market conversation as well, talking about, he says the data does not support the narrative, and in fact for them the cost of capital has come down. What are you seeing as far as what CoreWeave is doing compared to perhaps what the others are doing? How confident are you
Good point.
in that line as to reassuring the market about, you know, how much spending
Damn.
they're doing without real evidence of the ROI yet?
How'd you come up with that
We've
idea?
seen Oracle of late do a debt raise. I think it was about 50 billion. Google the same. They did a huge debt raise. There's
Incredible.
details of a debt raise as part of the CoreWeave earnings that we saw yesterday. I think we're in a build-out phase. So all of these guys are going out, getting access.
And what happened? We're about to hit the 200 right now, folks.
Infrastructure. My math tells me that. So I think this is a moment in time. I think what stands out for me is that they've been the fastest cloud provider to get to 5 billion of annual revenue. That to me tells me at least that they're building out infrastructure that people want, and as soon as they can build it out and turn it on, they're able to monetize it. That's a good trend to be looking at, I think. I spent some time with the company a couple of weeks ago, got a briefing, was able to dig deep. They're starting to see this pivot from training. I think that'll help with some of the concentration risk they've got with a small number of customers sucking up a lot of their demand. I think as inference comes online, I was chatting to the guys at Cumulus, the CEO of Cumulus AI earlier today. He's seeing that inference at the edge piece. I think that's going to be proliferating across all of these neo clouds. And as we go into 2026, I think that's going to help the likes of CoreWeave and some of those others.
Well, I mean, InTrader was saying today, you make the investment today, you sell compute for 5 years, so every dollar that we're putting to work today means dollars, plural, down the line as well. I mean, the backlog, as you pointed out, is enormous. Just wanted to get your thoughts then on OpenAI and this new fundraising round, $110 billion involving NVIDIA, Amazon now, and SoftBank. That puts it at a valuation of $730 billion. Your thoughts today? Because we're actually seeing NVIDIA is lower, Amazon is performing better. But what are your thoughts?
I mean, the key thing I'm looking at for that is OpenAI has been almost exclusively partnering with Microsoft. There's a link back to CoreWeave there because Microsoft then backed off some of that infrastructure to CoreWeave. So I think I saw that come across my desk in the last hour. The thing that I'm going to be interested in is there an AWS infrastructure component into this? And I'm assuming there would be as part of that. And what that means for me is that that's broken some of the exclusivity that was baked into that original deal that Sam Altman and Satya penned, where Microsoft and OpenAI were going to be exclusive partners for infrastructure. I think that's going to be interesting. I think that's just a statement of, going back to what we were saying around CoreWeave, these large language model, frontier model labs need access to every GPU they can get their hands on, and being solely concentrated on Microsoft Azure to provide those was a risk to OpenAI. So I think there's a technology story behind the investment. That means now AWS has got, I think it's 16% stake in Anthropic, as well as a stake in OpenAI. So good move, I think, from AWS and what they're doing.
Good move.
Okay. Really appreciate it, Stephen. As always, happy Friday to you. Have a wonderful weekend. Stay warm. Stephen Dickens there from Hyperframe Research. Coming up next, we will be
We have triple top resistance.
Technologies after its latest earnings, and
Interday.
back with NVIDIA for its autonomous vehicle technology. Market on Close. We'll be right back.
Really not too bad of a behaved chart, actually. The Dow Jones is down 559 points. Oh no. We better learn how to trade Jimmy's knife. Sneaky snake trading strategy, where we talk about chart patterns, moving averages, being in the now. Boom, boom, baby. Yeah. Woo. Yeah, man. Oh, nice.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Very good. Boom, boom.
Sometimes, you know, you could have done better.
Excuse you.
Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Sam Vardas here at the New York Stock Exchange. Ava Technology creates sensing and perception technology for autonomous vehicles. The company recently was selected by NVIDIA as a LiDAR supplier for its autonomous vehicle technology and recently reported a solid earnings quarter. So let's bring in Suresh Salahian, who's the co-founder and CEO of Ava. Suresh, thank you so much for joining us. Look, a nice quarter here. I mean, revenue of $5.6 million in Q4 compared to last year. You doubled that for the full year, $18.1 million, up from $9.1. Just talk us through the quarter. How would you characterize that? What drove some of those that revenue growth?
Yeah, sure. And Sam, thank you for having me. So we had a breakout record quarter and year, actually. As you mentioned, revenue doubled year over year. And we have also had, I think, one of the probably the strongest performing stock in the sector. I think up over maybe 280%. So, and this is all driven by our execution. We have been executing. It's driven by multiple wins in the production wins across automotive, industrial, and defense sectors, strategic partnerships, and also our scaling of our production. So we were really excited about that. One of the biggest catalysts here, I think, for us has been our first top passenger program win, as well as our selection by NVIDIA as a reference sensor for autonomous vehicle platforms.
Let's talk about that. Can you unpack that partnership for us? What does it entail?
Yeah, so NVIDIA obviously is one of the leaders in the AI space for many arenas, especially in the automotive sector. And this partnership is really surrounding around developing our technology together with NVIDIA, interfacing with their compute platform, but really we're working on one common platform that's being defined as a common suite of sensors, including cameras, radars, LiDARs, combined with NVIDIA GPU and software that's going to be used by multiple OEMs. And our first program is starting slated for 2028 startup production. And NVIDIA is already working with some of the leaders in the space, including top brands like Mercedes-Benz, Uber, Stellantis, and a number of other key players. So we're pretty excited about that, and I think that's been a critical catalyst for the company as well.
Yeah, just talk us through that win, obviously, with the global production contract from some of the European OEMs as well. I mean, what would that entail? I mean, what is that going to mean now for you?
The video is going to be in play here in a day or two.
For us, and
if not Monday,
market, there has been this race for automation. I think the race for automation across multiple sectors.
I'm telling you.
The broader physical AI space, which includes vehicles, robots, industrial sectors, and smart cities. So this has been relying now more and more on advanced sensing technology, including LiDAR. And as we bring our next-gen sensing and perception technology, the catalyst for us has been going from the automotive commercial vehicles or trucks, where we have a production partnership and win with Daimler Truck, to now expanding that into the passenger car space with the top European passenger OEM.
Getting close.
Making millions of vehicles.
Oh, look at that.
That is really known as a leader in the.
Ladies and gentlemen, get ready to rumble. As the NVIDIA stock on the daily time frame approaches the 200 SMA, we know what that means, don't we? Say yes or no. Exactly. Exactly. Tesla. Oh, we're at the 200 EMA on Tesla. Major support level. PLTR. Way oversold, way oversold. PLTR, way oversold. Amazon. Way oversold, way oversold, way oversold. Not on the weekly, though. Not on the weekly. We could sell off more on the weekly. Oh, yeah. I said it out loud for everybody to hear it. And Apple. Apple on the weekly. Little overbought. Little overbought. A lot overbought. Oracle. Oh, we're at support. Oracle. Oracle's at support. We're at the 200. I'm telling you. Jim, I've seen this strategy work before. You've called it out, and we had that big bounce. And you're telling me we're back down here again? And I don't lie, man. I'm telling you the facts. We're right at the 200 on the weekly. Does anybody have a problem with that? That's what I thought. AMD. AMD's overbought. Google. We're trying to get everything planned out so we can take these trades. Overbought. Way overbought. AVGO. Overbought. Walmart. Overbought. Nope, that ain't Walmart. Walmart. Walmart overbought. Walmart's overbought. Chipotle. Oversold. How's he do that? I'll use the 200 as a gauge and the 200 EMA and SMA as a gauge on the weekly and daily time frame. That's how I do it. Hymns. Uh-oh. Ladies and gentlemen, Hymns about ready to pull up at my support. Will I trade it? I think Hymns sucks. It's either a she or a he. Shop down $6.17. But this is Pride, Gay Pride, price line and trend line day, month. Right at the pivot point. So this is shop. We have these territories. These are great scalping territories. So we go into the weekly time frame. Shop. Definitely come close to hitting my support. Oracle. We've already talked about that one. Snow. Oh, look at Snow. Oh, that was Oracle. God. Snow. Oh, yes. I'm telling you, things are looking good, man. When it snows, it snows. Shares of this company within the broader technology sector trade lower on overall market weakness. Bullshit. That's all I got to say. Definitely hit my support level today. 154.94 sometime this week or month. Well, that's the monthly. 4 months in a row. Oh my God. We're at the 200 We're showing a little sign of weakness today, this week. Definitely at a pivot point area. There's that pot stock. Well, that's Nvidia. Moses. MSOS. It can pull back more. What about that BBIA crap? BBAI. Definitely at my support level. CrowdStrike down 13 bucks. Oh my God, this is at support. Just a little bit more. And we'll be approaching the 200 EMA. Mister's down $4, 50 cents. Mister oversold. This one will rebound eventually. Then we got Nike. I said Nike. Nike's oversold. Way oversold. You sit on that for a couple years. Apple's overbought. Meta will be overbought. Chipotle. Oversold. Tesla. Overbought. That's how you do it. And I gotta go. I'll be right back.
Market on close. It's time now for Options Corner, and I'm joined by Rick Ducat, lead market technician, to take a look at Netflix. What a pop we're seeing today, 14%. We went over the details of
Netflix.
Earlier. Investors are seemingly loving the move, Rick. It's rock under the Warner Brothers bidding war here. So just talk to us as far as what you're seeing compared to some of the others in the sector today.
Yeah, I mean, this was obviously a dramatic story. It was pretty interesting to follow. It seems like we're drawing to the conclusion now. Can't help but wonder if this could be a more of a Pyrrhic victory almost for Paramount. They've paid a very handsome price now, an inflated price really for Warner Brothers to the tune of over $111 billion, potentially here. And Warner Brothers hasn't exactly been doing great either. So kind of a question mark here going forward. Netflix, on the other hand, badly beaten up during previous month. Now they get to walk away scot-free with an extra $2.8 billion breakup fee here. So a pretty interesting situation here when we do consider this name. But Netflix and Paramount, two of the top movers in the S&P today when we look at this situation here. Not a lot of analyst activity that I've seen for Netflix based on this move today, but the reaction in the share prices has been enough to speak for itself, I guess I would say.
Yeah, the analysts are probably just sitting going, whew, okay, that's over, for now at least. No doubt we'll keep talking about this story, though. Just talk us through some of the technicals on what you're seeing here with this name, because obviously a pretty nice bounce, as we can see here.
Yeah, for sure. So when we look at our Netflix chart, we can see that we had this rather precipitous decline, starting with earnings from back in October, a big drop, and then that gave us our downward sloping trend line. That was pretty much the prevailing theme for the entire quarter. So then now, after our earnings event that we had more recently back in January, we hit some new lows near 75, handily taking out those previous low points here from the tariff news event shock previous in April near 82. Some other horizontal levels to consider now that we have progressed beyond some of these points. We can see 93, a repeated floor. That's around where we have held on so far today. We did dip below that on an intraday basis, but looking like we're probably going to close above it at this point here. Another repeated low and high point, 87, a low point before a gap, a high point during the January months, and then again just yesterday it was around we saw our high of the day. To the upside, 103 stands out. This was a low point that we reached during our descent here during the past few months here. So you kind of try to pick out these notable highs and lows during this type of situation to help inform your trading decisions here. Now, when we look at our moving averages, very quickly climbing upward once again, our price pattern is a very narrow, very tight channel from which Netflix is moving to the upside here. Our 251-day EMA in orange here, our yearly EMA, 99.54 is to the upside. We also have our quarterly 63-day EMA in gold here, 89.50. So about a 10-point range for our two more significant longer-term moving averages. The longer term, the moving average, the more noteworthy it is as a source of support or resistance because it takes more data than its shorter moving counterparts. They'll react more quickly, but they're less significant when they change. Another noteworthy thing is that we've progressed from the oversold area to the overbought area in the span of just a couple of weeks here. So a very rapid turnaround here. It just speaks to how quickly things can change in this field here. A piece of big fundamental news such as this can rewrite a story almost instantaneously here. So look for the crossover back below that overbought area for signs of potential slowdown on the RSI. Now our volume profile situation shows here we can see that that was the node that we crossed above yesterday here. That's around where we topped out, 83 to 86. Was that heavy trading area there? Then 90 to 98 is more where we are now. So a push above 98 opens the door then to recapture this smaller trading activity area from 103 to 107. So notice as well, very high volume spikes here. A volume spike being volume at least 50% beyond the 50-day simple moving average of volume. So that's our orange line here. You can see very, very far beyond that level here, suggesting very high conviction on the part of traders.
And talk us through the options activity that you're seeing on this name today.
For sure. So we can look at our next few months here of options activity, potential ranges. March 20th, 8.1% expected move, roughly right about here. So giving us a range to consider for that. In terms of today's activity, 2.6 million options contracts changing hands at the time I checked. So very heavy. Netflix is one of the most active symbols in the market. 78% roughly were calls, so very skewed toward that side. Our most important month in terms of open interest, our next monthly expiration in February, over 1 million contracts of open interest. That's in that month alone, more open interest than many symbols have in total here. The top strikes on the call side, 90, 100, and 110 in terms of open interest. On the put side, 80, 83, and 75 for that expiration month here. One notable trade as well, it was a spread, two separate trades, minus 90,000 August 21st, 105 calls, and minus 90,000 August 21st, 125 calls for a total net credit of over $69 million. So really a massive, staggering quantities in terms of both volume and dollar amount.
Great stuff, Rick. Always appreciate your technical lens on all of this. Thank you so much. Have a wonderful weekend. That is Rick Ducat there over in Chicago. Moving on and coming up, it's time for Overlooked Stocks. George Sillis has his eye on Arlo heading into the close, so we'll break down the news about that company, what you need to know about the stock today. Coming up next on Market on Close.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
How's it going?
First day, so.
Sometimes, you know.
Next. Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. I think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Intern, this place is incredible.
Somebody liked it.
Your office supplies, your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest,
Come again.
trade, get full service wealth management, and anything in between. I think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
SPY 685s are in the money at 331.
Welcome back to Market on Pros. I'm Sam Barnes, live from the
685s.
Exchange. It's time now for overlooked stocks. Shares of Arlo are on the rise today after its latest earnings report. So let's break this
Overlooked?
down with George Siller, Senior Markets correspondent. So Arlo being obviously
George.
in business with wireless surveillance cameras. Just talk us through what this company said in its report and why we're seeing such a nice pop for this today, up almost 30%.
Yeah, across the board, it was actually a really good quarter. In fact, a good fiscal year as the company completed 2025. And Arlo is really the company that's gaining market share, and it's competing in the provide security and video surveillance cameras for both home and businesses. But they've been competing aggressively with some of the larger players like Google and Amazon, and they've been gaining traction in terms of subscribers. And what's nice about their platform relative to those major suppliers of these similar technologies is that it's platform agnostic. So there are a lot of people out there that are concerned about privacy and sharing everything out there about themselves to companies like Google and Amazon, and that's where I think Arlo really has gained some subscriber traction. If you look at the report that they provided, they published EPS
ARLO.
That was higher by more than double, 10 cents last year, and actually beat the estimates by 6 cents because they were expecting only 16 cents for the quarter on an adjusted basis. And then sales came in higher by 16% to 141 million, beating the estimates by about $7 million. But if you look at deep down in terms of what they generated,
Fundamentals.
121 million registered active users.
Oh, God.
And paid subscribers. One of the things was that they've been transitioning
Arlo.
more concentrated hardware technology to software and subscription services.
Nice takeoff today.
And AI enhancing security services. The paid subs actually went to 5.7 million. That number was up 24%. Again, keep that in mind. It's important relative to the total revenue for the business. And the churn rate came in at a record low for the year, down below 1%, as well as average recurring revenue from those subscribers up 28% to 330 million for the year. They also provided updated guidance for both Q1 as well as the fiscal year. And it seems like the company has been doing well executing on their strategic plan to generate more of their revenue in subscriptions versus hardware, because we know subscriptions is digital, it's more recurring, it's more margin enhancing, and 63% as reported by the company last year is now based on recurring revenue and subscriptions versus hardware.
All right, well, certainly making a nice recovery with this 30% pop today off the back of coming off those highs in November.
Netflix.
So I really appreciate the breakdown on this earnings report.
Yeah.
Start your weekend. We'll see you next week. We are nearing the end of the market session, so we'll bring in Kevin Green on the other side of the break to break down the levels he's watching on the S&P 500 and also today's action coming up next on Market on Close.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Yeah.
Alex Coffee. And I'm Jenny Horn.
Oh.
This is Next Gen
Jenny
Investing,
Horny?
where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on
Are you Jenny Horny?
investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock. And that could certainly be a short to near term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
We're back here on Market on Close. I'm Sam Barnes here on the floor of the New York Stock Exchange. We've just got a few minutes left in today's session for the week.
Few minutes.
Let's welcome in Kevin Green,
Four.
markets correspondent, to help close out the day. KG, we're seeing that the S&P 500 on track for its worst month since March. US bonds, best month in a year. Energy at all-time highs. Obviously, we've got internationals outperforming. We've got credit risk. We've got AI disruption fears. What's standing out to you about these levels? There's just so much going on. I think what is encouraging is we've come off the lows today.
That is encouraging, but we continue to see a lot of weakness within.
That was a different side of her right there.
Last time that I checked, it was still trading at the lows, and it was actually accelerating here. So we are seeing a lot of pressure in this market, but I think we will get a resolution to this relatively quickly here, Sam. I think we still have the residual effects of kind of rebalancing, repositioning, getting new positioning because of some of the new perceived risk that's in the market. But if you're kind of looking at today's daily chart, we were able to recover from that 100-day moving average. Once again, that's been an area of support pretty much all week and pretty much all last week as well. That continues to hold, but we are below the 20-day and the 50-day moving average. At some point, we are still making lower highs. We are making higher lows. We will come to an apex where the market's going to either break up or break down. If you kind of look at some of the other internals, which we can talk about a little bit later, there's maybe some perceived risk that we could actually see another downturn in this market if these situations like private credit really does escalate. Going into the close here, I'm looking at around the 68.75 level.
Very nice.
A major area of resistance. I have it on here at 68.80. That's what the call flow is, but we have seen this act as a rejection point. Not looking for a major downside slide going into the close. I just get a little bit more concerned about the NVIDIA move. Once again, that's something that you just really do not want to see. It seems like it's on its way to hit 170, and probably once we get there to 170, buyers may step back in. That should be a catalyst for the markets moving higher.
Okay, let's just talk about some of these internals and the perceived risk here, because obviously you mentioned the credit markets. Obviously, there's a few ways to sort of categorize what's going on here, because you've got some of the AI funding concerns. Obviously, CoreWeave is trying to address that today. But a lot of the focus has been around these BDCs, obviously KKR. Just talk to us about that story and the significance of what we're seeing in light of what we've heard from some of these BDCs and why there are these worries in the market and just how risky it could potentially be. Because what I'm hearing is everyone's just trying to figure out whether this is an idiosyncratic sort of one-off situation or it is largely systemic.
Well, I think there was a question that we had around the regional bank crisis, about a year and a half ago. This is actually very similar to that. You have a market and private credit that's really not that transparent. And we really don't get any type of insight until they actually do report earnings for names like a KKR or even a Jefferies for that matter, to see what the perceived risk is. So for now, the market obviously is trying to get ahead of this. We can look at a comp chart here. This is the regional banks, the KRE, which is going to be in white, versus the KKR, which you can look at other proxies as well. A lot of these charts are the same. You have seen private credit names kind of moving to the downside before the regional banks started to get hit. But today, the regionals were down about 5%, 5.5% in the session. So it's starting to actually impact the financial sector as a whole.
There they go.
Really want to see. That also coincides with yields moving to the downside below that 4% level. It's probably a signal as well that we have a little bit more risk on taking place in the market, and high yield credit spreads continue to move higher as well. Signs of stress.
Very good job. I'd say it was a clean day, but slow. It's been a strange week. Like it could be a bottom. Definitely, I'm feeling definitely strange about this week. And what I mean by that is by the way the market was moving. So, not like your typical week, even on a bad week. So pay attention to this week's video. It's going to be a good one. We're going back to the 200 and see if we can find stocks at the 200. Maybe I might even have a scan. I know I got a good hammer scan. I need to start using that. Should have probably used it this week. Oh well. Everybody have a great week. Be safe. I'm going to be safe. See you later, Sheba, Johnny, Financial Juice, Magnificent, Gavin, JYH, Mark, R Green, Ricky, RTP. Later dates.